long-awaited plan to end Russia's war on Ukraine at the Munich Security Conference next week. The blueprint is set to be presented to allies by Special Representative Keith Kellogg and includes potentially freezing the conflict and leaving territory occupied by Russian forces in limbo while providing Ukraine security guarantees. Meanwhile, SoftBank is in talks to acquire Ampere Computing. Sources tell Bloomberg talks are in advanced stages for a deal that may value the chip designer at about $6.5 billion, including debt. This is the latest deal in a wave of chip companies looking to capitalize on the AI spending boom. A transaction may be announced in the coming weeks. And the Bank of England cut its key interest rate by a quarter point to 4.5%, but struck a hawkish tone. The central bank signaling that only 2 more reductions are needed to bring inflation to its 2% target. 7 of the 9 members voted for the quarter point cut, but 2 wanted a half-point reduction. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, navigating trade uncertainty.
The tariff environment is obviously evolving here on a daily basis. How would this work through the system that we really try to help the policymakers understand?
That conversation continues. Up next, we'll catch up with Gene Soroka of the Port of Los Angeles. Look out for that conversation in just a moment.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
Equity futures right now on the S&P bouncing back. We're positive by a little more than 0.1%. Under surveillance this morning, navigating trade uncertainty.
The tariff environment is obviously evolving here on a daily basis. If you see sanctions on Canadian or tariffs on Canadian or Mexican oil, that may send some of that oil to other countries. And so the Venezuelan oil could be even more important. So it's things like that. It's how would this work through the system that we really try to help the policymakers understand.
So here's the latest this morning. The flow of global trade uncertain as the world awaits clarity on President Donald Trump's tariffs. Gene Soroka, the executive director of the Port of Los Angeles, writing strong economy, consumer spending, and front-loading of cargo ahead of potential tariffs are helping to drive LA volume. Gene joins us now for more. Gene, it's good to see you.
Good morning, John.
You had a big 24. Let's start there. Can you tell us how much of that was about a good economy versus just front-loading ahead of this mess?
Well, John, as you know, not one variable drives the cargo volume through the port, but that underlying economy and the length of that stretch has been just tremendous. Then in the summertime, during campaign season, we started to hear from importers saying, you know what, just in case, we'll see how November elections go, I'm going to start to bring in a little bit more cargo and a little bit more. And that turned out to be true. Even our January numbers of cargo leaving Asia before Lunar New Year, probably the strongest on record.
Can you compare 24 to, say, 2021 and your ability to deal with that much volume and how much things have changed? What's changed at the port?
Yeah, I think we got a lot smarter. We worked a lot closer with stakeholders. For example, last summertime during the traditional peak season, we moved more cargo than at any other point in time, including those COVID years, and not one ship was backed up. So I think it's more communication across lines, from shipping lines to terminals, truckers, railroads, as well as being able to see the cargo ahead of time. Our port community system, the Port Optimizer, now sees that cargo 40 days before it lands in Los Angeles, giving us time to plan much better.
Was there a tell in where some of these cargo ships were front-loaded from at a time when there was a lot of pretty heated campaign rhetoric?
Yeah, China, Lisa, absolutely. Because during the campaign, there was talk about not only Canada and Mexico, but China. And at one point, it was $3 trillion worth of American imports that were at risk of having tariffs levied against them. So you started to see more and more folks hedge. But China makes up still 45% of our portfolio at the Port of Los Angeles. That was the biggest and most noticeable attraction to pulling that cargo forward.
Can you just give us a sense of how much it went up during those months and how elevated imports to the U.S. from China have increased in the past 6 months, given some of the expectation of tariffs?
Yeah, we had our second busiest year in the 117-year history in 2024, and the back half of the year was exceptionally strong because we didn't see a lull from the traditional peak season of summer goods that come in ahead of the year-end holidays. November, December, and now January, in excess of 900,000 container units, best all time.
Okay, Gene, but now there's an extra 10% tariff on imports coming from China. What are you expecting?
Well, Anne-Marie, I think in the second half of the year, we'll probably see a dip in cargo, and it'll be cyclical, nothing to really panic about. But with all that product here and the price points better than they would be with the additional tariffs levied, probably just a little trickling down overall, probably 10% less than last year at that time.
The president is also talking about how Europe's going to be next. And in 2019, it was brief, but he did put tariffs on things like French wines, Italian cheeses. How do you game this out for the rest of the year?
Now, a couple things. I think, obviously, a lot of people are talking about prices, both wholesale and retail, what impact that will have. Are folks going to suddenly increase their prices just knowing that the next landing of cargo is going to be elevated and try to get ahead of that? A little bit closer to home, I look at the jobs associated with the cargo. If our cargo starts dipping down, for every container we bring in, for every 4 containers we bring in, it means 1 job. So you look at the truck community, the dock workers, et cetera. Again, cyclical and maybe short, but we still look at that. And then equally as important as we're planning right now on the recovery in locations like Pacific Palisades and Altadena, 14,000 homes were burned. We've got to get lumber and cement and workers in to help to start rebuild those communities. So those are the pieces that I'm watching right now.
How difficult is that rebuild effort going to be? You're right there.
Yeah,
right in the middle of it. How hard is it going to be?
John, it's going to be super tough. I'm really pleased with the federal response, the state folks on the ground in Mayor Bass in Los Angeles, as well as our county supervisors, led by Catherine Barger. But these are entrenched communities that now have to be cleaned up. Families have to evaluate, can they rebuild? Do they want to rebuild? But the all-out effort of that federal, state, and local response has been good. Now that private sector has to come in behind and really keep the pace going.
And some of those people just won't go back. I wanted to finish with you on something much, much bigger picture. So globalization is, of course, something that your business has benefited greatly from. What we've seen is a lot of people get left behind. And what we've seen from politicians is, quite rightly in some cases, a disappointment that there wasn't reciprocity with places like China. I want to understand from your perspective where you see the world going. How are things changing? What does the post-globalization world look like from your vantage point?
Yeah, I think a couple of pieces. One, 90% of trade moves on water. That's really important to us. The cargo coming through Los Angeles gets to every congressional district in the nation. If that cargo starts to move, sourcing changes, we have to be nimble enough, as we've shown over the past 6 years, to follow that cargo and chase it. Be anticipatory of where it's going to be coming from so we can set up. The speed component for the Port of Los Angeles has been our go-to-market play, and it's got to continue. Even with Mexico's manufacturing rising, we're playing strongly in the maquiladora areas.
What's the relationship between what goes through the Panama Canal and what could go to you?
Interestingly enough, we saw that over the past year with the elongated dock workers negotiation here on the East and Gulf Coast. We saw about a 3 or 4 percentage point market share uptick coming our way. I think there's a lot more opportunity.
Have you kept it? Have you held on to that?
So far. Now, it's early days because that contract was just agreed upon in a tentative state back in the early part of January, but we're doing everything we can to keep all that cargo stay in our place.
The politics of that part of the world, pretty interesting as well. Gene, it's good to see you, sir. Thanks for dropping by. Gene Soroka there at the Port of Los Angeles on global trade, Lisa, in a post-globalization world.
Although what's interesting about what he just said, it was quite the opposite at the end of last year as people were concerned about tariffs, that the more that threat is sort of on the horizon, the more people import to get ahead of it. So you can just imagine this sort of pushing it down the road and this constant front loading that might continue.
Well, this is what Zero Hedge was talking about when all of this data was coming out. They were saying this is just perpetual stimulus. If you think the tariffs are coming, you think the tariffs are coming, you just spend and you bulk up and you backfill to get it on a better price.
You keep front loading. Some of those companies that did that, by the way, got caught wrong-footed. Remember Target?
Yeah, well, that was last year. This year, let's see.
That was an inventory landmine, that's for sure. Coming up on the program, Darryl Cronk of Wells Fargo, the LinkedIn co-founder, Reid Hoffman, Sonia Meskin of UBS, and Terry Wiseman of Macquarie. The third hour of Bloomberg Surveillance, just around the corner.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like Trump to change in terms of
what some people see as the over-regulation of banking in America.
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of deregulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive internationally through a more benign environment.
Nobody covers Davos like Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Lots of uncertainty. It's the risk-off trade. No one wants to lever up.
Right now, it is business as usual, but maybe a little bit of a bird on the shoulder of uncertainty.
The volatility is not just in the equity market. Now it's cross-asset.
You're going to get an environment that is attractive for investment.
There are areas where you can look at the valuations and go, you know, this is completely reasonable, but it is definitely more of a nimbleness, and you have to be watching things much more closely.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City, the third hour of Bloomberg Surveillance starts right now with equity futures positive by 0.2% on the S&P 500. In the Nasdaq 100, we look like this. We're just about negative by not even 0.1%. On a Russell, positive by 0.3. In 30 minutes' time, it's all about the economic data. Jobless claims just around the corner, ahead of payrolls tomorrow. The estimate in our survey for claims, 213. For payrolls, 170. Then later on, after the closing bell, we hear from Amazon. Before we get there, got to talk about the labor data and the focus of this administration, not on the stock market, but on fixed income.
Let's just talk about the 10-year Treasury yield for the rest of the year, because that is what Scott Bessent is looking at. And frankly, that is the correct thing to be looking at, completely unbiased view. Look, people have been saying that in this term of the administration, it will be the bond market that offers the biggest check at a time where inflation is coming off a higher boiling point, and you have a real question about just how much the U.S. can increase its deficit. Will this be the constraining feature to some of the pro-growth measures that we have not yet seen rolled out at a time where we already have seen a lot of tariff talk?
I'm just going to say it's going to be a long year then, when Lisa every day is saying how the 10-year yield is basically, you know, the most important thing, and now she has Scott Bessent to thank for that.
More cowbell.
What I will say is tax cuts are going to mean higher deficits, which mean you need higher yields to finance them. And in the same interview with Larry Kudlow, Scott Bessent was talking about the fact that he wants to make the tax cuts permanent. This is going to be expensive, let alone, let's not even discuss if they have the votes for that.
Non-inflationary growth is difficult to achieve. There are several ways of doing it. The previous administration took advantage, benefited from mass illegal immigration. And that's essentially what it was. Just huge amounts of undocumented workers coming into this country, a big boost to the supply side of the labour market. That allowed them to deliver non-inflationary growth towards the end of the administration, the first term for President Biden, and of course, the last term. In a second term for President Donald Trump, to achieve this by not going down the same road they did, but by going down the energy path, is an intriguing one. Makes sense on the surface of things. Get energy prices down, you'll be able to do things elsewhere, rates should fall. How do you get energy prices down? How will they boost supply in this country?
It's a great question. We had Mike Wirth on from Chevron yesterday. There's a lot of pro-oil and gas and energy talk. Has there been anything on the ground to really increase the production? Not necessarily. It is an interesting point at a time where efficiency is becoming the tool to offset a lot of the extra expenditures. We're seeing this in corporate America, and we're seeing this in the government. Does that lead to a real slowdown, though, in the labor market at a time where some people are saying we're already on a softening path?
There's also inconsistencies with this idea to get energy prices down. what matters more, foreign policy and tariffs or energy prices? Because you're doing maximum pressure campaign on Iran. You're talking about tariffs from Canadian crude. You're talking about maybe pushing Russia to force them to the table by trying to snap some of those tankers off the global market. There's a lot of inconsistencies, which actually might mean you could see energy prices higher, even though they want to drill, baby, drill. It's a really interesting moment for the American economy and the American bond market too. Just for Lisa, the 10-year yield right now, higher by 3 basis points, the 10-year 4.45. You'll hear more from Scott Besson a little bit later, the Treasury Secretary, sitting down with one of our print reporters down in Washington, D.C. Look out for that on Bloomberg TV and on Bloomberg Radio. He'll be catching up with Salia Mohsin a little bit later. Coming up this hour, we'll catch up with Darryl Cronk of Wells Fargo on optimism for U.S. markets, Reid Hoffman of Greylock on big spending for AI, and Sonia Meskin of UBS looking ahead to payrolls. We begin this hour with stocks looking for a third straight day of gains. Darryl Cronk of Wells Fargo with optimism ahead, writing this: we expect stock prices to march hard by year-end, driven primarily by earnings growth that should broaden to more cyclically oriented areas. Darryl joins us now for more. Darryl, good to see you.
You too, John.
Bit of heat coming out of the American story. It's not bad, just a little bit of heat coming out. ISM services, job openings, we'll get claims later, payrolls tomorrow. Is that a good thing?
I think it's a good thing. You want that economic growth. I mean, we walked into this year thinking the economy would run hotter than most of our friends up and down Wall Street, right? So we were a good half a point above in economic growth. We thought rates would be higher. We thought inflation would be meaningfully higher than the consensus. We were almost a full point ahead of everybody else on year-end CPI for 2025. And we think earnings will deliver. I mean, you're already seeing it here in the fourth quarter. We're on a run rate of about 5% revenue growth and just over 10% earnings growth. 5% revenue growth is the real element, I think, right? Because you can drive that down, in operating leverage through the margins and straight to the bottom line. So if you can maintain that kind of revenue growth and get decent nominal growth, let's call it 2.5% GDP growth with, we're going to say 3 to 3.5% inflation. Our year-end target's 3.3. That's 5.5%, 6% nominal.
If you think that the economy was run hot last year, is some of the uncertainty that we see right now coming from policy that hampers corporate spending, is that a feature, not a bug, to help with the disinflationary process where otherwise some of these pro-growth policies could be somewhat inflationary?
I guess the way we've thought about it, Lisa, is when the dust settles at year end, the positive policy impacts need to outweigh the negatives, right? And you've got both ends of it, right? So you've got tariffs and immigration you can call negative, and you can call deregulation and tax cuts positive, right? We haven't got to the latter yet, right? We're still kind of, stewing on it. We've been all about, early days, tariffs, what we do, control of the border, all that stuff. So ironically, the markets have weathered that quite well, right? I mean, we're sitting here in a tight band, whether you look at the stock market, the bond market, right, which we're talking about with the 10-year.
Thank you.
I mean, remember that, when the Feds first started cutting rates in September of last year, September 18th, the 10-year was 370, right? It's 445 today. All of that's term premium, right? Because the long end of the curve is term premium, a growth premium, and an inflation premium. Almost 55% or 55 basis points of that's term premium, which is just a function of the uncertainty around the policy.
Okay,
right?
so if you do get some of that term premium taken out of the system, if you have longer term yields return to sort of where they were back on September 18th, how much is that part of your call for the broadening out? How important is that to see the rotation out of just some of the Magnificent Seven stocks into the rest of the index?
Well, certainly. So what I would say is this, like when you think about 2025 and what has to happen, you've got two fives that need to happen. 10-year needs to stay below 5%, right? Unemployment rate needs to stay below 5%, right? Earnings growth needs to deliver, and earnings breadth needs to broaden out, to your point. Inflation needs to stay less than 3.5%. The dollar, if you want to measure it by the DXY, needs to stay below 110, right? And the positives of policy need to outweigh the negatives, right? If you get those things to happen, I think you're in a good place and markets can do quite well. Any one of those spiking above some of those thresholds start to inject risk into outlooks and the system, basically.
I want to pick up on your point about tariffs, and how you're saying the market's weathering it pretty well. But isn't the market just pricing in the fact that there will be 11th hour deals like we saw with Canada and Mexico?
Yeah, I mean, I think you have to separate, right, the old adage of, like, you got to take President Trump seriously, but not literally. We were learning that quickly, right? not all tariffs are created equal, right? Remember Trump 1.0, the tariffs were very surgical, right? It was washing machine parts, solar panels, and steel and aluminum. This time they're very broad. They're like a stick, right? 25% on Canada, 25% on Mexico, 10% on China. They're at the country level, right? So we're using the emergency powers instead of 301, 232 powers this time, right? Which is a very different equation. I think when it's all said and done, you know, the Canada, Mexico, and call it the friends tariffs, including the Eurozone, are more about leverage and getting what you want. China is more about geopolitics, right? That's where the real rub is with China. And I would expect the durability of the Chinese tariffs to stick and stay. And that means very specific things for certain industries, right? We still get most of our tech hardware and a lot of our semis from parts of China, right? Autos are a big element there. Metals, energy prices, those are the areas. So it's gonna come down to those segments, sectors, and industries where the tariffs are going to matter as they get applied.
Are you concerned at that point then about inflation rising, because this is the opening salvo when it comes to Chinese tariffs?
Yeah, I mean, as I said, I think the inflation is, you can call it stickier, you can call it more durable, whatever you want to call it. If when we walked into this year, the rest of the street said, you know, if you measured U.S. CPI as they were saying 2 to 2.5, we were at 3.3, right? Which is that full point ahead. Which is why when you look at, go back to Lisa's 10-year, I know we got to keep coming back to this, which is why our 10-year, sorry, John didn't
choking on my water. Yes, she doesn't own the 10-year bond, but carry on.
Actually,
well, so it's why we have the 10-year at year end this year at 4.75. Like, we don't think when we were doing the math, right, about everybody else was in the threes on the 10-year, right, for year-end 25. You can't make that math work, right? So I think rates are higher. I think inflation is more durable, and that inflation premium as the year goes on gets stacked into the yields.
Scott Besson needs to talk to Bramo about Bramo's 10-year yield.
Well, call me up.
I spoke to an aide last night, and they said no. He watches everything, every indice. They're like, also he looks at the barrels on the market. He wants to know where oil is every day.
I have no doubt about that. But I think coming into this year, just bigger picture, we thought maybe because they were going to run this hot, there would be a risk that the deficit would get away from them, the Treasury yields would run away as well. January, yields started to push up back towards 5%. We've retreated by 40 basis points. When you hear the Treasury Secretary say things like, I'm focused on the 10-year yield, how much comfort do you take from that? Because we talked about this to close out last year. Would they be constrained, regulated by stocks or regulated by bonds? I think a lot of people thought that maybe they might be regulated by the bond market. Do you take any comfort from that?
I do think that's the right focal point, right? Rates matter in this environment because it matters for equity valuations. It will matter ultimately for earnings. It matters for small caps, right? So look, there was a lot of short positions sitting right on the 4.5% line on the 10-year that scrambled to cover, which is why we ended up at 440 yesterday on the back of the Treasury refunding, which was no news, right? And we didn't see, you know, Treasury Secretary Bessent turn around and say, I'm going to start layering out more and heavier auctions in the 10 and 30 year, right? The 3, the 10, and the 30 were all spot on where expectations were and have been for the last 4 months. So this whole idea that they're going to stop issuing as many bills and start issuing more long bonds, maybe in the future, but it's not in the current, right? And if that happens, then you start increasing supply, right? The risk you run is the auctions get sloppy, John, right? And we saw that back in October of 2023 where there just wasn't enough demand. Everybody was crowding to the short side of the curve on the demand, and the bid to cover ratios on those long auctions were messy.
And then Yellen made some changes, and it looks like those changes might be sticking, at least for now. Darryl, it's good to see you. Darryl Cronk there of Wells Fargo. On Lisa's 10-year bond yield, which is just about unchanged this morning. With an update on stories elsewhere this morning. We should keep going with this.
Oh, really?
Let's get your Bloomberg brief. Here's your Hara Hacker. Say Hara.
Hi, John. We're actually staying on that story. U.S. Treasury Secretary Scott Bessent says in order to lower borrowing costs, the administration's focus is on bringing down 10-year Treasury yields, not the Fed's benchmark rate. In an interview last night, Bessent said Trump is not calling for the Fed to lower rates. Bloomberg's Celia Mosin will have an interview with Secretary Bessent today at 1 p.m. Eastern. In other news, shares of ARM Holdings are falling 3.9% in the pre-market. The company reporting better than expected third-quarter results, but gave a cautious revenue forecast for the full year. That's adding to recent concerns also seen by AMD this week that the booming market for AI hardware is now on shakier ground. And the NFL is going down under. The league will play its first game in Australia in 2026. The Los Angeles Rams will be the designated home team, playing a team to be determined later. Australia is considered a significant global market for the league, with a growing fan base of millions. That's your Bloomberg Brief. John?
Yahara, thank you. Shorter flight for the Rams, so I guess that kind of makes sense, right?
You're coming
You're
to
not
me for some
interested. All right,
interesting
okay.
commentary on this. Lost cause.
I've learned my lesson. Okay. Up next on the program, bonds. The morning calls. Plus, LinkedIn co-founder Reid Hoffman joins us in just a moment. Looking forward to that. Live from New York City. You're watching Bloomberg TV. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Lisa, that's fascinating. You've got to share that with the audience.
No, we really don't. Let's move on. It's too long.
All right.
Ways to manipulate
Big brother.
kids.
No, it's very interesting. Okay. Doesn't want to share it. Equity futures on the S&P, positive by 0.2%. I might later. Let's get you some morning calls. First up, Wells Fargo lowering its price target on Ford to $8, noting lackluster guidance for the year. Your second call from Evercore, upgrading CarMax to outperform, highlighting a favorable industry backdrop. That stock is positive by 3.5%. And finally, Piper Sandler lowering its price target on Qualcomm to $190, expecting a 10% decline in handset sales this year. Let's stick with tech. The impact of generative AI under scrutiny as some investors question massive capex spending in the space. Reid Hoffman, the co-founder of Manus AI and author of Super Agency, What Could Possibly Go Right with Our AI Future, joins us now. Reid, it's good to see you.
Great to be here.
I said as you walked into the room, that is a book I need to read. What could go right? Because I'm very worried about what things could go wrong. Let's put it that way. You, in the book, approach something really important. That as we make these technological revolutions, these advancements over human history, actually, it benefits human agency. And I'm worried that maybe with AI, it goes in a different direction. Help me out and tell me why it could go right.
Well, the short answer is it gives you superpowers, right? And it gives you superpowers across a large number of things. Everyone should go try ChatGPT, Inflection's Pi, Anthropic's Claude. Give it a try. You can find what should I make for dinner? How do I get medical advice that's available to me? How might I have a difficult conversation with a colleague? You know, how might I actually do things in parenting that might be different? You know, all of those things are superpowers that we get.
Are you throwing Lisa under the bus?
I am.
Lisa, do you want to share with the audience what you do?
You can manipulate what your kids look at if you send them links to things that then change their algorithms that then give them more news feeds. in their feed. I mean, there are ways that you can kind of play the system a little bit, and I think that that's proper.
Yeah, exactly. And by the way, it helps them learn. It gives them news about the environment around them. I mean, this is one of the things. If you're not actually, in fact, using these AI agents to learn right now, you should. And like, for example, one of the ways that I do when I approach a difficult subject, say, for example, quantum computing, I stick a technical paper in, and I say, explain this to me like I'm 12. Superpowers.
Superpowers.
Yes.
Okay, so my next question was going to be, how should we participate in how we shape this intelligence? And Lisa has given us one idea. Could you give us another?
Well, I think part of the key thing is that my very first chapter is about ChatGPT, where humanity enters the chat. You've got hundreds of millions of people who are interacting with it, and the company watches what works and what doesn't work, and then improves it. So by simply going and experimenting and getting which kinds of things are the things that help you elevate your agency, then actually, in fact, helps the company know, oh, these things really work. Oh, these things need to be improved.
At the same time, you talk about technical papers, and one thing that AI does really well is work with technical details, not so much the social, not so much when you have to have certain biases that are baked into some of these algorithms. What are the limitations to this in sort of broad-based application at a time where people are saying this could do qualitative jobs and there could potentially be a lot of biases baked in?
So every major group is working intensely on biases. And actually, one of the things that we did with Inflection and PI, personal intelligence, pun intended, was to teach it to be kind and empathetic, to have EQ as important as IQ. And actually, you see that now in Anthropic's Claude and other things as it's kind of spreading. And so you can actually have these kinds of interactions, be trained in them, and this is kind of reinforcement learning by human feedback, to actually be much better than your average human.
The reason why I find this so fascinating is because I think about my children and what careers they potentially could have. And I'm like, no, not programmer, because that's going to be dead. All of these other ones, probably if you can be empathetic, human, those human skills are probably going to be more needed. That's what people are saying. Are you saying those two are going to go out the window? I mean, what does this do to employment?
So first, I actually think programming skill jobs aren't going out the door. I think there's human amplification, but I think it's also human amplification of like EQ as well. So the fact that you have for example, say a medical assistant that can help you with something, or a coach that might be able to talk to you something, doesn't mean you don't want a human coach. It's more coaches the better, right? And being able to make it work.
You're talking about AI for the good. Yes. But what about AI in the hands of adversaries?
Well, so superpowers for terrorists, superpowers for criminals, superpowers for rogue states. That's one of the things that we need to be careful about how we navigate. Once again, all of the major groups actually have security groups that are working on this to try to make sure, and that's, I think, part of the having so-called red teaming plans and kind of trying to make sure that that's as minimized as much as possible.
But how do you think the U.S. government should be approaching this? The market's freaked out because of DeepSeek and how much potentially the CCP is putting money into their version of AI. But when you're in China and you want to look at things on DeepSeek that are potentially critical to the CCP, it will not show you. So how does the U.S. government go about this?
Well, so I think it's important that the U.S. government kind of continue some of the threads that the previous executive order did, which is, you have red teaming things, that you actually do world leadership about what kind of things are happening. I mean, there's connections in the UK AI Safety Institute and the US one and the French one, and I think these are important to do. But I think that this is one of the things where there will be multiple AIs, and part of the reason why I want AI not to just be artificial intelligence or amplification intelligence, but also American intelligence as part of what we're doing.
What do you make then of the tech industry being very close to this administration? I'm not just talking about your former friend Elon Musk. I was at the White House yesterday and Bill Gates was walking into the West Wing for meetings. Do you think they can help the administration basically get to there faster when it comes to safe AI?
In the short, absolutely. I think it's, if you said of any kind of Western democracy government in the world, most especially, of course, American presidency, American government, should they be connected with the tech industry, talking about how tech's creating the future? What are the things that we can do to make better American industry, better American society, better lives for American citizens? The short answer is absolutely.
What do you make of the backlash against Elon Musk more recently about his involvement with government?
Well, in government, the move fast and break things maybe should be, a little bit more compassionate and judicious.
Is that what you think the approach should be?
I think that the question should be is trying to say, hey, look, there's a reason government doesn't work like companies, even though I think there's efficiency that's really good, and we need to respect those reasons too.
Do you feel that you're going to basically get some sort of repudiation because of where your politics were ahead of this election, and given how Trump has basically cozied up to a lot of individuals in the tech world? I have not seen you yet at Mar-a-Lago at inauguration or walking into the West Wing.
Look, I think the thing that we most want as American citizens is for our government to succeed for our industry, succeed for our citizens. And so that's what I most want. And I think we all do.
You have been an incredible investor. You were an early investor in OpenAI. You invested in LinkedIn. You just so many of the behemoths currently. Do you see a lot of upstarts right now that look like they could become the next big thing in some of this machine learning technology?
So the short answer is yes, although picking them is one of the difficult things about being a venture capitalist, and there's a lot of different options. Back, a few years ago, I was arguing that we were 5 large tech companies heading to 10, but I wouldn't necessarily have predicted that NVIDIA would have so quickly become one of those, into the 7 and then going to 10. And so I think we are in that progress, and I think there are a number of startups that are creating amazing technology, and then the question is product market fit at scale.
What do you think the next technological evolution is going to be that could potentially be a sort of ChatGPT moment or a DeepSeek moment or one of these sort of breakthrough ahas?
One of the things I think we're going to see this year, all of the major AI companies are working on amplifying coding. And one of the things, like, for example, for your kids, other things will be, yes, you have to bring it up, will be actually, all of us will have a software engineering assistant, and that will make all of our work a lot better. And that's one of the things I think hasn't yet entered the consciousness. So I think that's one of the things that's coming. And then, of course, with what I'm doing with Manus, I'm hopeful that we will have some really great early results in curing cancer.
And how we can accelerate the scientific process. And I think we're all up with you on that page. I hope you're very successful. Thank you, sir. Really appreciate your time. Thank you. It's good to see you. Reid Hoffman there of Manus AI and a whole lot more. Up next on the program, some jobless claims data just around the corner. That data drops in about 5 minutes' time. Terry Wiseman's going to join us, and Sonia Meskin from New York City. This is Bloomberg.
everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have take two numbers.
Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Bloomberg Invest is back. Join me, Shonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
Equity futures on the S&P 500 positive here by 0.2%, just about unchanged on the Nasdaq. In 20 seconds' time, we get some economic data. Look out for jobless claims. The estimate 213, the previous number 207. We switch up the board and get to Lisa's bond market. The 10-year Treasury yield looks like this. Yields up a single basis point. We should have branded that. Oh, yeah. 443.22. We can rename the data check part of the screen.
Can you imagine?
Yeah, it would be good. Okay. Jobless claims drop. The numbers look like this. The estimate was 213. The previous week was 207. I'm trying to stretch so the number itself does actually drop. We're still waiting for it. I can give you some numbers elsewhere as we wait. It's a small upside surprise. 219. 219 against an estimate of 213. The previous read was 207. 219, as you all know, on a historical basis is exceptionally low. So still in the low 200s, just a small bounce from the previous week.
And you see a small tick up versus expectations for continuing claims. The revisions, again, very much tame. I would be surprised if the market responded in a massive way to this, because it doesn't indicate that things are really falling off a cliff. And we heard earlier from Jonathan Pingle, not Junior, but Jonathan Pingle the younger, who was saying this actually might become the more interesting data point at a time of stagnation where the jobs number tends to be from a data generator.
The bond market at the moment, the yield is higher by a single basis point, the 10-year 443. Going into tomorrow and that random generator, the number that we get on Friday morning, Payrolls Friday, it's like the most important number in the world, and it's like the random number generator that spits out something like 200,000. Who knows what we're going to get?
In fairness, that's better than having some conspiracy theory about why they then downgrade the expectations by 800,000 the following year. So it has been a messy number. There are criteria that go in. Maybe it's more accurate, as the most accurate forecaster just said, to just view it as a random number generator.
The estimate for the random number generator tomorrow is 170. 170, the previous number was 256. That estimate comes from our survey here at Bloomberg. That's the median, 170. Terry Wiseman of Macquarie joins us now for more. Terry, it's good to see you, sir.
Good to see you.
Lots to talk about the economic data, but we've got to start with Lisa's bond market and the comments from the Treasury Secretary, Scott Bessent.
Love this.
This administration focused on the 10-year yield. I asked this question of Darryl Cronk a bit earlier. I'm going to ask it of you. Does that bring you comfort as someone who follows the bond market?
Absolutely. First of all, it's an implicit admission that the short-term yield is not within the purview of the Treasury Department or the administration. That's great because it's effectively an admission that the Fed should be independent, right? They deal with the overnight rate, they deal with Fed funds, and what Scott Bessent is saying, we deal with the long end of the curve. Now, that's natural. It's the Treasury that issues bonds and long-term bonds, so you would see the logic behind the idea that it's the Treasury that should have some purview over the long end. But he also said something different that also gives me comfort. He says he wants to bring the long-term yield down by virtue of lower structural inflation, and that comes through better productivity. And I think that ties in very nicely with some of the policy agenda of the current administration. So it all fits together.
It all fits together and makes some people bullish bonds, and that's what we saw, especially when you add on top of it the Treasury refunding announcement that came out completely unchanged, so it wasn't the terming out of debt. Just how much more bullish did you get on that lovely 10-year note yesterday?
I didn't get that much more bullish because in the final analysis, what is going to drive sentiment for the 10-year are things like the deficit. And this was not so much a statement about the deficit, although there are, anecdotal stories out there about the, what Doge is doing and what Elon Musk is doing to try to reduce government expenditures. I got a little bit more excited about that part of it that seems to suggest that they're going to be hands-off with regard to the Fed. And if you'll notice what happened this morning, the dollar rallied. And I think to some extent, the reason that the dollar rallied this morning was because people were interpreting this not just as something that has to do with the long-term yield, but also something that has to do with the Fed funds rate and Fed independence.
What have you made of the move that we've seen in the dollar with respect to some of these tariff announcements, given the fact that initially it was the haven play, and then it was sort of unclear, and people walked that back, and then there was questions about the loss of American exceptionalism, worries about the deficit. You could create your story. What do you make of some of the reaction that we've gotten recently?
Well, the dollar has strengthened a lot. So, you can interpret the weakness that we've seen on the back of the tariff announcements as a sell the fact situation. In other words, it's not really fundamentally a weak story for the dollar, but so many people had built up long dollar positions. They may have used the tariff announcements as a reason to take those off, and therefore we had some volatility in the dollar. But like I said, as of this morning, the dollar seems to be strengthening again. The administration seems to be granting more independence to the Fed. That certainly is not part of the problem at this point.
You're talking about tariff bombing, though, when it comes to Europe and China, according to your note. And then you say, where's a tariff bomb shelter? Where are they?
That's very, very it's very, very difficult to find one because, when people get worried in the market and sentiment turns south, correlations go to 1, and it's difficult to hide and find any pockets of stability or robustness or strength. I will say, however, that some of the bad news, I think, with regard to Canada is already out, right? You want to go to those places where the news has already come out and try to avoid the ones where the news is about to come out later, right? On the premise that if the news is out, it's fully reflected in the price, and maybe there can't be much more action. So I point to Canada, if only because the worst seems to be over. Now, we may revisit the issue in 30 days, but again, the initial shock is gone, is past us. That might be a good place to hide. The Japanese yen, in terms of the FX market, may be a good place to hide because I think the BOJ is very cognizant of the need to assuage the Trump administration, not to let the yen weaken further. So that might be a place to
Also, Japan has a trade surplus, which Donald Trump likes. He hates trade deficits, i.e. Europe, and he says Europe is going to be next. How are you looking at the euro? Is this parity for this year?
We don't think it's going to get that bad because I think that, again, a lot of the bad news is out and a lot of this is anticipated. But and I do think that ultimately, speaking about the year, as we get closer to the end of the year, there will be compromises on the main issues that divide the U.S. from the EU. Things like energy policy, things like disposition towards China. I think these could be resolved. I think there's enough commonality. But Trump being Trump still wants to use the divisions that have prevailed over the last few years to try to get his way and try to get the compromise to be more in his favor than in the EU's favor. So over the next few weeks, I do believe that we may see more tariff bombs. They'll be directed at the EU. And again, you want to think about, actually at this point, about finding those places to find shelter in.
Directed at the EU and maybe not the UK. Let's talk about the UK. The Bank of England cutting interest rates about 90 minutes ago by 25 basis points. A couple of individuals on the MPC voted for a half-point reduction, including one prominent hawk, which was a big change from the likes of Catherine Mann. Sterling's down to 124, 123.90. What's the Bank of England doing, signalling interest rate cuts, more to come at a time when inflation is still above 2% and will be so for the next several years?
I think they're looking at the direction of inflation as opposed to the level. And if you look at the UK, services inflation, the services component of the CPI, had been very sticky until about 2 or 3 months ago. And even there, where people had expected no stickiness and really no decline, no disinflation, we've seen a precipitous disinflation in service prices in the last month or two in the UK. And I think that's giving them comfort that underlying structural inflation in the UK has come down and that this 2.5% that we're seeing in headline CPI is real. It's not about to evaporate, and we're not about to get inflation again.
No stagflation then? Because downgrading your growth outlook and upgrading your outlook for inflation is not a good thing to do.
It's not a good look, but I don't think that there's really much that the UK can do in the very short term about the growth outlook. Remember, that depends on productivity, it depends on demographics, it depends on innovation. These are not things you can fix overnight, even in a liberal economy like the UK.
There used to be this belief that there was a constraint on central banks like the Bank of England and the ECB on cutting rates in response to weakness because the weakness in their currency would lead to an uptick in inflation. Why is that no longer on the table?
I'm not sure that it's no longer on the table. I do think that they look at the currency, and if the currency were to decline quite a bit, I think it would sound off alarm bells about the prospect for FX pass-through into inflation. I think the issue here is that we haven't seen a precipitous, large, consistent decline in these exchange rates. If it were to drop by 2 or 3% over the course of a day, it would be taken to imply a lack of market confidence or a collapse of market confidence in these currencies, they would react. But these are slow moves, these are trending moves. And I think because of that, there's no sense of panic that needed to address it with interest rates.
There's a bigger point here, and John was alluding to this earlier, that maybe some of these single mandate central banks are becoming more dual mandate central banks, just incognito, right? That they're going to allow a weakening in currency, allow inflation to remain a little bit higher because the emphasis needs to be on growth at a time where they are being left behind. How much do you think that that is a template for other central banks, namely the ECB, in the weeks to come?
Let me first say that that's a dangerous policy to follow. And the reason is that sometimes when you see slow growth, you don't really know if it's the result of poor demand, poor aggregate demand, or lack of an expansion of the economy's possibilities, i.e. an expansion of the production frontier. And if you're cutting rates, if you're cutting rates in the face of disinflation that is being caused by weak demand, that's okay. But if you're cutting rates on the back of a declining growth that's being driven by poor supply conditions, you may end up simply creating a lot more inflation. And I think that the central banks need to make a better distinction when they issue projections about GDP. What is the underlying driver here? Because what the underlying driver happens to be should play a big role in how they address the slowdowns with interest rate policy.
Hey, Terry, this was smart. It's good to see you, as always.
My pleasure, John.
Bit of a clinic, as always, on foreign exchange and the bond market as well from Terry Wiseman of Macquarie there. If you are just joining us, welcome to the programme. 10 minutes ago, we got some economic data. Let's focus on jobless claims. It came in, small upside surprise, 219. The number we were looking for in our survey, the median estimate was 213. The previous week was a revised 208. In line with what we've heard so far this week, things coming in just a little bit softer, but with the emphasis on a little bit, just a little bit softer on jobless claims, a bit softer on job openings and the jobs data that we saw over the past few days as well. The ISM also just a little bit softer. Taking some heat out of the American economy seems to be the big takeaway so far this week.
And it's welcoming to see, people are welcoming the idea of taking a little bit of heat out of the U.S. economy because it's not coming with it falling off a cliff. I do think it's interesting, this idea that we're seeing stagnation on some levels when it comes to job growth, and this question of when that creates fragility and when that's actually something that just is a feature of a very stable economy that keeps chugging along.
I say some heat's coming out, then we'll get payrolls tomorrow and it'll be like 280.
It's in random number generators.
I've got no idea what the number's going to be. The estimate in our survey, the median, just to give you a sneak peek of things, 170. The previous month, of course, 256. Sonia Meskin of UBS dropping by for more. Sonia, good to see you. What are you looking for from tomorrow's number? And to Jonathan Pingle's point of Natixis, why is January so hard to forecast?
You know, January tends to be quite seasonal. There's also weather effects as well. So we have this impact of seasonality, and we've had this historically, I think, for at least a few years, that is amplified in January compared to other months. But in addition here, we're going to have benchmark revisions. So the underlying assumptions of how we're estimating data might change as well from the Census Bureau. So we're looking for 200K, but really, as we've published, this is just an exercise in predicting noise.
An exercise in predicting noise. We should collect these. An exercise in predicting noise and a random number generator. This is fantastic. I am curious about what your takeaway is, just more broadly, from the random number generator or, exercise in noise. The stagnancy of this market, that's not stagnation of this market, the idea that we're not seeing a lot of hiring and we're not seeing a lot of firing. Do you take that as being implicitly a negative, suggesting a brittleness that makes this labor market more susceptible to some sort of shock? That's the way some people have been describing it.
Well, that's possible, yes, and tariffs could be one of those shocks, actually. And we would expect the unemployment rate to go up if the tariffs against, Canada, Mexico, China are, in fact, sustained, especially Canada and Mexico. But on the other hand, the U.S. is doing considerably better than the rest of the world, so that is a strength for us, of course.
JP Morgan had this survey, and they talked about inflation and tariffs have the biggest impact on markets in 2025. I know we're just joking here, but in all seriousness, does it even matter what the non-farm payroll number is tomorrow?
In terms of the exercise in predicting noise, probably less so. Well, of course, in a sense, we would expect, if, for example, the number comes in considerably lower than what the market expects, I would think the market would react, of course. Now, if the number comes in close, as usual, folks are probably going to look through it more and refocus on tariffs.
Well, okay, so let's talk about tariffs then. You don't think Canada and Mexico get implemented, but we still have China. This is just the opening salvo, Trump said himself, and he says he's going after the European Union next. How do you think about tariffs for the rest of the year?
We would think of it as if they were to get implemented. There are really two ways to think about it, right? Two paths. One is just the threat of tariffs that is causing uncertainty already for businesses. And we've seen this in the ISM manufacturing survey, for example, ISM manufacturing as well, and others regional surveys. And the other one is the actual impact of tariffs if they were to get implemented and they had staying power. And in the latter case, it's a bit easier to estimate, though there's still considerable uncertainty. We would expect a bigger hit to growth than inflation, actually.
Something largely absent from this conversation, and absent, I would say, from the news conference with Chairman Powell in the past week. Why no conversation about the fires in Los Angeles and the disruption we all expect in the economic data? What happened to that story?
Well, that's a terrible, it's a terrible tragedy, of course. But unlike the staying power of tariffs, we would expect there to be a rebuilding exercise and reversion to trend from a hit like that.
So you're not expecting any disruption in the economic data in the weeks to come?
We are expecting this to show up in part in the NFP, for example, later this week. But we're not expecting this to be in effect for the rest of the year necessarily. That would persist.
Got it. Sonia, it's good to see you, as always. Sonia Meskin there of UBS on the data we get tomorrow. So we've got random number generator and an exercise in predicting noise?
Noise, yes.
Okay. Is that the promo for tomorrow?
So stay tuned.
Taking
We're
the
gonna
day
have
off.
a special. Actually, I think it's important because you can take something, as you consistently say, from the way that markets respond to this number generator. And I will say the bigger point is going to be less the random number and much more the way that they revise the numbers from last year. Just how much momentum did we have in the labor market going forward?
We've been mentally revising those numbers down, haven't we?
I mean, by what?
Over the last number of months.
700,000 to 800,000?
Yeah.
70,000 minimum people have been talking about. They take right off the top.
Is Sonia setting off alarms? What are you doing over there? What's happening? No? You want to tell us what that was? No? Forget about it. All right.
That's just noise.
Okay, just noise. That's the noise. 8:30. Okay. Sound effects on this program now. A different program, wrong show. All right. 2-year yield's higher by 2 basis points. The 10-year yield higher by almost a basis point, 4.42. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Ford shares are falling 5.7% in the pre-market. The automaker warned its profit could fall by $2 billion or more this year. Ford blaming the weakness on falling vehicle prices. At the same time, it's working through expensive new model launches. On top of that, CEO Jim Farley told Bloomberg that President Trump's threatened tariffs could cost the industry billions of dollars. Meanwhile, Roblox shares are tanking in the pre-market, down 18% after the online game platform reported daily active users that fell short of analyst estimates. The number came in at 85.3 million. That's about 3 million fewer than analysts were expecting. The company also lowering its bookings estimates for 2025. And 100,000 organic eggs worth about $40,000 were stolen from the back of a distribution trailer in central Pennsylvania. State police are investigating the theft, which comes after bird flu outbreaks cut egg supply, causing a massive rise in prices. That's your Bloomberg brief. John?
Yahara, thank you. Yahara, thanks for this morning. What do you make of that story?
I think that eggs are the new gold. I think that right now you're having a situation where you might have to pay $8 instead of eggs. You're getting egg beaters in your egg McMuffin, and I think that it's leading to a real security breach at a lot of these egg delivery sites.
I love how they said that they had to be, these organic eggs, so clearly they're available for John. Are you going to the black market potentially to find these?
The black market for organic eggs?
I imagine that's what this is. Where are they putting them?
They're going to sell them on Canal Street.
Maybe.
Alongside the Louis Vuitton handbags.
Can you imagine?
They're going to slip out a dozen of eggs.
Or you can maybe pay a premium for the fake Louis Vuitton and then get the eggs inside.
I still don't understand why they don't clear out Canal Street and all that mess and all those handbags.
Sounds personal.
It's part of the tourist attraction.
It's a tourist attraction.
Yeah, you go to New York.
Such a mess down there. Just clear it out.
Oh,
I don't understand it. What I also don't understand about that, just to go on a bit of a tangent
Please, carry on.
What I don't understand is that just around the corner in Soho, you've got the legit thing, and they're paying through the nose when it comes to the rent for those buildings. Like, imagine how much that costs to rent those buildings in Soho and have a presence there, and then round the corner on Canal Street, they're selling fake handbags.
You think that
that
they're
just
hold on a
doesn't
second?
make
You think
sense
that
to
they're
me.
cannibalizing on Canal Street from the Soho stores?
I don't think it's good for the brand that there's a lot of fakes going around New York City. Let's put it that way.
Cool idea of loud fashion.
All right.
Cool idea. Okay.
Just, let's put it that way. Anyway, up next on the programme, we'll set you up for the day ahead. You're watching Bloomberg Surveillance.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The opening bell, a little more than 38 minutes away. Equity futures on the S&P 500 positive by 0.2%. On the Nasdaq 100, just about unchanged. With some morning movers going into the cash open, let's cross over to Manus Cranny. Hey, Manus.
Jonathan, good morning. Honeywell splitting itself in three: automation, aerospace, materials. Elliott got what they wanted, but on the guidance for the numbers this year, it's a miss on earnings per share, sales, and free cash flow. Roll it over. Have a look at Ford. You just profit drop, that's what they're expecting, and Jim Farley warns billions and billions of dollars will be lost if we go for full tariffs. He's asking for a reasonable negotiation. Roll it over, have a look at Roblox. Here you've got daily active users coming in at 85.3 million, a lot less than the market had expected at 88.39, but hours engaged, 73.5 billion on this. There you go, down 19%. That's a shock sticker.
Manus Cranny, thank you. Let's start getting hammered. Going into the opening bell. Manus, appreciate it. Let's get to some events you need to look for through the rest of today. At 1 p.m. Eastern Time, don't miss this. Bloomberg sitting down with the Treasury Secretary, Scott Bessent. We'll take that on Bloomberg TV and on Bloomberg Radio. Plus, Amazon results coming after the closing bell on Friday, the main event. The payrolls report is just around the corner, and we'll get some Fed speak as well. We'll hear from Bowman and Kugler. Looking ahead to next week, get some McDonald's earnings, Coca-Cola as well. So look out for those two names. And then the big data point next week. Once we get through payrolls, we'll be talking about CPI.
And maybe CPI won't be a random number generator. I want to say that what I'm watching very much are some of the projections by some of these companies, in particular the likes of Coca-Cola and Pepsi, about a strong dollar. And then with respect to Amazon, and I keep harping on this, efficiencies. And the reason why is because they have a lot of spending to justify, and suddenly they can talk about the application in reducing some of the headcount. We're going to hear about that more.
And the markets are looking at all this uncertainty when it comes to policy. So are corporates. We talked about Amazon and e-commerce. Ford yesterday, their guidance, they're not putting into consideration some of these tariffs that might hit their bottom line and might make their supply chains incredibly more challenging.
What's your question for Secretary Besson a little bit later this afternoon? What are you thinking about?
What's the level of 10-year Treasury that really is the check on some of these policies? And the other question is, does he still plan to term out some of the debt and longer duration bonds? Why did that not come in yesterday's refunding announcement?
That would be mine as well. The complaints that we heard about the average maturity under Treasury Secretary Janet Yellen, the issuance at the front end of the curve, the accusation of activist Treasury issuance that came from the likes of Stephen Moran, who's now part of the administration. Look, it's early days, so I don't want to draw conclusions about the last 24 hours and say that they won't be terming out the debt. I don't know the answer to that, but I would like to know just a little bit more detail. Like you, what would it take to term out that debt? How are you thinking about things? Now you're in power, is this beneficial to you to keep things as they were under Treasury Secretary Janet Yellen?
And part and parcel of that is the danger zone for the 10-year Treasury yield. If you're watching that, when does it become a red flag saying, don't touch that dial?
It's worth repeating, it's only week 3. So it's too early to draw any conclusions about any of these things. It's only week 3.
That's right. It is only week 3, but months before Trump got elected, Scott Bessent was on this program really throwing daggers at Treasury Secretary Yellen. So it felt that he would go in and want to ameliorate this situation that he said is completely unfair and that they were manipulating the bond market. Well, it's a lot harder, right, when you have the office and the seat to do that.
He's only just getting a full team in place, right? Before we figure all this out, we also need to figure out how much additional issuance there might be coming down the line further out once they get this tax package passed.
For now, he can punt by saying, it's only week 3, guys. Stop drawing conclusions. So he probably won't answer that. But these are legitimate questions to raise at a time where this was one of the potential headwinds to Treasuries long term.
So we check out your bond market.
Please, I think that would be
Yields are up at the front end by 2 basis points on a 2-year. The 2-year right now, 4.20. On a 10-year, we're just about changed at 4.42. Tomorrow, and it's all about tomorrow, it's about the random number generator. An exercise in predicting noise. The payrolls report is just around the corner. The estimate in our survey here at Bloomberg is 170, the previous number 256. Coming up tomorrow, we'll catch up with Sarah House of Wells Fargo, Priya Misra of JP Morgan, Ellen Zentner of Morgan Stanley, and Jeff Rosenberg of BlackRock. Those 4 and a whole lot more. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes, I don't know why, but for some reason, I love thinking about black swans, and at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, you can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. Nobody does that. They say, let's talk about the team.
And so many more.
Do you need a clap?
No, I never heard of it. Go.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
All right, futures trying to push higher right now despite some disappointment on the earnings front. 30 minutes until the start of trading. I'm Katie Greifeld.
And I'm Bonnie Quinn. Matt Miller and Sonali Basak are off. Bloomberg Open Interest starts right now.
Coming up, disappointing outlooks from industry heavyweights. Ford sees a sharp drop in profit as Qualcomm faces slowing smartphone growth. Meanwhile, Honeywell announcing it's splitting into 3 independent companies, following pressure, of course, from activist investor Elliott. And its yields, not the Fed. Treasury Secretary Scott Bessent says that the administration's focus is on that 10-year Treasury rate. Bessent joins Bloomberg today at 1 p.m. Eastern. All of that and more coming up. But let's take a look at where these markets are trading. We actually saw a bit of a rally into the close yesterday, and you can see that we're trying to maintain that momentum right now, even though, as we mentioned, some disappointment when it comes to Ford, when it comes to Qualcomm. But nevertheless, you can see the S&P 500 currently higher by about 0.3% if you round up. The NASDAQ 100 a little bit less than that, but still green. And then you take a look at the 10-year Treasury yield. It's pretty much unchanged right now, but at a relatively low level relative to where we've been over the past few weeks at least. The 10-year Treasury currently trading at 4.42%. And Bonnie, apparently this is what we should be watching because this is what Trump and Bessent are watching.
And there was a 10 basis point move yesterday, so you know the market is watching everything Bessent has to say as well. He's on Bloomberg TV, by the way, at 1 p.m. Eastern. We'll speak more about that, but let's get into some of the details of some of these stocks that are moving pre-market. Qualcomm down 5.3%. It sees the smartphone market relatively flat this year, as we've been saying, weighing on its forecast and raising concerns around sales growth. Ford out with a warning that profit may fall by $2 billion or more this year, citing lower car prices, also costly newer models, and also the threat of tariffs, of course. And then Tapestry shares, they are popping after it raised its guidance for the year, thanks to stronger than expected sales for Coach. So one great news story this morning, at least, Katie.
Yeah, there is some green on the screen, at least when it comes to Tapestry. I want to go back to the bond market, which we don't usually do at 9 a.m., but those comments from Scott Bessent yesterday on Fox Business, he'll be joining Bloomberg TV later today, really interesting when it comes to the focus on the 10-year Treasury yield. It's not the pressure on the Fed that they're piling on right now. It's this 10-year Treasury yield, which is a hard beast to tame, Vonnie. You take a look at just what we've seen since the Fed actually cut rates by 50 basis points in September. We've gone straight up, give or take. And you have to wonder, I mean, beyond watching Is there anything that they can possibly do? It doesn't feel like it.
I mean, if you look into the details of what he's saying a little bit, he talks about expanding energy supply, bringing the cost of heating oil and diesel down, thereby impacting somehow the deficit. But it's a very, very difficult thing to do. John Authors of Bloomberg Opinion pointing out today that Alan Greenspan tried to do this in the years before the great financial crisis and didn't get anywhere with it. Now, he wanted yields to go up, not down. But again, didn't go anywhere. And you can buy industrial quantities of bonds, right, to try and impact the yield curve, but really that's quantitative easing. Do we really want to go back there?
Yeah, and that of course requires a discussion with Jerome Powell as well. So interesting to sort of thread the needle there. Let's try to do that with Ritholtz Wealth Chief Market Strategist Callie Cox. And Callie, I'm curious to hear your opinion, your thoughts on what we heard from Treasury Secretary Scott Bessent last night, because it feels like you could build a case that this administration cares much more about the bond market than they do about the stock market, which is what we saw in the first administration.
We know President Trump cares a lot about the stock market too, but I think the bond market is the point to watch right now for investors, even for the everyday investors who think that interest rates may not matter to them because it affects how we all think about money. But the 10-year yield is a complex beast. And look, Scott Bessent came out with a QRA. He basically said status quo for supply and issuance for the next few months, which is great. Status quo is something that markets crave these days. It's certainty in a world of uncertainty. But at the same time, the 10-year yield has been whipped around by all these unusual forces. Worries about the deficit, worries about inflation and where that's going, worries about Fed and fiscal policy. So it might be harder to tame than Bessent is leading on. And, bond investors might have more agency than they think they do here.
Well, and just to tease that out a little further, Callie, the more you temper and tamper with the 10-year yield, the more that starts to impact stocks, right? Via corporate debt and so forth.
Yeah, exactly. I mean, I think people forget too that, again, going back to interest rates affect how we all think about money. This is a big deal for corporate America, and it's a big deal for the housing market as well. Mortgage rates are based off of the 10-year and longer term rates. And, a lot of corporates do borrow further out down the curve. I'm a little worried about that because, we have the Fed keeping the short end of the curve up. And now the long end of the curve is, increasing and showing that it could have a higher base. That combined with all the policy uncertainty we're struggling with these days could mean that it's a rougher environment than most expect for corporate America this year.
Yeah, absolutely. Those fears, you've seen them on and off in the stock market. So let's talk a little bit more about that relationship. When it comes to the long end of the Treasury curve, every now and again, every time we get meaningfully above 4.5%, it feels like those jitters come out. How do you see that dynamic evolving?
Yeah, there's something about 4.5%, and I'm not a technical analyst. Maybe it's just a round number thing. But whenever we cross that threshold, it seems like the stock market is a little more attached to the 10-year yield and where it's going. I think the base for the 10-year is much higher than it was 6 months ago. I think it's because the economy is stronger, and the risks for inflation are higher inflation are still a little bit higher as well. But I'm not so sure that 4.5 is where the 10-year yield evens out here. It's so hard to tell, Katie, because a lot of this pricing has to do with that uncertainty around policy, uncertainty around the deficit, really things that sit, a ball that sits in the administration's court. So, I don't envy somebody solely focused on the bond market right now, but I think at the moment it might be more important to focus on the 10-year yield as this generator of yield than this economic hedge that many investors use it for.
Just a moment, Callie, if you would, on this market. Jim Tanos yesterday said something very pithy to Bloomberg. He said, bull markets place a premium on promises. Is this a market trading on promises?
I think in some parts it is, and I would never go as far as Tanos here. I would never invoke the B word. I don't think we're in a bubble at the moment, but tech is trading on high expectations. It's trading on this AI story that we've learned in recent weeks, could be evolving a lot quicker than some think. So, we still like value here. We still like looking at stocks that trade closer to their earnings. We think cheaper cyclical sectors could be interesting in this moment. But on the whole, I think it makes sense to get your portfolio back in balance, especially if you're one of those investors who has benefited from a pretty stunning tech run over the past few years.
Callie, we have more than 50% of the S&P now reported, and really we've done well. Howard Silverblatt pointing out that we have almost 80% of companies beating estimates. What do you foresee for the other half of the S&P?
Well, we're in the middle of earnings season from a count perspective, but much of the S&P's market cap has reported. So in some ways, we're in the later innings of the earnings season, Vani. I like the beat rate. Of course, you want to see 80% of companies beating their earnings expectations. That's much higher than the 5-year average of around 70%. But this has been the story of corporate America the past few quarters. Wall Street almost underestimates them every single quarter, and they come out with stronger earnings than everybody expects. That doesn't mean it's smooth sailing, though. I mean, of course, we saw some mixed results out of big tech, and that was obviously a stumbling block for the market. I'm listening to, again, CapEx concerns, mentions of tariffs, and, setting the bar as we move into later in the year, because Wall Street has raised the bar for the coming quarters.
All right, Callie, always wonderful to speak with you. Thank you so much. That is Callie Hawkes of Rittles Wealth Management. Honeywell will split into 3 publicly traded companies, separating its aerospace division from its automation business and proceeding with the spin-off of its advanced materials arm. Its earnings forecast missed estimates this morning, sending the stock lower. Let's discuss now this big change for Honeywell with Bloomberg's Brooke Sutherland, who covers industrials. So, Brooke, is this simple enough now? It's broken into 3. Bloomberg Intelligence suggesting that it could be broken up even further were management to go further.
I think that's the big question, because if you look at what's going to remain in the automation business, yes, there is a very sizable, what we think of traditionally as automation, but there's also building controls, there's warehouse robotics, there's fuel processing technologies. And what we've seen with other conglomerates that have done these big breakups is it usually takes a couple of them to get to the final simplified structure that these companies end up settling on. We've seen that with Danaher, we've seen that with GE, we saw that with Trane Technologies, with Fortive, which was itself a Danaher spinoff. And so I think that's just going to be the question of, do you have a coherent enough narrative for this business that's going to remain that it's attractive to investors? But on the other hand, the aerospace part of Honeywell will be a lot more focused. We've seen, really great performance in a lot of pure play aerospace stocks, GE being one of those that did its own big breakup. And so I think this is something that investors are going to be excited about, to be able to own that Honeywell aerospace business by itself.
Well, when you think about spinoffs in general, they've been so popular in the stock market. You think about General Electric, for example, that was well received. You take a look at Bloomberg's index of spinoffs over the past 5 years or so. We're right near record highs, even though it's been a pretty rocky market, Brooke. I mean, talk a little bit more about how investors are receiving this news.
Sure. I mean, I think what we've seen over time is that you have to have a really good reason for having a diversified business model. And I think, companies have to sort of constantly be proving why their various pieces fit together. And in the case of Honeywell, I think they have very good businesses, but what happened is they were often trying to tell too many stories at the same time. And you had sort of, a downshift in one business at a time when another was performing well. And that's what you see with a lot of these conglomerates, is it's just too much going on at one time. What I will say, though, is that, for all sort of the last rights pronounced over conglomerates, there are still quite a lot of very diversified business models. If you look at Amazon, they have an e-commerce platform, they sell groceries, they have cloud services. You look at Microsoft, they have LinkedIn, they have also cloud services, they have Xbox video games. I mean, and, these examples really do persist. And so I don't think the model is entirely dead. It's more a question of, how can you make it work in a way that, doesn't turn off investors ultimately?
It's a great point. We're not entirely past the age of conglomerates. Brooke, always great to speak with you. That is Bloomberg's Brooke Sutherland. Meanwhile, some other movers we're keeping an eye on, and let's talk about Peloton. Cost cuts have bolstered profit more than anticipated, revenue continuing to shrink, but even still the stock up 18% right now. Definitely needed some good news. Take a look at Roblox, though. Roblox daily active users missed expectations. It also lowered its 2025 booking forecast, shares down almost 18%. And Under Armour, it raised its annual profit guidance in a promising move for its turnaround strategy, shares up about 5%. Meanwhile, coming up, Eli Lilly sees growth from its Mounjaro and Zepbound diabetes drugs. Details on the latest earnings and the outlook next. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
AI, how it has penetrated pretty much all sectors, including music. AI can write music, compose music. How do you see AI changing the landscape in fashion?
Yeah, AI definitely helped. When I did the jewelry, I used the AI, helping me to give some idea, but ultimately you still have to do a lot with it. To just give you very superficial ideas, but at the end you still have to customize and how to really make it and do that. I do not think that AI and the technology can replace the human mind at this moment.
Yeah. Are you concerned one day we won't be able to differentiate designs by AI and designs by an actual designer?
I don't know. For me, I see that, when a designer doing, it's the spirit, it's the heart that the computer don't have.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Now to high interest to look at what's making headlines around the world. Aides to President Trump are trying to tone down his idea of taking over Gaza after he suggested the U.S. would, quote, own the war-ravaged territory. Trump's proposal was made at a news conference alongside Israeli Prime Minister Benjamin Netanyahu. The idea was welcomed in Israel, though widely condemned elsewhere in the Middle East and among Washington's top European allies. U.S. Treasury Secretary Scott Bessent says the Trump administration's focus on bringing down borrowing costs is on 10-year Treasury yields rather than on the Fed's benchmark short-term interest rate. Bessent also repeated his view that expanding energy supply will help lower inflation. Bloomberg's Saleha Mohsen will have an interview with Secretary Bessent today at 1 p.m. Eastern. Around 40,000 federal employees have taken up the U.S. government's buyout offer. That's about 2% of the federal workforce. The White House earlier estimated that between 5 and 10% of the federal workforce could take the offer.
All right, switching gears here, let's go back to earnings season because Eli Lilly out with earnings today that were mostly in line with estimates. The drug maker is working to fix inventory problems with its new blockbuster obesity drug that weighed on sales in recent quarters. Bloomberg's Madison Muller covers Lilly and joins us now. Madison, great to see you. So for better or worse, it feels like when it comes to the GLP-1 market, there's this duopoly. You have Eli Lilly and you have Novo Nordisk, both of which have reported in the last couple days. How did they two shape up against each other?
Yeah, so I think that there was some concern given the last two consecutive misses from Lilly's obesity drugs that maybe something was going on with demand. Like, is this market that seems insatiable, is it actually slowing down? And so there was definitely some concern, I think, going into both companies reporting this quarter. And Novo is looking pretty good. I think that relieved some of those concerns. Lilly is also saying that, a lot of this, the last two misses have had to do with inventory problems. And they're still forecasting I think it's like up to 35% revenue growth for 2025, which is huge. So that's like at least $12 billion in added revenue this year. So clearly there isn't a demand problem. And what Lilly's explanation, at least, is of what's happening is that there's some inventory problems in the channel of wholesalers and pharmacies. Basically, at the end of the year, they typically see a ramp up in wholesalers having more stock on hand, and they just didn't see that for whatever reason this quarter or the last two quarters. And so they're not going to try to forecast seasonality going forward and just really look more at the demand dynamics.
Madison, what comments are we hearing from management about the potential confirmation, which looks very likely now, of RFK Jr. as HHS Secretary?
Yeah, so I was just talking to Lilly's CFO about that earlier this morning, and they said that their agenda isn't really changing. I mean, for one, a huge thing for drug makers has been the Inflation Reduction Act, and so that's something that when we were at JP Morgan last month, Eli Lilly's CEO said that Lilly and other drug makers are looking to try to revise some of the provisions of the IRA this year. They're asking the Trump administration to pause those negotiations going forward so that they can revise some of these policies, one of them being what they call the pill penalty, which allows pills to be negotiated for lower drug prices sooner than biologic drugs. So that's something they're really focused on. They're going to continue focusing on that with the Trump administration. And when it comes to RFK, again, they say, you know, they do have more common ground, I guess, than differences, because RFK does have this focus on chronic disease, and obesity is a chronic disease. So they're trying to make it work there. I think it was a couple months ago, Eli Lilly's CEO was at Mar-a-Lago with Trump, and even before inauguration. So these conversations, they've gotten the ball rolling, and I think that they're getting their agenda out there to the Trump administration.
Yeah, it's going to be really interesting to see how those relationships develop and evolve here. I am curious, though, talk about the pipeline when it comes to Eli Lilly, when it comes to Novo Nordisk. It feels like both of them are trying to basically develop and get out their next generation obesity drugs. What does that timeline and story look like?
Yeah, so both of them are taking slightly different approaches. I think in the near term, at least, Lilly's biggest thing, and from what I've heard from a lot of the conversations at JP Morgan, people were saying the biggest pharma readout this year is going to be Lilly's oral weight loss drug. So that's expected around mid-year, and Lilly is really far ahead of everyone else with developing a pill that is, potentially easier for people to take who don't want to have an injection. And so that's something people are really looking for this year. That's going to be pretty important. Novo is focusing more on next generation shots. They do have an obesity pill as well, but because they've had such a struggle with supply problems, they really haven't had enough supply to actually make these pills, because it uses the same ingredient as Wegovy and Ozempic. So they've been focused on this next generation drug, CagriSema, which was a little bit disappointing to investors at the end of last year, but we'll see what happens with that.
Madison, thank you so much. That is Bloomberg's Madison Muller joining us there. We're also, by the way, speaking about Bristol Myers Squibb ahead of the opening bell, down about 3.5% now. 2025 sales and profit forecasts were below Wall Street expectations. Declining sales of older drugs will likely slow the company's return to growth. It plans to eliminate $2 billion of spending by the end of 2027, and that's on top of the $1.5 billion already planned through the end of this year. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Whatever this number looks like, we will build a massive narrative and extrapolate it out 12 months.
Yeah, and then we'll remind ourselves that these are very noisy numbers.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
How tight can the labor market get if we do see these deportations?
Companies are waiting to figure out what the policies are.
And lots to think about.
The January Jobs Report, Friday on Bloomberg.
All right, welcome back to Open Interest. You're taking a look at futures right now. With minutes to go until the opening bells ring, you can see the S&P 500 up about 0.3%. The NASDAQ 100, it's in the green, but just so, barely a 0.1% higher. The small caps making a run for it. The Russell 2000 currently up about 0.4%. Of course, maybe that focus that Scott Bessent and Donald Trump have on the long end, maybe giving a little bit of relief to the small caps. Of course, they would certainly like to see lower rates, and it seems like the administration would like to see that as well. I was just taking a look at the year-to-date figures, Vonnie, and it's interesting because you take a look at the NASDAQ 100, the S&P 500, both up about 3% year-to-date, which is pretty good, especially relative to all the volatility we've had. The small caps actually outperforming, up 3.9% on a total return basis, which was definitely surprising when you think about all the volatility that we've seen in the smaller caps.
Yeah, and we are holding up, as you say, Katie. Even this week, it's been 2 up days and 1 down day. Bloomberg Intelligence has this market pulse index. I don't know if you've been watching it, but now it's suggesting that sentiment is manic. Yeah. And that is actually a little bit concerning because when that happens, it's a warning sign of a vulnerable market. So just putting that caveat in there.
Yeah, yeah. Manic, not a word you love to hear applied to pretty much anything, but we'll see. We definitely have a manic day of earnings after the bell. It feels like this week has been just so heavy, and Amazon hits the stage later today. The sentiment around big tech has been really mixed, it feels like, especially you think about Alphabet, that disappointment we saw earlier in the week. We'll see what Amazon delivers, currently up about 1% pre-market. We have to wait and wait for NVIDIA, but it'll definitely be good to get the pulse on what we're seeing over at Amazon.
A couple of weeks' time, exactly. But it does feel like the Magnificent Seven have sort of split, right? There was some magnificence about them and some not so magnificent of the 7 so far that I've reported. But as you say, Amazon reporting later today. We're expecting results around 5 p.m. Eastern, I guess. And the stock is up about 7% this year, so not too shabby.
Not too shabby, but great point. There is a lot of dispersion in the Magnificent Seven, so you have to be selective. But coming up, we have less than 4 minutes to go until the opening bell. We'll discuss with Van Rion's Shayna Sissel up next. This is Bloomberg.
been offers before to take over Greyhound, but then in the middle of the pandemic, 2.5 years ago, we had this fantastic opportunity to buy the brand and the network. When we took on Greyhound onto the Flix tech platform for network management, revenue management, we saw the highest unit economics in more than 100 years of Greyhound history.
My vision is to transform long-distance bus travel in the United States and make it one of the top considerations for anyone planning a long-haul journey.
CEO Kai Boyson imagines even more potential if state and local governments recognize the need to support long-distance bus travel with integrated infrastructure.
We need to think about the infrastructure in the United States holistically and think about the transportation system as one integrated system. And intercity bus needs to be an integral part of that system. One should be able to connect from one mode of transport to another seamlessly, easily. We have great success models in the United States. For example, Los Angeles Union Station, Boston South Station, or New York Port Authority Bus Terminal, or Washington, D.C. Union Stations.
Kai and the team, they are doing a fantastic job. They have really improved the product, they have improved technology, they have really made the production more efficient, that at the moment it's also a profitably growing business.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
All right, we are moments away from the start of trading on this Thursday session. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. You think about how we ended up yesterday. Of course, that little bit of a lift coming into the close kind of got upset in the after-hour session when we got those earnings from Ford, from Qualcomm. But even still, you can see the futures market right now trying to hold on to this little bit of momentum that we're building right now as we really kick off the trading day. You can see that the bells are ringing over at the NASDAQ, over at the New York Stock Exchange. We're almost to Friday, we're almost to jobs day, but let's take a look at how trading is shaping up. Just in the first few seconds after those opening bells have started to ring, the S&P 500 higher by about 0.2%. The NASDAQ 100 right now, it's green, but just barely. But the small caps is what I'm really interested in because the Russell 2000 currently higher by about 0.5%. This is your year-to-date outperformer. I think that stat would surprise many people, especially when you think about the volatility that we've seen at the long end. But even still, keep your eye on the Russell 2000. Let's look under the hood here, though, because we are in the heart of earnings season. And we'll start with Eli Lilly reporting a 2025 outlook that was mostly in line with estimates as it sees growth with Zepbound and also Mounjaro. Bristol Myers also adding another $2 billion to its cost-cutting plans through 2027. Its forecast missed expectations, and then we'll finish up with Honeywell. I got all the decliners here. It's splitting its aerospace, automation, and advanced materials businesses. That follows pressure from activist investor Elliott, which says that the split will boost shareholder value, but shares down a little bit right now, Bonnie.
Not quite all the decliners. Yeah, I have a couple as well, Katie, including Ford. Ford out with a warning that profit may fall by $2 billion or more this year, citing lower car prices and costly new models. Also, of course, the threat of potential tariffs and a slowdown in demand as well for electric vehicles. More on all of that in a moment. But let's also take a look at Qualcomm, because it also is lower today by 5.3% right now amid investor concerns around smartphone demand. The company sees the overall smartphone market flat in 2025. This as it slowly loses Apple as a customer, as Apple develops its own modern chips for the iPhone. So let's take a closer look now at Qualcomm, as well as a look ahead to Amazon earnings after the bell. Bloomberg Technology's Caroline Hyde joins us now. Caroline, explain to me why investors are punishing Qualcomm so much again, because it's another case where we saw revenue rise by 17%, which is not bad, and yet we see this market reaction.
And the overall forecast, Bonnie, is strong. It's just the forecast on smartphone growth is once again just building that anxiety among investors that are worried that we're going to have this continued flatlining of smartphones. Look, it's important about Apple and the fact that they're slowly slowly been moving away onto their own chips. But remember, Qualcomm basically makes money on the IP that are used by any single phone out there, whether you're using a Qualcomm chip or not, you are using their IP. So the royalties keep swimming, and they've managed to do very well at moving into smartphones that Samsung makes, particularly higher end ones, and they make nice royalties off that. But there is just this nervousness. These stocks have risen. These companies are really trying to live up to the hype cycle around the diversification, movement into autos, the movement into AI a little bit more when it comes to the PC element of Qualcomm there. And we saw it synonymous really with ARM, which is of course a chip designer. And it's in a lot of litigation versus Qualcomm as well, I might add. But ARM too really beat in terms of their earnings. They're pointing though towards just a curtailment of the exuberance. We're going to see growth, but maybe just not the growth that many wanted to see when the valuations of these companies are so high.
Yeah, the jitterness, it really just feels like these stocks are being punished if there's even something to
fly in the ointment.
Exactly. Let's talk about Amazon. Amazon, of course, coming up after the bell. You think about specifically in cloud, what we heard from Alphabet, what we heard from Microsoft.
Yeah.
Not too rosy.
It's not. And AWS is the all-important operating profit generator for Amazon. Amazon is the #1 player when it comes to the provision of the cloud. And they need to keep showing that they can live up to the CapEx that we're expecting to be at least about 70 billion once again. And is that driving return on AI investment? Are we seeing a return on investment when it comes to cloud growth? Now, we're anticipating cloud growth to be strong, but we want to know how strong for Amazon overall. Is it going to be living up to about a 17% growth rate? Are we going to, remember, they're not seeing the explosive growth rates of a Google or a Microsoft that have been in the 30% realm because Amazon's been doing this for so long. But still, this is going to be the juggernaut that also we question, how is the retail sector? It's interesting that many are saying that Amazon's revenue is actually going to eclipse that of Walmart for the first time. So we go back to the fact that this is an e-commerce giant, and they're going to be affected by Temu and Shein not being able to come in quite so cheaply anymore. The de minimis that's going to be axed by the Trump administration, well, suddenly that's going to be having to be soaked up by the price points of these cheaper Chinese goods. Amazon does have third-party sellers that are Chinese goods, but it's much smaller, and overall they could win out by being able to get us access to the goods we like, but perhaps not at a higher price point. So Amazon likely to be delivering strength, but we need to see how the cloud does.
Yeah, absolutely. And great point there on the e-commerce business. Surpassing Walmart, that would definitely be a sign of the times. Caroline Hyde of Bloomberg Technology. You can catch her at 11 a.m. Eastern, but don't go anywhere because joining us now, I'm pleased to say we have Banrion Capital founder and president and CEO Shana Sissel joining us now. Shana, great to speak with you again. Let's start with earnings season. Of course, we've gotten a ton of names reporting this week, and it feels like we've seen definite pockets of disappointment when it comes to big tech, when it comes to maybe some more of these industrial names. What is your read-through so far?
Exactly that. Big tech has been largely disappointing. I think I sent over some notes earlier, and I said that I think this is going to provide investors an interesting entry point to build a position in names that had been largely overvalued, trading at premiums after their earnings reports. Because long term, I think many of these companies actually have very positive long-term trends. This short-term dislocation, I think, is a result of a number of things. Some concerns about the CapEx spend as it relates to AI and how that's monetized. Some concerns about how other companies and other industries are using their CapEx spend. Concerns about things that are going on overseas, particularly as it relates to tariffs, China, things of that nature. All those things are putting pressure on these names. They're putting pressure on the companies, and the companies, well, if you look at their earnings, they're actually not doing poorly per se. They're just not living up to the super high expectations that we've had for them over the last few years.
It seems like investors have been waiting for management to reassure them about DeepSeek, Shana. And I'm curious, because I know you're an investor in NVIDIA, and do you think that it will be when NVIDIA comes and tells us that, you know, DeepSeek is not a threat, that that's when all of these AI-related stocks will rally once more?
I think it'd be hard for NVIDIA when they report earnings, or any of the tech companies when they report earnings, to say that, because I don't know that they have enough information to make that comment right now. I think there's the way that news came out caught everybody by surprise, including those companies. And so subsequently, I think that they still need to do more research, and it would it would not be in their best interest to make comments related to something they don't understand fully yet, which is why I think you're seeing these sell-offs. Now, personally, I don't think that we should be as concerned about DeepSeek. Every day, more information comes out that makes me more and more confident that it's not the threat that people initially thought it was. Specifically, if you read the actual paper related to DeepSeek, there's a whole bunch of commentary in there that talks about the cost and how the $6 million is not actually reflective of some of the research costs that went into it, so on and so forth. Beyond that, the news that came out, I think yesterday, about the Canadian security company diving into DeepSeek chatbot and connecting it to the CCP. So there's a number of things that I think we need to take a step back, but I don't know that we're going to hear from NVIDIA or any of the tech companies in their earnings reports any real significant commentary on DeepSeek until they fully understand what the threat is.
Well, Shayna, I want to switch gears here because we're up against the clock, and I want to talk about sneakers because I'm taking a look at your February stock ideas. I see Nike on the list. Nike, obviously a very interesting story right now, and it's down about 25% over the past year. They've had some management shakeups. What is the catalyst that you see coming for Nike?
Well, Nike's becoming cool again. And I think that is something worth noting. I have a 9, soon to be 10-year-old son. He is all Nike all day, every day. And his friends are more and more wearing Nike. You have some celebrity endorsements. The anniversary of the Jordan shoe and the way that they've handled the marketing on that. I love, if you watch on social media, you'll see that the CEO has been handing out tickets to anyone related to wearing the Jordan shoes. And in Chicago, of course, they're celebrating that with, I believe there's blocks on the Jordan statue at the United Center. But they're finding a way to make their brand relevant again. They're going harder into the athlete market. That's always been the thing that's made them cool. The stock is beaten up, and I'm not saying that it rebounds tomorrow, but I think the new CEO is making the right decisions and the right steps to bring Nike back to being cool again. And it hasn't been out of favor that long, and the kids are really the key to brands that like Nike. And if you think about it, the reason they kind of lost ground is because another brand became cool. But I don't think that that's something that's insurmountable that they won't be able to overcome. Stock is cheap. It is beaten up. It's largely out of favor. I love names like that.
By the way, share of it then while you're at it as well. Shayna, thank you so much for joining us today. That's Van Riehen's Shayna Sissel. Coming up, Ford shares plunging after the company warned of a $2 billion profit drop. We take a look under the hood next. This is Bloomberg.
In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like Trump to change in terms of what some people see as the over-regulation of banking in America?
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of deregulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive internationally through a more benign environment.
Nobody covers Davos like Bloomberg. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Evercore ISI downgrading Match to neutral in the wake of disappointing earnings. The analyst says that he's less convinced there's a path for recovery. Next up, DZ Bank is cutting Alphabet to a hold. The tech giant reported earnings and sales that missed estimates earlier this week. And finally, we have Voya Financial is getting a downgrade to neutral over at Barclays. The firm cites weaker earnings power and risks to next year's outlook.
And Katie, another stock we're looking at this morning is Ford. It's falling after the company warned of a potential $2 billion profit drop. The auto giant saying lower vehicle prices and costly new model launches are partly to blame. Bloomberg auto reporter Keith Norton joins us now from Detroit. Keith, how did this come as such a surprise that the number was so large? I mean, many of these issues have been brewing.
Yeah, they have. But Vonnie, what happened here is this first quarter profit being wiped out by new model launches really took the street by surprise. Ford is launching a new Lincoln Navigator and Ford Expedition, their big SUVs. They're built in the same plant as the Super Duty pickup truck, which is their most profitable model. So that plant is down for this changeover, and that's why they're going to break even in the first quarter. That really takes a big hit to overall earnings. They say they'll be stronger in the second half.
Well, it's hard to talk about Ford and automakers without talking about tariffs. And CEO Jim Farley actually joined us on BTV last night. Let's take a listen to what he had to say on the topic.
I think longer term is the bigger concern. These kind of tariffs, especially in these two countries, are very significant. And if they persist beyond months, you know, we could see billions and billions of dollars of pressure on the industry, lost jobs, lots of impacts to communities and our ecosystem in the industry. And that's what we're talking to the administration about and congressional leaders.
And Keith, it just seems like sort of an impossible situation because if you're Ford, if you're GM, and you're watching the will he, won't he on tariffs, whether or not it's a negotiating tactic by the administration, you still have to try to run a business around that possibility.
Right, and it's very hard to manage around that uncertainty. Jim Farley made another interesting point, and that's if you tariff Mexico and Canada, you allow Ford's European and Asian competitors to import their vehicles without tariffs. And he said that would lead to a bonanza for their foreign rivals because they wouldn't have that 25% levy on their cars coming into the country.
Is there a possibility that car prices, though, will actually go up, Keith, for some of the reasons just mentioned, and that might offset some of this $2 billion? Or will customers just not buy the cars if they do become that much more expensive?
Well, to raise prices to cover a 25% tariff would make the cars uncompetitive from a price standpoint. So they wouldn't really benefit like they did during, say, the pandemic with the supply shortages from the higher prices in that case, because volumes would definitely go down.
And Keith, I want to take a longer-term look at Ford, because you take a look at this stock, obviously falling out of bed this morning. It's had a really rough ride over the past year, over the past 5 years. It's still up about 14%, but relative to the rest of the market, obviously not doing too much there. Is it crazy to think that this could be an activist target, or how do you see that potentially playing out?
Yeah, it's always hard to think of Ford as an activist target because the Ford family still controls the company through a special class of stock that gives them 40% voting control. Bill Ford, the great-grandson of Henry Ford, is the chairman of the company. His daughter is on the board. His nephew is on the board. The family is still firmly in control of Ford, and as long as they have that stock, it's very hard for an activist investor to come in.
Keith, thank you so much for all of your insights. That is Bloomberg's Keith Naughton there in Detroit. Coming up, has PIMCO lost its edge when it comes to private credit? We'll discuss in today's Wall Street Beat. This is Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asia markets.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
All right, it's time now for the Wall Street Beat, and PIMCO's hesitant dive into private markets could leave the company at risk of falling behind. Bloomberg's Laura Benitez has the scoop. Of course, this is the subject of today's big take. And Laura, I have to admit, when I think of PIMCO, I don't necessarily think of alts. I still think of Bill Gross, even though, of course, it's been years and years since he left the company. How has PIMCO changed over the years since his departure?
I think many people still do think of him. He's a figure that's always looming large. His spirit lives on. But I think people generally feel like it's gone from having this one hawk-like figure to PIMCO now being governed by a smaller circle of leaders. But of course, the biggest divergence in the last 10 years has been PIMCO's desire to expand into alternatives, which, as we know, pays very high fees, and so many investors are flocking to that part of the market now. So there's a lot to capture, a lot of opportunity.
Yeah, Laura, give us a little bit more detail on how PIMCO's alts business has developed over the last few years.
Well, I mean, it's been handed a 90 billion mandate from Allianz back in 2020. So, its alternatives business is around 200 billion. Half of that is with real estate from Allianz. So it has been quite heavy in property. Obviously, property's had a lot of challenging moments over the last 2 to 3 years. So there's been a lot of working out there, some losses and some departures. But they have been very strong in places like distressed debt, where they have a presence in these big capital structures. They're in the steering committees of a lot of these deals if they go a little bit awry. And, there's some very, very sharp minds there, as we know.
Laura, give us a sense of the competitive landscape here, because it feels like every asset manager is trying to get its alts business up to speed. You think about PIMCO in comparison to BlackRock, for example, which has done a ton of acquisitions, it feels like, over the past couple of years to really come up to scale. How does PIMCO compare?
I think, managers have a few choices. One is to try and expand organically, which is very, very slow, and, it can be part of the longer game strategy. Another side is, you can try and acquire, which is what the likes of BlackRock have done. That can be very costly, and many firms don't want to risk diluting or changing their culture or structure internally. So there are challenges to both sides, but what's really key is attracting talent and keeping that talent at the minute, because there's a lot of competition for hiring in that market.
Yeah, exactly. So what does it do to retain that talent, given that there's obviously a little bit of a problem still? Before it was Bill Gross, now perhaps it's Dan Iveson and a few of a small coterie?
That's right. Yeah, I think, incentives are very key. I mean, you have the likes of KKR and Apollo, Dan's made some very, interesting incentives and opportunities. And I think, other managers have to step up to that and be mindful of that. And also just have a great, healthy, constructive culture and strategy going forward in terms of, being aligned on how you build out that alts business. But we've seen many partnerships start to crop up amongst the more traditional asset managers. So we've had KKR partner up with Capital Group. BlackRock, as you mentioned, have been expanding at breakneck speed. Big acquisition for HPS, that's still in the mist. So it'll be interesting to see how other managers try and move in and stay competitive.
Let's talk about fees here, though, because a line that caught my eye in your story is you talk about PIMCO's relative caution carries a risk here of it getting stuck as a lower margin bond shop. And underlying part of this gold rush into private assets is the fact that, of course, you can charge investors higher fees to get that exposure. So talk to us about, what that actually looks like when it comes to the end investor buying into a private credit sort of fund versus just a traditional public bond fund.
Exactly. So the majority of PIMCO's assets are with fixed income, and as you know, there's a race to the bottom in terms of fees. They're just getting lower. The likes of Vanguard and others are keeping everyone on their toes. Whereas obviously in the alternatives part of the market, you can charge some very, very attractive fees for doing more bespoke, interesting, complex, higher risk strategies. So I think that's something that everyone is, keeping in mind. And also for the traditional asset managers like PIMCO and Capital Group, it'll be keeping both sides happy, keeping your traditional investors happy, and also, looking at how you can kind of push into the higher fee part of the market. So there are some challenges, I think, for the bigger managers that have been around for a long time.
All right, Laura, great story, great reporting. Really appreciate your time this morning. That is Bloomberg's Laura Benitez. And Laura mentioned, of course, that race to the bottom in fees. And speaking of, I'll be in conversation with the CEO of Vanguard, Salim Ramji. That conversation coming up at 11:30 a.m. Eastern. Of course, Vanguard announcing its record fee cuts this week. So plenty to talk about there. But let's get a check on these markets right now. You can see the S&P 500 holding on to its gains, up about 0.2%. Big tech managing to find some momentum here. The NASDAQ 100 higher by about 0.2% as well. I was talking about that leadership in the small caps, faltering a little bit right now. You can see the Russell 2000 pretty much unchanged here, but that has been your year-to-date leader. A lot of that depends on the bond market, and the bond market, of course, is where all the eyes are right now, especially when it comes to the Trump administration and Scott Bessent, our newly installed Treasury Secretary. Bloomberg will speak to him at 1 p.m. Eastern. But coming up in the next hour on this show, we'll speak to Citi Wealth's Stephen Whiting. Then we'll speak to Cummins CEO Jennifer Rumsey on her company's promising growth. And then the CEO of LabCorp talks about how RFK Jr.'s potential confirmation may impact business. This is Bloomberg.
prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
This is CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. This is a big day for President Trump's efforts to downsize the U.S. government. About 2 million federal workers have until midnight to call it quits or face the prospect of getting fired. Correspondent Weijia Jiang is at the White House.
The administration expects about 200,000 federal workers to take that resignation offer. CBS News has learned that more than 40,000 employees already have, with the largest spike expected today.
Air traffic controllers are exempt from the administration's buyout offer. At this morning's national prayer breakfast at the Capitol, the president promised to work with Congress to adopt a new computerized air traffic control system after last week's deadly collision between a passenger plane and an Army helicopter.
I think what is going to happen is we're all going to sit down and do a great computerized system for our control towers. Brand new, not pieced together, obsolete.
Democratic lawmakers led an all-night protest session in the Senate over President Trump's nominee for budget director, California's Adam Schiff.
Russ Vogt believes in dismantling that government of the people, piece by piece, brick by brick, until what remains is a hollowed-out bureaucracy that serves the interests of the wealthy and abandons everyone else.
Vote helped construct a plan calling for drastic cuts to Medicare, Medicaid, and Social Security. Drivers are gripping the wheel extra tight. Dicey conditions from the Midwest to New England.
A sheet of ice in the metro Detroit area necessitated a lot of car scraping this morning.
I turned my defroster on, got out with my scraper, and it took me about 25 minutes.
Hundreds of salt trucks on major highways, I-75, I-94, but drivers supposed to be going 5 to 10 miles below the speed limit, but there were still some crazy drivers.
Well, of course, there are always crazy drivers. Nice days are cold, or bad days.
And the advice this morning, just slow it down.
I'm not in a hurry to get to work. Never have been.
Charlie Langton for CBS News, Detroit.
A new strain of bird flu has been detected in milk from dairy cows in Nevada. CBS's Jerika Duncan.
Detecting this second strain in cows means the virus has jumped from birds to cows for a second time.
Jimmy Butler's tumultuous time with the Miami Heat is over. They've traded their disgruntled NBA star to Golden State for 3 players, including Andrew Wiggins. CBS Sports Miami's Mike Cugno says the Heat have to be relieved.
2 months, 3 suspensions deep into this. It was ugly. He was leaving practices. He was not showing up for planes.
Dow down 1. This is CBS News.
Visit OptimaTaxRelief.com.
Australia will host some NFL games next year, and one will feature L.A. Reporter Scott Maiman.
The Rams already have a global marketing agreement in place, so we'll see L.A. playing in the city of Melbourne in 2026. The NFL in general is already popular in Australia. It's a huge money winner on broadcast TV, despite the time difference of when the upcoming Super Bowl goes to air. And it's a sport that's already popular in high school, so it's destined for success.
The Times of Israel says Israeli Prime Minister Benjamin Netanyahu gifted President Trump a golden pager when the two men met at the White House Tuesday. It was a nod to the attacks in Lebanon that killed more than 30 people and injured over 3,400 in September, when thousands of rigged pagers used by Hezbollah operatives exploded. Upon receiving the gift, report says Mr. Trump called it a great operation. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube as well, so head over to youtube.com, search Bloomberg Podcast Alive. Alex Steele is out today. Sitting in for Alex is the John Tucker. Good morning, John.
I always feel like I have to apologize when you introduce me.
we
nice to be
Alex.
here.
Yeah, we do miss
Alex will be back, so don't
She'll
worry.
be back. Yeah, no problem tomorrow. So we got a lot coming up here, John. A lot of news flow as usual. We got a lot of earnings we're trying to stay on top of. Coming up, we're going to talk to Dan Hansen, Bloomberg chief UK economist. The Bank of England cutting some rates again, and where do we go from here? Nancy Tengler, CEO and CIO of Laffer Tengler Investments. We'll get her market call as well. Gregory Corte, Bloomberg News, White House and political correspondent on the Musk buyout taken by 40,000 federal workers as a deadline nears. So a lot of news coming out of D.C., a lot of news coming out of corporate America, and we'll stay on top of it all. We've got mixed trading out there on the markets. Right now, let's go to Lisa Mateo and get a Bloomberg Business Flash.
And this Bloomberg Business Flash brought to you by IBKR. Will the percentage of U.S. experiencing drought conditions exceed 18% on 2/18/25? At IBKR forecast trader, the yes recently at 35%. What's your take? Trade your prediction at IBKR.com/forecast. All right, we've got a little movement in stocks this morning on a big earnings day. It includes Amazon. Speaking of which, Amazon shares up 0.2%, but it also is a run-up to the big jobs report tomorrow. Ahead of that report, we had initial jobless claims came in higher than expected, but still relatively low. 219,000 applications were filed last week. Continuing claims, those were higher too. We'll get to the NASDAQ, up 0.1%, 22 points. The Dow, little change, down about 13. The S&P 500 up 0.1% or for 8 points. The 2-year yield at 4.20%, up 1 basis point. The yield on the 10-year 4.43%, and that's up 1 basis point. To commodities, we have the Bloomberg Dollar Spot Index up 0.1%. Have to point out the British pound down 0.7%, 124.07 against the dollar. The BOE cut its interest rate 0.25 point to 4.5%. To earnings we go. We'll start with shares of video game platform Roblox down 16%. The kids love it, but I guess not as much because it reported fewer daily active users. Then we go to Peloton, riding high up 12%. First quarterly result under new management. It really showed profit beat expectations. And Ford, tapping the brakes, Ford down 6%, warned that profit may fall $2 billion or more this year. And finally, Honeywell, streamlining its portfolio. It'll split into 3 separate publicly traded companies. Its shares are down 4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash.
All right, Lisa Mateo, thank you so much. We appreciate it. John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio. We are streaming live on YouTube as well, so that's a good stuff. The Honeywell story, John, fascinates me because, I mean, you think about these conglomerate companies, whether it's General Electric, Honeywell, you know, it's just a series of making acquisitions and then breaking the company down and selling it off. It's an investment banker's dream.
The age of conglomerates, I mean, is that model dead and buried?
It has been, I think. And the General Electric
so what,
today,
Honeywell just didn't get the memo until the last minute?
Yeah, I think what they saw is the success of General Electric and its divestiture programming and streaming down to a couple of core businesses.
Do they have a Larry Culp at Honeywell?
No. So we'll see how this plays out. Maybe we'll check in with Karen Ubelhart. She's the BI analyst who's been covering these companies forever. We got some weather coming in to the region here today. I don't know if you had to deal with it today on your drive-in, John. It was.
I mean, I got in at 3:45-ish, and it was starting to come down south of Newark Airport on the New Jersey Turnpike.
Rob Carolan joins us, Bloomberg's a meteorologist. Rob, what do we have for the eastern seaboard today, tomorrow, and I hear there's something this weekend as well?
Well, you are correct about the weekend storm, Paul. Right now, we've got a system moving through where it's changed over to rain in New York City and the D.C. area, but some spots to the north and northwest of both the city and I-95 in the district in Baltimore still could be slippery. We've got some places where the temperatures are right around freezing, so the next couple of hours it should start to improve in both areas as the precipitation becomes a little lighter and the temperatures continue to rise up towards 40. The Boston area, they've got a good burst of snow moving through right now. It'll snow pretty hard in Boston the next hour to 3 hours, and then it should peter out this afternoon. It looks like Boston's going to pick up an inch or two. However, the suburbs to the north and west, they have a shot at 2 to 4 inches before it ends. Is a little bit of light rain along the New England coast and a little bit of freezing rain inland this evening.
How's this winter weather been so far?
Well, we've been colder than normal so far for the winter, John. Temperatures have been a little bit below normal December. Most of the Northeast well below normal in January, at least a degree or so. And the big story about this month is going to be all of the activity, as Paul alluded to. We've got this storm system moving through today, another one which looks stronger and a little bit snowier for Saturday night into Sunday from the mid-Atlantic states up into New England. And then we'll be dealing with yet another storm system by the middle of next week. The pattern very active through the central and eastern United States, probably as far out as about the 21st or 22nd of the month.
Well, all right. Rob, we'll be talking to you, I'm sure. Rob Carolan, Bloomberg meteorologist, getting that weather update here. Let's see what's happening in the markets. We welcome Isabel Lee from Bloomberg News. She's a cross-asset reporter. Isabel, what are you looking at in the market?
Ford, it's down 6%. The company warned that profit may fall $2 billion or more this year, and 2 reasons, really: lower vehicle prices and costly new model launches. And again, this adds to the risk posed by the new potential, I think that's a keyword, potential tariffs under President Trump. And this is a big deal because Ford is the second largest U.S. automaker. The CEO actually said there's no question that 25% tariffs on Mexico and Canada would have a major impact in the industry. And that's reverberating across Wall Street as well. Yeah. Morgan Stanley, for instance, said that the guidance assumes no tariff risk. So that's really something that investors.
And the thing we learned from all the tariffs, I mean, the last time around is an auto component goes back and forth like 8 times.
Yes, I was going to say 6 times, but it's 8. I think $3,000 is the increase in your car prices. Again, everyone probably knows I'm a Subway taker, but that's still significant.
I just don't know how an investor with any confidence invests in the auto industry these days, simply because I don't know how this whole EV transition is going to take place. And I know it's costly, but I just don't know where the end game is.
I know it's tangential, but like, do the EV owner, the Tesla owners, are they sort of like put off by Elon Musk these days?
I don't know.
Does that his involvement in the administration? Does that like put off buyers on Tesla?
I think those
or
who are
increase it?
loyalists of Elon Musk will just stay loyal till the end. And John Authers, a Bloomberg Opinion columnist, had a little portion in his column about Tesla, and ever since the presidential election, it really just edged higher like crazy. So what's there not to like?
The stock price or the sales?
Stock.
Okay.
Yeah, so we'll have to see. Anything else?
ARM down 4%. So ARM gave a cautious revenue forecast for the current period. Revenue will be $1.18 billion to $1.28 billion. So even though this was up from the prior forecast and in line with Wall Street estimates, again, it's all about expectations. Analysts were just really expecting much more, and this follows a disappointing outlook from AMD. And of course, DeepSeek. So again, this makes you question whether the billions of companies are lavishing on AI hardware and AI spending is really justifiable. We have Evercore saying results are better than expected, but the outlook is below consensus.
Very good. All right, Isabel Lee, thank you so much. We appreciate that. As always, Isabel Lee, cross-asset reporter for Bloomberg News, joining us here in our Bloomberg Interactive Broker studio. The Bank of England, they're cutting rates. They're not sitting on their hands. They're cutting rates. And let's get the latest from Dan Hansen, Chief UK Economist for Bloomberg News. Dan, what did we learn from the Bank of England today?
Hi, Paul. So, well, you've hit the main news there. We got a cut in interest rates. A couple of things stood out to us. The first was, and this is the thing that really drove the market reaction, you've seen it in sterling, is that we got 2 votes for a 50 basis point cut. So you had 7 members of the MPC, there are 9 in total, 7 going for a 25 basis point cut, and you had 2 going for a 50 basis point cut. And the awkward sort of tension in what we got from the bank is that there are a few hawkish elements to its guidance, to its forecast. So what you've had to weigh is those hawkish elements with this sort of dovish rate split. And I think the broad takeaway for us is that we're going to get more cuts from the Bank of England this year. We think we might get 3 more this year, but they're in no hurry to reduce interest rates. We thought the economy's been very weak here in the UK. We thought they might signal that they'd be willing to speed up, but actually they're in no rush. And the reason for that is the inflation outlook. The inflation outlook is very sticky here in the UK, and that's going to keep them moving at a fairly gradual pace. We think they'll move at a quarterly pace of interest rate cuts.
So you've got inflation and you've got slowing growth. I was told that's stagflation at one point. Is that the case? And wow, what's the message it sends to the Chancellor of the Exchequer?
Well, that's a really difficult message, John. And it's we've had a downgrade to growth for this year. The outlook for growth is pretty anemic. You know, maybe 1.5% growth annually, which is very slow. And it is a very difficult backdrop for Rachel Reeves, who has made it very clear that having had a start to her tenure where things didn't go so well, and there was a lot of talking the economy down, I think, from the Labour government. The government has really shifted its message towards growth. And of course, it doesn't help when you have the central bank coming out and downgrading the growth outlook and upgrading the inflation outlook. So you're right, there is a sort of political element to it. But I think the challenge the government has here is that there's not much they can do to really stoke growth in the near term with the fiscal position so tight. Everything they can do is about the medium term, and that doesn't really help the electorate here and now. So it's a really difficult message. We're going to hear from the fiscal watchdog at the end of March as well, and they're probably going to have a similar message to say, which is growth this year is going to be pretty weak.
Dan, what's the underlying weakness in the UK economy? Here in the US, it's 70% of the economy is the consumer, and the consumer's in pretty good shape. What's the underlying weakness for the UK?
So there are 2 bits of that, I think, Paul. So the first is that consumers here are very cautious. So in the US, you've had the saving rate fall pretty sharply following the pandemic back to, or even below pre-pandemic levels. Here in the UK, it's risen and it's above pre-pandemic levels. So just like the US, the consumer is the biggest sort of spender in the UK economy, but consumers just aren't spending. So that's the demand weakness. And then again, different to the US economy, the UK has got a very weak productivity picture. So the supply side of the economy doesn't grow very fast, and productivity growth, in fact, has been negative recently. So there are those two things where you've got supply side weakness and demand weakness, and that's sort of, you bring those 2 things together, and that's where you end up with a sort of weak growth outlook. If I'm not mistaken, the FTSE was hitting records.
I mean, is there some sort of disconnect between the local economy in the UK And the stock market there? I mean,
Well,
it's more
I think
internationally focused, I would guess, right?
Exactly, yeah.
Okay.
And obviously you've had a slightly weaker sterling as well. That always helps the FTSE. But I think you've hit the nail on the head there, that it's just the international side of the FTSEs that is sort of behind that rally. The UK domestic economy that has very little bearing on the performance of the FTSE.
All right, Dan, thank you so much for your time. Appreciate the reporting. Dan Hansen, Chief UK Economist for Bloomberg News, joining us from our offices, Queen Victoria Street in the city of London. S&P 500 up 15 points. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And this Bloomberg Business Flash brought to you by Oracle. Attention growing businesses. Oracle offering to cut your cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. Well, we've got a slight lift to the markets, but that's for the NASDAQ, up 0.3%. We have the S&P 500 up 0.2%, but the Dow right now down about 29 points. And this all follows yesterday's gains on Wall Street. The two-year yield, 4.19%. That's up 1 basis point. The yield on the 10-year, 4.42%, and that is little changed. We have the Bloomberg Dollar Spot Index up about 0.1%, and Bitcoin up nearly 1% at just above 97,000. Let's go to earnings, and we have a nice lift for luxury. Tapestry higher this morning, up 14%, raised its guidance again for the year, and that was thanks to stronger than expected sales at Coach. Then Ralph Lauren also raised its guidance. Its shares are up 15%. Hershey shares this morning, well, they're up 4%, reported higher than expected sales for the fourth quarter. Now, for 2025, it actually expects to see sales grow at least 2%. That's mostly driven by higher prices because of those higher cocoa prices. And finally, after a disappointment from Chipotle, you have Yum Brands. Their shares up 7%. Its sales beat expectations thanks to growth at Taco Bell locations. Pizza Hut, well, that had a 1% decline. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. John and Paul.
Lisa Mateo, thank you so much. We appreciate it. John Tucker sitting in for Alex Steele. I'm Paul Swinney. We are live here in our Bloomberg Interactive Broker Studio. We are also streaming live on YouTube. Search Bloomberg Podcast Now when you get over to YouTube. Our next guest, nice exposure to technology. And one of my questions is technology going to continue to lead this market higher? We're having a little bit of a hiccup so far in January.
It was the only sector to decline in the month of January, if I'm not mistaken.
And it's just kind of underperforming here. So Nancy Tengler, John, she's the CEO and CIO of Laffer Tengler Investments, based in, get this, right now, she's calling from Scottsdale, Arizona, one of my all-time favorite places.
Where there is no snow and ice on the ground,
no snow and
I'm
ice.
assuming.
The Royal Palms Hotel is my go-to place. They love me there. Lots of good stuff to do out there. Exactly. Nancy, thanks so much for joining us here. DeepSeek was a story a couple of weeks ago. We've now kind of forgotten about it. But I think that caused a lot of tech investors to kind of maybe rethink a little bit their AI trade here. How did you kind of view that news, and did it kind of change in any way your view of big tech?
Well, Paul and John, I'm dressed in sympathy for you this morning in a down vest, because it is actually cold here.
Define cold, Nancy.
Well, not really cold.
Yeah.
She knows I was going to whip out my violin and start playing.
Well, listen, I think there was a couple of things with the DeepSeek announcement. Remember on the Friday before we had Project Stargate, where the president had Larry Ellison, Sam Altman, and Masa Son in the White House announcing a $500 billion investment in AI. And whether or not it's going to be $5 billion, we could talk about that all for quite some time, but it generated enthusiasm. And then the next Monday, we had the story break that DeepSeek had developed a more efficient AI model for $5.6 million. I don't think that's correct, and I think there was, timing involved. And then we had Alibaba come out. What we know is that the system is not as reliable. It's censored. It crashed, and we also know that at Davos, where this was being talked about, and for months before DeepSeek, that is, that they allegedly have 50,000 H1 NVIDIA chips, which cost $40,000 each. So I think the whole thing is a bit suspect, but good for the overall AI market. Because what we know from Jevon's rule is that what you will see is the cheaper technology gets, the more the usage and the use case demand goes up. And we're seeing that across all sectors in earnings reports for the last 9 months and also this most recent quarter.
Nancy, what do we learn from the earnings reports so far? I mean, they're kind of backward looking. I guess more specifically, the earnings calls that we've had.
Yeah, John, no, you're absolutely right. So it is backward looking when you look at earnings beats, but what we listen to is the guidance, and what we're hearing is pretty optimistic. So I'm going to look at my notes just a little bit because we cover a lot of companies, but we're hearing things from companies as diverse as NextEra Energy, Raytheon, Xylem Water Treatment Company, and Prologis, for example. So old economy companies that are benefiting from the usage of AI in their well, in their businesses, and then the margin improvement is showing up in margins, and we're getting guidance that's pretty optimistic. And so you see that in the markets. What we also see is volatility, because we have Trump 2.0, and we know from Trump 1.0 that volatility will be with us. He's going to make bold statements, some of which will come true, many of which won't, but it'll rile the markets and it'll rile the algos and the short-term traders. As an investor, it's great news for me, because volatility is the friend of the long-term investor.
Nancy, I'm looking at your 12 best ideas portfolio, very, very heavily weighted with the big tech names everybody knows, Spotify, Amazon, Broadcom, Microsoft, and the like. Talk to us about your thesis there behind that portfolio.
Yeah, so we run a growth strategy, Paul, and then we also run a dividend growth strategy, which is more value. And we always pull from there our 12 best ideas, because there was a study done decades ago that said optimal diversification is 12 names. And we have found that to be true over the years. That portfolio has done better than everything else. So we look for the companies that are generating earnings growth at a reasonable, not a cheap, but a reasonable valuation. And in determining that, we look at relative price to sales ratio. So what am I paying for a future unit of sales? And then the price earnings to growth ratio. And these are the names that we have confidence in. And in fact, it has shown up in the performance. So I think it's also got a heavy exposure to consumer discretionary, modest exposure to industrials via Uber, and then one healthcare name, and I think one financial, Goldman Sachs.
I learned from Paul this morning that there's high dispersion in the market. I want to ask you for a detailed explanation of that. But are we all riding the same? Are investors all riding the same wave?
Well, to some extent, and that's driven by the ETFs, John. So, when you see a big sell-off in a stock like Apple, a lot of times that's because retail investors or financial advisors are exiting ETFs, many of which own Apple. So you have to keep that in mind. But what we're looking at is an analogy to the 1990s. And I think we're in the early years of this analogy. Internet as a technology was, super cool, but we were measuring eyeballs. I wasn't, but analysts were. Eyeballs on a website. This technology is much more robust. And you've heard John Chambers, who was the CEO of the poster child of overvalued stocks in the 90s, say that generative AI and AI computing is more powerful than cloud computing and the internet combined. So in some periods of time, it makes sense to be part of the consensus, as long as you're not buying companies with multiples of 100 times peak earnings, which is what people were paying for Cisco in the day. And the buyers of the infrastructure are the hyperscalers, who have robust balance sheets, many of whom are spending 50, 60, $75 billion this year in CapEx, but they're still generating 50, 60, $75 billion in free cash flow. So these are really sustainable, strong companies.
Nancy, thank you so much for joining us. Really appreciate it. Nancy Tengler, CEO and Chief Investment Officer at Laffer Tengler Investments. Oh, no, by the way, forecasted high for Scottsdale, Arizona today, 78 degrees. So there you go.
That's tough.
It is. They have a nice golf tournament there. The PGA is there in Scottsdale this week in Phoenix area, so they're going to have some good weather. Gregory Corti, he joins us. He's a Bloomberg News White House and political correspondent. Gregory, Elon Musk, I guess we're talking about some of these employees, federal employees, are taking the buyout, maybe 40,000 folks taking a buyout here in Elon Musk and the Doge group trying to reduce costs of the U.S. government. What can you tell us about that, Gregory?
Yeah, that 40,000 number was as of early yesterday, and certainly the Musk Doge team, the Trump administration, expects that number to increase considerably today as we approach the deadline. It's obviously a decision that federal employees don't want to make lightly, and so they're going to try to get all of the information that they can before making this decision about whether to take this deferred resignation deal, which basically would keep them paid until the end of the fiscal year, until September 30th, even though they can leave and perhaps even go find another job at the end of February. But these are a million individual decisions by federal workers that collectively could have a really big impact on all sorts of federal services that people receive every day. The largest federal department is the Veterans Administration, which is already having critical staffing shortages in almost all of its hospitals and clinics around the country. We know from the past week or so what's happening with air traffic control. So there are a lot of sensitive positions that haven't been explicitly excluded from this deal that we want to just kind of see the data and where all these employees are going to come from and what impact that's going to have.
Oh, yeah, and it's tax filing season. I guess this applies to IRS. Do you really want to cut the IRS workforce at this time of year? And also, the CIA and workers in that field, does this then raise national security concerns?
Yeah, there's a lot of confusion about this because originally when the email from the Office of Personnel Management went out last week, and this was a very sort of Elon Musk email, right? The subject line was "fork in the road," which is the exact same subject line that went out to Twitter employees when he was trying to downsize that company, which he's since renamed X, of course. But that original email said that national security employees, immigration enforcement, postal workers would be exempt from this deal. But then days later, the CIA offered its own deal separate from this to try to slim down the workforce, and what they said sort of recalibrate towards the skills that they're going to need in the future. So it's really unclear, who's eligible, which resignations they'll even accept. The government doesn't necessarily have to accept the resignation. And then there's a possibility even that if somebody has buyer's remorse and says, wait, I want to rescind my offer, there are questions about whether they can do that. There's questions about whether these offers are even guaranteed, given that Congress ultimately funds the federal government and Congress could have the final say over whether workers continue to get paid. So a lot of questions here, but this is a pretty audacious, bold move to really fundamentally reshape the federal government from the bottom down. Usually this is done by across the board budget cuts across federal agencies. Here they're going straight to the employees and saying, do you want to still work here or not?
Greg, we just about 20 seconds left. How many employees does the federal government have? Like, is 40,000 a lot or just a drop in a bucket?
Yeah, it's about 2.3 million civilian employees. That includes uniformed military services. So right now we're talking about with 40,000, that's like 2% of the federal workforce, and their goal is 5 to 10%. So we'll see if we get there.
And the deadline, what, today, right?
Midnight tonight, Eastern time, yes.
All right, we'll stay on top of that. Gregory Cordy, White House and political correspondent for Bloomberg News, joining us from Washington, D.C. And again, 40,000 or maybe more workers, and that could be maybe 2%.
But the interesting thing, it's not guaranteed. It's just like, yeah, you take this so-called buyout offer, and then could they turn around and say, you know what, you're not getting paid till September?
I don't know how that's going to play out. I'd have a good attorney maybe look at that agreement, as you would probably for anything on the employment front. Mixed market out there, S&P up just slightly. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got stocks mixed this morning. This is ahead of Amazon's earnings, tomorrow's jobs data. It's expected to show payrolls increase by 170,000 last month. Now, ahead of it, initial jobless claims, well, they picked up last week and remained relatively low. Separate data, though, did show labor productivity advanced at a firm pace. We'll start with the NASDAQ up 0.1%, 28 points. The Dow down 0.2%, 104 points. The S&P 500 up 0.1% or 7 points. We have the two-year yield, 4.19%, up 1 basis point. The yield on the 10-year, 4.43%, and that's up 1 basis point. To commodities, COMEX gold, $2,872 an ounce. We have Brent crude, $74 a barrel. WTI crude, $71 a barrel. And the Bloomberg Dollar Spot Index up about 0.1%. To earnings we go. We start with Bristol Myers. Their shares down nearly 2%. Forecast 2025 sales profit. Well, it came in below expectations, and that's really a sign that falling sales of older drugs, that's going to slow the company's return to growth. Then you have Eli Lilly, shares up 3%. Full year earnings forecast in line with estimates. It's actually been working to fix inventory problems that it's had with its new obesity and diabetes drugs. And Philip Morris, their shares up 9%. Better than expected profits. Sales of its Zyn nicotine patches rose more than 25% last year. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. John and Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube. So head over to youtube.com, search Bloomberg Podcast Live. You know, John, early in my career, I was an industrials banker at Merrill Lynch, and you spend like half of your career putting these big industrial conglomerates together, and the second half of your taking them apart, and you get paid both ways. Both ways. Is, you know, another person who really follows this industry really closely, all of industrial America, is Karen Ubelhart, senior industrials analyst at Bloomberg Intelligence. Karen, talk to us about Honeywell here, one of the America's great industrial companies. I'm seeing the news today that they're going to break up after pressure from an activist investor, Elliott Management. Talk to us about what's happening in Honeywell.
They were late to the party, and you're right. I've seen these companies break up, come back together, break up. When I first started doing it, conglomerates, they were trading at a 20% discount because they had less volatility than the average industrial. But the world changes, and the last 5 years, which accelerated in the last few, most of the big conglomerates have broken up. And Honeywell isn't the last man standing, but they have ITW that's with them. But pretty much everybody else has gone towards simplification and focus. And Honeywell tried to do other things to avoid doing that. They liked the package they had, but the mood among investors is that they want, they focus is better. And they have this crown jewel aerospace that they weren't getting value for. And in fact, nothing was really broken, but they have underperformed in a 1, 3, 5 year basis because there was no catalyst. And they still had that conglomerate that people weren't paying for anymore.
So the parts are going to be worth a lot more than the whole?
Yes. And what they really wanted, Elliott said it's going to be two great businesses, the automation business and the aerospace business. The truth is they wanted to pull out aerospace because look what happened with GE Aerospace when it was a pure play. They want that multiple, and they're not getting anywhere near it as a conglomerate.
So, Karen, I'm looking at the stock here. It's off almost 6% today. Even on a trailing 12-month basis, it's only up 8% here. What's the market maybe not appreciating here, or has Honeywell kind of underwhelmed with this announcement?
Well, the stock ran up a lot on the Elliott stake, and then it ran up a little bit more when they announced they would consider splitting the aerospace business. But the fundamental outlook was kind of crappy. Their guidance is pretty conservative. They are concerned about the short cycle businesses, so it was a very underwhelming quarter. And that makes about the third consecutive underwhelming quarter, which was also unusual for Honeywell. And the outlook is quite conservative. But I thought the fact that the split was actually a done deal, that would overwhelm the disappointing fundamentals. It appears that was in the stock, at least for today, and that people are not happy with the outlook for the collective businesses. That's my view.
Does Honeywell have a Larry Culp?
No.
Question.
Do they need one?
That's a very good point. We will say that it took a while for Larry to pull that off, but my view is always don't bet against Larry. It just took longer, but no, they don't. So the guy that's running it now is a very good operator. He ran the automation business. He's an operating guy.
So I'm reading your research here, Karen, on the Bloomberg terminal. You like the aerospace business. You call it the crown jewel. And you think a split here could boost Honeywell's enterprise value by as much as $32 billion. That would be pretty big. What would drive that?
It's basically that the aerospace business, if it got a premium multiple to the aerospace businesses that they would compete against, and they're very profitable relative to them. That business could be well over $100 billion, 27 billion. I have at the top with the premium 125 billion value, and the whole thing is now at an $85 billion enterprise value. So the automation business is more complex. They call it one business. It really isn't one business. My guess is that would be split up again. But again, great multiple, not a whole lot of growth. So the others will probably get premiums as well. But the real value is in the aerospace business. And that business, they did talk a little bit more conservatively about the outlook for that business. So people may have clipped their thinking a little bit on that, but the long term looks really, really good for aerospace.
Okay, so we missed GE, and I guess we missed Honeywell. But who's next, and is the conglomerate model finally dead and buried?
I think it is. The only one left. I mean, you could still argue 3M is kind of a conglomerate, but they're now all in sort of all economically driven businesses, some consumer, some industrial. They're not real distinct different businesses. The last one is ITW. It has 7 businesses. They're all about the same size. They have extraordinary margins. They don't grow very much, but someone hasn't gone after them yet. And they still trade a premium to the other peers because their returns are good. That's the last one. Fortive was a little bit of a conglomerate, but they already announced that they're splitting. So I'd say ITW is the last one in the U.S.
And, Karen and John, Karen's been covering this industry for 30, 40, I don't know, for forever. She's seen all these companies come and go. She knows all the management teams going all the way back in the day. General Electric, boy, for the first time in 20 years, this stock is just ripping here. It's up 23% year to date. It's up 87% over the trailing 12 months. I guess GE has finally found a recipe that investors like.
Yeah, I mean, remember when I started covering them, they were in 7 businesses, and some were good and some were bad. Like they were in refrigerators, right? And that wasn't such a great business. Light bulbs, and so they got it down to some core businesses. And again, 2 of them were kind of the ones that were left were not great. It was wind power and gas turbines, right? And then the other business, aerospace, was terrific, and their margins. Nobody can beat them. The growth rate is very good in the aerospace business, and they dominate in engines. And that's that's the big value add well, there's a lot of value add, but a very important value add to the aerospace to aircraft and defense, et cetera. So they have a very good engine business. They dominate it. They have a huge aftermarket business as a result because engines have a lot of moving parts. So it's that's very important. And then the other 2 businesses nobody wanted, and now look at GE Vernova. That's doing terrific because of data centers. So one never knows. But if you held on to both of those, you did even better than you did with just aerospace.
So this is Paul's question. Who are the investment bankers, and how much are they going to get paid?
I think I know it's Goldman Sachs, but I don't, God knows. I wish I still worked there because,
In your world, anyway. In your world these days, Karen, what's kind of the most interesting to you? Because we have a world where tariffs may or may not be part of global policy, trade policy, and your companies are global. They do business all over the world, heavy machinery, heavy equipment. What are some of the names that are still looking good to you?
I love what Emerson's done, and we haven't really seen, that's going to unfold with time. They again got down to only automation, and they were had a very strong market position in process automation. They're building out the discrete business, and now they're going to own, probably, it was approved, a full full ownership of Aspen, which is an industrial software company, a big one. And so they're going to leapfrog the other industrial companies in terms of exposure to software. Roper had the most software, but they're gone. They're in the technology business now. But so they'll have a very good mix of business. Aerospace is much more profitable. It's more stable. I mean, not aerospace, software. So that's going to help them. And he's got a lot of room to go. He moved quickly. The portfolio was transitioned very well. They have one more business to sell. They're going to sell that now. It's announced. They just have to find a buyer, and it's probably private equity. And then there'll be a pure play in automation, which has a good outlook.
All right, that's a good
Some
one.
of the other ones are HVAC. Some of them are really interesting, and they ran big on data centers, and now since they have such a big exposure to Mexico from their production base, they have come in a little bit, but that outlook is really, really good too.
Hey, Karen, I know your partner, Chris Ciolino, follows Deere, but you've followed the company forever. And I love Deere because I kind of feel like it's a real call on the U.S. farmer, how the farmer's doing. What's the latest on Deere and company?
The outlook for equipment this year is not great. It's actually in a downturn, and that always, when the farmer's cash flow and prices get better, the farmer cash flow look good, and they'll be buying again. But they had a really good run of a couple of good years. Tariffs are dangerous for the farmer, however. The last time, we used to be #1 in soybeans with China. We're not anymore. Because when we had the tariffs, they went to Brazil and they ain't coming back. So tariffs are very dangerous to the U.S. farmer, and therefore it would impact Deere.
Interesting. All right, Karen Ubelhart, thank you so much. We appreciate it. Karen Ubelhart, she covers all the industrial companies for Bloomberg Intelligence. She's followed them for decades. She knows all the cycles, all the businesses. And right now we've got Honeywell stock down about 5%, despite them moving forward with a spin-off of some of their companies that are going to break down into 3 separate companies, try to get rid of that conglomerate discount. That's in response to an investor, Elliott Management, an activist investor who'd been pushing for that. So we'll stay on top of that. But again, John, the bankers win, the lawyers win. Everybody kind of gets paid there.
Have you ever been assigned to cover the Super Bowl?
No.
Nor have I.
No, and I've been to a Super Bowl.
The question is raised, how does one get to do that?
Yes, I don't know. I hear the Radio Row, which started out quaintly 30 years ago or something with a couple of radio stations, WFAN out of New York and some other sports stations. Now it is a monster operation down there. Every Super Bowl, every kind of conceivable media network, linear, digital, anything in between, they're down there.
I can just imagine, but we're not there.
We're not there, and luckily, but we've probably got some people down there. But looking at the markets here, John, not a whole lot happening here. We got the S&P up 6 points, the Dow negative 100 points, the Nasdaq up 14 points. We're going to get that jobs data number tomorrow, and that's important for a lot of reasons, not the least of which is it's important to the Fed. So presumably that'll have an impact on kind of how the Fed.
And looking at the data like that, it's just like at this point you could probably safely say the inflation picture has moved to the back seat. We're not too concerned about that.
It's interesting. It's obviously the Fed has a dual mandate there: price stability and employment. And as I look at it, so we'll have to see. Speaking of the Super Bowl, let's head down to New Orleans. Joe Montana, former 49ers Hall of Fame quarterback, he speaks with Bloomberg's Vanessa Perdomo, live from the Super Bowl Radio Row in New Orleans. Let's go to that now.
Thanks, guys. So I'm here in New Orleans for the Super Bowl 59 with Joe Montana, legendary 49ers quarterback. Joe, how are you feeling?
I'm feeling great. I don't have to play.
Yeah. Okay, so but next Super Bowl's in San Francisco. Yeah. Are you mentally preparing for that one already?
Yeah, the last time it was there was fun.
Yeah.
You like to go visit places like New Orleans and New York and L.A. and everywhere else they have it, but it's fun when it's in the Bay Area. You don't have to fight traffic in the airports.
Yeah, yeah.
So,
I can imagine you're a little busy, though, doing all of the press and all of that stuff that you have to do.
Yeah, I stay busy through a good portion of it. From Thursday, a little bit slower towards the end of the week, but. It's always fun to come here. You run into some old people and you all tell the same old lies.
Yeah. It does seem like a fraternity walking around Radio Row for sure. So the NFL is thinking about going to an 18-game season. What do you think about that?
I think it's okay as long as they shorten the preseason games. Nobody likes the preseason games. I think the preseason games are more for a test of the younger guys that the draftees and some teams that you may have traded for during the offseason. But I think it's okay. I mean, you're going to play that many games anyway. But if they can shorten and keep the first part to a minimum, I think everyone would be fine.
Okay.
Everybody likes playing for real.
Right. Yeah. So the preseason games, getting rid of them wouldn't be super consequential, you feel like, to get prepared for the season?
No, I think nowadays, even when I was still with the Chiefs, we would go down and practice again. Our facility, our summer workout was near the Saints, and so we would go down and scrimmage them and while we were getting ready for training camp. So I think there's ways to get around doing that and timing things up, and everybody will have the same problem.
Right. As long as you're prepared going into the season, right?
Yeah. So it'll be an advantage for some veteran teams, but
that's fair. Yeah, for sure. So the other thing that the NFL is doing is adding a lot more international games. We've seen that Australia got added. I mean, that's quite far away for travel.
My friend already called me. Hey, are you coming? Tell the NFL to bring you down here and be a liaison. So I'm like,
so you're excited about it.
I just saw it. Yeah.
You're excited about it as a former player. What about if you were playing in those games?
Well, they're going to take them down there plenty of time ahead. It would be my guess, and I think going international is fun. I mean, we only went for preseason when I was playing, but I think playing games for real it's a lot more meaningful, and it's a lot better for the fans of that country.
Do you see how global the game of football has gotten since there's been more international football now?
Oh yeah, and I think that was been what the NFL realized was that's been the biggest downfall was that they didn't try to go global earlier.
One of the things that we're seeing on the global stage also is now that flag football has gotten added to the Olympics for 2028. What do you think about that being added to the Olympics? Do you think it's going to do even more for the NFL and just football in general?
I think it definitely would do more for football in general. Is it an Olympic sport? Who knows? I mean, there's all kind of crazy things in there now, right? So, but it'll be fun for people to watch. It's always exciting. The ball's always getting thrown around. And, it'll help teach people what football really is about.
It remains to be seen if NFL players are going to be able to play in it or are going to want to play in it. Would you have played? I mean, Olympian's a different title. It's a prestigious one.
I think it's a little different than like the NBA and all that. It's still a physical game in the NBA, but I think that what the guys are making these days, I don't think the owners will want to have them running around playing flag football for the Olympics.
That's fair. So what it is going to do is a lot for women's flag football, right? And that we're seeing that as a big step.
Yeah, you see that more and more everywhere. That flag is coming up instead of padded football these days to a certain age, and I think that's fine. I think early on for kids, pads are okay. I always say because when they're really little, it's like bunch ball, right? Nobody, they all go in a bunch and then they all fall down.
You're not reading the playbook yet.
No. And then what happens is when one guy gets, all of a sudden, there's one or two guys that grow faster than others, and that's when the game becomes difficult, I think, for kids in the contact side of it.
Yeah.
So, I'm all for it. And whatever, early on in pads and then go to flag.
So, last we got to talk, you're here with Pfizer. Tell me about it.
Yeah, I've been with Pfizer now for a number of years, and one of the things we're getting out and have people understand is the risk of pneumococcal pneumonia, and that the CDC has now lowered the at-risk age to 50, and 50 and above, you're 6 times more at risk, whether you're healthy or not. And so we're just starting to get people to realize that you can battle this with vaccination. I got vaccinated, and so to get out there and talk to your doctor, your pharmacist, and find out you're at risk, and work out a program, or you can get on. They have a great website called Vax Assist, VAXassist.com. That has a lot of great information on it. So
VaxAssist.com.
Yes.
Got it.
Yep.
And last we got to ask: are you picking your former team?
Yeah, I got to.
Yeah,
it's hard to bet against them. I think everybody likes to see Philly win, but it's hard to bet against the Chiefs.
Amazing. Well, Joe Montana, thanks so much for being with us. Back to you guys in New York.
All right, that was Joe Montana, former 49ers and Kansas City Chiefs.
I forgot he played for Kansas City.
Me too, until the end of his career. Absolutely. Hall of Fame quarterback there. He's speaking with Bloomberg's Vanessa Perdomo, live from Super Bowl Radio Row. So kind of cool to hear from one of the all-time greats. All right, let's get a little bit of a reset here as we start the 11 o'clock hour. We're going to do that with our good friend, Charlie Pellet.
Hi, thank you very much, Paul Sweeney. From football to markets, we got you covered on Bloomberg Radio. The Dow lower, S&P, NASDAQ, they are both advancing. Bottom line here, the sense of caution is prevailing as traders wade through a deluge of corporate earnings ahead of Amazon's results after the bell and tomorrow morning's jobs data. Here's where we stand. S&P higher, little change right now, up 4 at 6,066, a gain of just under 1/10%. The Dow down 145, lower now by 0.3%. NASDAQ up 16, a gain of 1/10%. 10-year 4.43%, the 2-year 4.19%. Gold down $16 the ounce at $28.50, a drop of 0.6%, holding close to a record. West Texas Intermediate crude 71.41 a barrel, up now by 0.5%. Honeywell International shares, they are lower by 6.7%. Honeywell will be splitting into separate publicly traded companies following pressure from an activist investor. It is the latest in a line of industrial conglomerates seeking a more streamlined portfolio. Karen Ubelhardt is a senior analyst with Bloomberg Intelligence. She was interviewed moments ago on Bloomberg Intelligence.
They have this crown jewel aerospace that they weren't getting value for. And in fact, nothing was really broken, but they have underperformed in a 1, 3, 5-year basis because there was no catalyst. And they still had that conglomerate that people weren't paying for anymore.
Karen Ubelhardt of Bloomberg Intelligence. You can hear more of that conversation on the Bloomberg Intelligence podcast. You can download it wherever you get your podcasts. And again, Honeywell right now down 6.5%. Recapping, S&P higher, little changed, up 0.1%, up now by 6 points. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate that. We got John Tucker sitting in for Alex Steele. Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. We got a little bit of weather coming through here in the eastern part of the United States. For a checkup on that, we go to Rob Carolyn, Bloomberg's meteorologist. Rob, what do we see here on the eastern coast of the U.S. these days?
Well, we got a storm system sweeping through the area pretty quickly, Paul. Right now, we got about another hour's worth of rain in the D.C. and Baltimore area, and then it should end. They actually may see a little bit of sunshine before the day is done. The good news is most of the icing's over now in the I-95 corridor there around the district in Baltimore. North and west, though, it's still a little slick. New York City, it looks like the showers are going to continue probably through about 1 or 1:30. Then they'll end. Skies may start to brighten towards this evening. Most of the New York City area now above freezing, though we're still a little chilly in the Hudson River Valley, so it may be slick there in Rockland and Westchester counties, up into Putnam and Dutchess counties. And in Boston, that's where the snow is falling right now. Already starting to see signs of some sleet and freezing rain south of Boston. About an inch or two for the coast, maybe 1 to 3 inches away from the coast in Boston, but they'll be done by about 5 or 6 o'clock this evening. So this is a quick hitter, and it looks like it's going to be followed by another fast-moving storm late in the weekend.
Ooh, tell me real quick about that.
Sure, John. It looks like a storm moves in Saturday night, late in the day for the district in Baltimore with snow. Down in the district in Baltimore, they change to sleet and freezing rain. New York and Boston, though, may stay as all snow. Some parts of New York and New England could see a half a foot.
Great. I'm flying out Sunday morning.
You're going away to find snow.
Go away to find snow. Rob
stay
Carolyn,
here.
I know. I can just stay here. All right, Rob. Thanks so much. Rob Carolyn, Bloomberg meteorologist, giving the latest on the weather here. Mixed screen out there. S&P and the Dow. S&P's up 7 points. The Dow's down 100 points, and the Nasdaq's up 28 points. Let's see where the action is under the hood. We do that with Alex Semenova from Bloomberg News joining us here in our studio. Alex, what are you looking at?
Hey, guys. Always a pleasure to join you. One name that is getting a lot of attention today is Honeywell. That stock is taking it on the chin right now, down about 6.5%. This is after the company said that it is splitting into 3 independent companies. This also confirms a scoop by Bloomberg last month. This is the latest in line of industrial conglomerates that are aiming for a more streamlined portfolio. And it comes, of course, after pressure from activist investor Elliott Management. The firm revealed a position of more than $5 billion back in November. That's its largest ever in a single stock. Elliott basically called for the split, saying that Honeywell's conglomerate structure was to blame for its underperforming shares and its inconsistent financial results.
And I want to know, how many suit jackets can you hang on a Peloton?
Peloton.
Well, Paul actually uses his.
It's only a case right now, especially when you look at the performance from that 2021 high to right now. The stock is still down about 95%, even though if it's having a good day today. It was trading at about $167 a pop back in its heyday, and now less than $9. It is up today, though, after really solid earnings results. This is reflecting that their cost-cutting measures have really improved their bottom line, even though revenue isn't really increasing. Of course, it's kind of struggled since the pandemic because people went back to in-person fitness classes, gyms, no longer using their Pelotons. John, as you say, kind of hanging their stuff on their Peloton bikes.
Maybe I can pick one up at a discount.
At a discount.
And a really expensive clothes hanger.
Yum Brands, what's going on there?
That stock is having a really good day. Actually, it's best since 2020 and on track to close at a record high if the gains continue. This is, of course, also after strong earnings results, but specifically thanks to Taco Bell.
Yes,
that was apparently a hit during the quarter. The chain announced the revival of a few famous products from the past few decades, and also launched crispy chicken nuggets that apparently is paying off for Yum Brands.
Now, they also own Pizza Hut, right?
I think so,
Now, here's my Pizza Hut call. Bear with me here, John. Growing up in the New York, New Jersey area, I know pizza, all right? However, going to school down in the South, no pizza. So I came to appreciate Pizza Hut.
And if you ever tried to order, I just want a slice at a pizza parlor outside the tri-state area, forget it. They're like, look at you, like you're nuts.
But you're in Richmond, Virginia, you're in Durham, North Carolina, and you have a hankering for pizza. Pizza Hut, it fills the bill, I'm telling you.
I remember it was famous for, having cheese in the crust.
Yep.
Back in the day.
Yeah. So anyway, Yum Brands, a little bit of a mixture there. And you can talk to Michael Halen. He covers the restaurants for Bloomberg Intelligence. It's all about obviously the health of the consumer. I mean, you think about that. You see that immediately in some of these fast food type of places and just in the dining expenditures where people spend their money on dining. And you see it immediately. And it's a great read on the consumer, I think.
And as cannabis sales increase, there's always the Spicoli effect, too.
That's right, the Spicoli effect. Alex has no idea what the Spicoli is. No.
We'll have to educate her someday.
All right, let's talk to these markets here. Let's talk technology in these markets. Is technology still a leader for these equity markets as it has been forever? Shana Sissel joins us. She's the president and CEO of Bonrion Capital Management, joining us here. Shana, a couple of weeks ago, it seems like a lifetime ago, there's this thing we all learned about, DeepSeek. And I know you guys spend a lot of time thinking about investing in technology, broadly defined. How did you guys think about this DeepSeek and what it may mean for technology investing?
So my general rule of thumb with any kind of news is if it makes me have a very visceral response, that I should step back and read. And so that was my initial response. The market, however, does not have the focus and the ability to necessarily do that. So it freaked out. As I learned more, I became less concerned about the DeepSeek threat and what that means for China as a competitor in the AI space. There's a number of things that stood out to me that made me think like, okay, this is no different than any time a Chinese company knocks off a American shoe brand or anything else. It's very similar, but there's more of a concern here. If we thought TikTok was a concern from a national security perspective, this is an even greater concern with its connections to the CCP through their app. So while there's definitely some interesting aspects of the open source code that can be used by Amazon or anybody to leverage, the actual app itself and the things as related to that, I'm less concerned about. In terms of what it means for U.S. companies in the tech space, this shouldn't be a surprise. It was always the greatest risk to technology companies in the U.S. was having somebody disrupt the market. But I think it's a bit overblown. And quite frankly, I think we've been complaining about valuations forever. And this solved our problem pretty quickly.
All right, let's move to Treasury yields. I heard the new Treasury Secretary say yesterday that he's kind of focused on the 10-year and bringing that down. Now, I'm kind of a student of history, and I have to go back to the early 60s and beyond. right up to present day, the 10-year seems to follow economic activity. And if you want to bring the 10-year lower, a sure way to do it is to lessen economic growth. I'm sure he doesn't want to do that.
Yeah, that's the conundrum here, right? You want to bring rates down, but at the end of the day, there is correlation there between the strength of the economy and the interest rate environment and the yield curve and how the yield curve behaves. The Fed doesn't have the power it thinks it has to control that. I mean, we've seen that in recent months with the Fed cutting and yet yield curve not behaving like rates have been cut. In fact, it's to be expected, right? Because you want to get out of an inverted yield curve, which requires the longer end to go up, even in a cutting cycle. But I think that the problem here and what they're trying to kind of fix is related to mortgage rates and the housing market. And I don't know that there's an easy fix to that. But I am concerned that there's this belief that if they just cut rates enough, they can fix this problem, because I think it's not that black and white. And there's a high probability of a potential mistake being made if they go in with policy decisions thinking that it is that easy.
Shana, I know you work with your clients talking about alternative investments here. Where do you see the greatest opportunity in alternatives here? Private equity, private credit, hedge funds? Where are you spending most of your time these days?
So more hedge fund-like strategies. Private equity, private credit are kind of sensitive to the interest rate environment and also sensitive to public market betas. In the hedge fund world, especially if you believe that there's going to be increased volatility, hedge funds and hedge fund-like strategies are great diversifiers. So for example, last week, there's a ETF, BTAL, it's the AGF US Anti-Beta Fund. It's long, low beta, short, high beta. That product did remarkably well when we had the big DeepSeek threat sell-off. And that's exactly what you want in those types of products, and that's what hedge fund-like strategies can do, is provide you that downside protection when the market is under significant stress. Managed futures is another example, like a CTA ETF. And then when you move into the hedge fund space where they can use leverage more as a tool, you can get even greater benefit as a diversifier and as a downside protector. But it's not sexy, and people forget that like these aren't meant to outperform the market. They serve a purpose in your portfolio. I like to think of it as like home insurance. Like you hope you never have to use it, but you would never not have it. Because you need to be able to manage the risk. And that's exactly how I see those types of strategies. This year, I think, is the year where these types of strategies are really going to show their worth, because I think the markets are going to be quite volatile.
Shana, thank you so much for joining us. Always appreciate getting a few minutes of your time. Shana Sissel, President and CEO of Banrion Capital Management, joining us here talking about the broader market share. One of the big movers in the marketplace today is Roblox. The game company stock is down 11%. It was down more than 20% earlier in the trading day. Bookings missed. Outlook a little bit softer than expected. Let's get some details on that. We can do that. The Mandeep Singh, he's a senior technology analyst for Bloomberg Intelligence. Mandeep, describe what Roblox does, and then what's happening with the stock today.
I mean, this is a platform, think of it as a walled garden where you can play any user-generated game, as well as, the AAA titles and all sorts of gaming content hosted inside Roblox platform where multiple users can play the game. And it's been quite popular, with that demographic, the 9 to 17, 18-year-olds.
It's a great way to entice somebody to do their homework. It really is.
Yeah,
it works.
The use case is beyond gaming.
You could spend 20 minutes doing this, after you do your homework or whatever.
Yeah, and so I think, again, user growth of 20% plus, and anytime you see a company missing on user growth, the reaction is pretty strong. Now, if you remember, there was a report from Hindenburg talking about how the user and engagement metrics are inflated. So pretty much the company has been, doing the cleanup post that report, even though they didn't really acknowledge, there were a large number of users.
Were they faking those numbers, or they're just so difficult to
I think
ascertain?
the problem with online platforms is it's so hard to figure out exactly, what's bot activity and where are the user metrics inflated or engagement. And there's always scope to, clean up and have real users being reflected on the platform. In the case of Roblox, brand safety is a big aspect because, we were talking about kids using the platform. So they've really, I think, done a lot since that short thesis from Hindenburg. And that's partly the reason why they missed in terms of the user and engagement metrics. But they called out Eastern Europe being weak and Turkey being weak. To me, this is really the quarter where the impact was the most obvious, and then it will gradually get better because they've cleaned up.
So it seems like at least a partial vindication for the Hindenburg research.
Well, I could make the case even for, a platform like Snap, where you may have, they have shown 100 million daily active users every quarter. Now, do they really have 100 million, or is it more 97 million because 3 million are just captured in their metrics? So no one has a consistent approach.
There's not a third party, like a Nielsen for TV ratings. There's no third party to verify.
There is no third party. Right. It's the company that's giving you the metrics, and I don't think there is like a consistent approach that every company uses in terms of giving out their daily active user count.
Beyond the daily active users, what are the other important metrics that you need to look at?
Engagement also was kind of a slight miss.
Well, in radio, it's time spent listening. Is that this sort of the same thing?
Yeah. So, I look at, what they are doing on the AI side. They are looking to develop their own foundational model. So think of it as, what the LLM companies are doing. It's a walled garden where they will create all sorts of tools to enable more content. It's similar to YouTube in some sense. YouTube has got a lot of video content. Roblox has got a lot of gaming content and other things for that demographic. So net, I mean, this seems to be a justified reaction because they missed on their numbers, but has the thesis really changed because they're losing share? I don't think so.
And real quick, have the safety concerns as a parent, have they been fully addressed?
That's what they're trying to address, and that's why they missed on these metrics. So they're using a combination of AI tools as well as just focusing more on brand safety because they want to ramp up ads. And the way you ramp up ads is you want to make guarantee the advertisers that it's a safe platform to advertise on.
Mandeep Singh, thank you so much. We appreciate that. Mandeep Singh, Senior Technology Analyst for Bloomberg Intelligence, joining us here in our Bloomberg Interactive Broker Studio. Coming up, Bloomberg Television's Celia Mosin speaks with U.S. Treasury Secretary Scott Bessent at 1 p.m. Wall Street time on Bloomberg Television and radio, and we will bring you that important conversation as global Wall Street, increases its knowledge of Mr. Bessent and maybe the policies that could be acting in global financial markets. S&P 500, it's up 11 points, 13 points. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. The Dow lower, being weighed down by Honeywell. We've got the S&P, NASDAQ, both higher. This ahead of the jobs report tomorrow morning and Amazon earnings. After the close of trading ahead of earnings, we got Amazon up by 0.7%. Bottom line here, sense of caution prevailing. S&P up 14, a gain of 0.2%, while the Dow down 60, down 0.1%. The NASDAQ Composite Index up 44, up 0.2%. The 10-year, 4.44%, with the 2-year, 4.20%. Gold retreating from a record, down $15 the ounce, $28.52, down 0.5%, while West Texas Intermediate crude oil, $71.32 a barrel, up 0.4%. Bitcoin just above $97,000, up by 0.1%. I mentioned Amazon. After the close of trading, it is expected to report that revenue grew 10% in the fourth quarter, fueled by its cloud computing and ad businesses, as well as online sales during its busy holiday shopping season. Ahead of earnings, Amazon now up by 0.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Powell, thank you so much. We appreciate that. John Tucker sitting in for Alex Steele today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Podcast Live, and that's where you find us nice and easy. Tariffs, uncertain when they will be implemented, to what degree they will be implemented, but certainly industries. I'm looking at a story here about Puma sneakers. They're importing fewer sneakers made in China to the U.S. They're now going to Vietnam and Indonesia. So it's impacting the sneaker business. It's also impacting the global aerospace business. And for that, George Ferguson joins us. We won't ask him about sneakers, but we are going to ask him about, he covers all the aerospace stuff for Bloomberg Intelligence. George, talk to us about kind of how the global aerospace business is thinking about U.S. tariffs on China, on Canada, on Mexico, and maybe the European Union.
Yeah, so, from a China and Mexico perspective, I think at least on the large commercial side, sort of thinking about Boeing, it's probably not much impact. There's some supply chain activity down in Mexico, a bit in Canada, but really not a large portion of the airplanes. So I think not a big effect there. If tariffs go to Europe, I think then we have a much bigger issue, right? Because we saw this during the first Trump administration, right? If Airbus is trying to deliver airplanes into the U.S., you got to slap a tariff on them as they come in. The airlines will not want that tariff. They'll push back on Airbus, ask them to eat that tariff, or maybe find another jurisdiction to take delivery of the airplane in. And if you get retaliatory tariffs, you have this supply chain that's very integrated. GE, for example, they build their jet engines, the most used jet engine in the world, the LEAP, and the CFM56 for that matter. They build it partially in France and partially in the U.S. And so you get sort of components moving between the two countries. That's going to be a big challenge.
Oh, and I forgot, Canada makes planes too, right? Bombardier.
Yeah, so one of the bigger issues is Bombardier, right? They reported earnings today. They pulled guidance.
Wow.
Because on the small jet, the biz jet side, the supply chain is very U.S. focused, and the customer base is very U.S. focused. We're the biggest consumers of private aviation. So Bombardier, to ship airplanes into the U.S. for delivery to customers, those customers have to pay a 25% tariff on that airplane. And the supply chain, if there's retaliatory tariffs, the supply chain ends up getting taxed as well, as you send engines and avionics over to Canada to put it into the airplane. So they pulled guidance today. They're probably the most affected because there's another 4 manufacturers. Gulfstream is one, U.S.-based. Textron, Cessna, another, U.S.-based. Dassault out of France, but they also have a big defense business and more international scope to their bizjet business. So they get hurt, but not as bad. And Embraer, Brazilian, we're not hearing a lot about tariffs on Brazil. They do assemble some in the U.S., so probably less affected. So Bombardier is probably the worst affected in aerospace.
Hey, George, we also heard from President Trump this morning talking about the air traffic control system here in the U.S., talking about new systems for air traffic controls, perhaps in response to that terrible crash in Washington, D.C. last week. Can you talk to us about air traffic control system and kind of where it can be improved? Is it a technology story? Is it a personnel story? What do you know about that?
The technology story has been around for a long time in air traffic control. A lot of the computers that the controllers are using are pretty antiquated. From time to time, they've come in and tried to update them, but it seems like they're perennially behind the curve in automating, air traffic control. And so I think this is probably a great opportunity for the U.S. to invest for the long haul in its airspace and really put a bunch of money into it, right? The government's always got these competing objectives, right? The budgets are always tight, and I think air traffic control seems to work. We haven't had many accidents, and so, the investments there sort of always seem to get pushed off a bit and not fully implemented. So it would be great to see the president prioritize air traffic control. I think it would help with situations we had in Washington, D.C. The other day, although I think these Army training flights that move along that Reagan corridor are probably best put somewhere else. But it does feel like the controller was sort of juggling heavy traffic periods there at Reagan and looking for the Army helicopter to recognize and avoid that CRJ that was coming in for a landing. Seems like better systems could probably help out in that controller workload.
George, thanks so much. As always, great stuff from you. George Ferguson, Senior Aerospace, Defense, and Airline Analyst for Bloomberg Intelligence. He is also an Army veteran, so we thank him for his service. And, of course, the highlight of his career, the peak of his career, was he went to Penn State.
Oh.
It's been downhill ever since for our good friend George.
And working for you.
Exactly. So he's our go-to person on aerospace, defense, and the airlines. Coming up in just a moment, Salim Ramji, Vanguard CEO, sitting down with Bloomberg Television's anchor Katie Greifeld, talking about the asset management business and the fees on the ETF.
It is fee war
on
ETFs now?
Yeah, I mean, I saw they're lowering their fees on their ETFs to 7 basis points, 0.07%. I don't know how the economics work there, but they certainly work for the Vanguard folks because they rake in tons and tons of assets. And all that funds flow going to ETFs, it's just an extraordinary story just over the last, seems like 10, 15 years. It's been just an incredible
When I think
story.
of Vanguard, I think of the late Jack Bogle.
Yes, of
and
course.
what was he all about? He was all about the investor.
Yep, low fees. Salim Ramji, Vanguard CEO, with coming up in just a moment with Katie Greifeld. Looking at the market, S&P up 13 points, the Dow minus 90, and the NASDAQ up 43. So red and green on the screen here. We'll stay on top of that. Got the gold futures pulling back up a little bit. 10-year Treasury yields 4.45%. Right now, let's go live. Bloomberg's TV's anchors, Katie Greifeld. She sits down with Salim Ramji, Vanguard CEO, talking about ETFs and asset management. Let's take a listen.
Our TV and radio audiences worldwide. I'm pleased to say we're joined by Vanguard CEO Salim Ramji in an exclusive conversation. Salim, great to have you with us. So we all saw the ripple effects.
Great to be here, Katie.
Thank you. We saw the ripple effects from Monday's move, and your average fee now is just 7 basis points across your lineup. The industry average, for context, 44 basis points. Set the scene for us. Why now?
Well, in one sense, I will say Monday was a pretty joyous day here at Vanguard. And it was joyous because it really is a reaffirmation of our business model. We're owned by our clients. And so as a result, as we gain scale economies here at the company, we share those back with our clients. And that's not just been true since Monday. It's been true since 1975, since when we founded the company. And so this was continuing on a 2,000 price cuts, I think, by our tally as of last week. Now it's 2,168 price cuts. And that's been part of the proposition that investors have had with Vanguard for decades.
And so, Salim, I think I'm asking on part of your competitors, but also investors as well when I ask, how low can fees go? You're at 7 basis points right now. Where is the possible floor here?
Well, we don't we don't price products as loss leaders. We're not looking to, price abnormally low in order to get somebody into a higher cost other service. And so we really look at it across the board in terms of our scale economies. We want to deliver great quality and great performance. And I think that the thing that sometimes gets lost in the mix, obviously, index prices have been coming down for quite some time, led by us over the past several decades. But sometimes it gets confused that we're all about index. We're actually about active and index. And really, if you go back to our origins, what Bogle was against was high fees. And so active management at a low fee can really outperform over the long term if delivered with the right quality. That was Bogle's hypothesis in the 70s and 80s. And if you look at our track record, even just in something like active fixed income, the empirical evidence backs up that hypothesis that he had way back then. 91% of our active fixed income outperforms its peers over the past 10 years. And one of the reasons why is because we price it at just over 10 basis points. And so at a very low fee. And, when you speak to our fixed income team, to Sarah Devereaux, our CIO, and our teams who run our active fixed income, part of the reason they're able to outperform is they have a much lower headwind from higher fees, and so they're able to take risks in a much better and more disciplined way. And so what this is really about is not just about delivering high-quality index management, but it's really about delivering high-quality investment management at a very low fee. And I think whether you're looking at active fixed income or whether you're looking at index fixed income or index equities, that's really what we've been about.
Right. Well, Salim, you make the point that a lot of people probably think of Vanguard and they don't think of active. And you do have, of course, active funds out there, but it's a pretty small percentage of your overall lineup, especially if you take a look at the ETF side of things. Should we expect to see more active fund launches from you?
Yeah, our active management, the first Vanguard funds were actually active funds. If you go back to the 70s, and both we manage our active fixed income within Vanguard. We have a whole range of partners, sub-advisors that we work with for our fundamental active equities. And they're unified by the principle of being high quality at a low price. And yeah, Katie, you already have seen us doing a lot more in active ETFs. And I think you've seen that pick up over the past several months, and I hope and expect that will continue over the next, this year and next year.
All right, so we'll keep an eye out for that. You were talking a little bit about, of course, how the ownership structure works at Vanguard, how basically a lot of the extra cash, the extra assets that you generate are funneled towards these fee cuts. But I'm curious, from where you sit, how do you balance lowering fees versus investing in the business? What does that decision tree look like?
Yeah, it's something we do very carefully here. This week is all about our fee cuts and giving back to our clients in the form of lower fees. We've also stepped up our investments in things like technology. That's something that really began about 2-3 years ago and is continuing this year and next year. Because we're always trying to balance making sure that we've got high-quality products at a low cost, and we're delivering the right level of service to clients. We're investing in newer technologies to make our investing even more efficient, to make our client interfaces even more efficient. So that's always a balancing act here at Vanguard, just like it is at many companies, in terms of how do we think for the near term and how do we think for the medium to longer term. But I'd say one of the beauties of Vanguard, I think part of the original genius of Vanguard, is that when we've got a surplus after we've looked at the important investments we need to make back in things like technology, the way we give back to our owners is through lower fees. Right. And I think that's the Vanguard effect that you've been seeing for decades all across the company.
Yeah, that Vanguard effect, obviously a good news story for your investors, maybe not for your competitors, but I do want to talk about the future, and I want to talk specifically about private markets and alts. One of the big take stories that we have on the terminal right now is about PIMCO and fears that PIMCO might be falling behind in alts, because you take a look at the industry right now, and a lot of your peers have invested heavily in alts, in privates, to scale up there. What is your plan when it comes to those areas, and do you fear that you're a little bit behind right now?
Well, one of the great benefits of our business model, if you go back to the origin, we had sub-advisors. For example, at our beginning, we are and are still sub-advised by Wellington Management, which is still our largest sub-advisor today. And so where we don't have capabilities within kind of Vanguard, we've long had an ability to partner with other firms. To date, we've generally done that in fundamental active equities, but we can do it in things like private markets. And there's lots of discussions and explorations we have underway to see what's possible. But our North Star is always about what's right for our clients. And it's making sure that whatever it is we do in active, in index, ourselves, or with others, that we keep in mind that we're about simplicity, we're about low cost, and we're about long-term returns. And I think that there are constructs that will allow private markets to fit in that. But that's really part of the exploration that we're doing, because whatever it is we do, we want to do it the Vanguard way. And we want to do it in a way that's well suited to our client base, which is really looking to us for a certain set of things that we've consistently delivered over the years.
All right, Salim, got to leave it there. Really appreciate you taking the time. That is Vanguard CEO Salim Ramji. Back to you.
All right, that was Salim Ramji, CEO of Vanguard, speaking with Bloomberg Television's anchor Katie Greifeld, talking about the asset management business, the ETF business. And again, the news, John, from the last week was Vanguard cutting the fee on most of its ETF businesses to 7 basis points, really putting incredible pressures on its competitors like Invesco and Black.
And it's important to note, as he pointed out, it's owned by the investors.
Yes, exactly. Very unique ownership structure. The
customers, basically. Yeah.
Yes, exactly right. All right, let's get a reset here. We'll continue on. Let's go to Charlie Pellet with a Bloomberg Business Flash.
Hi, thank you very much, Paul and John. Reset recap with the Dow lower, the S&P, NASDAQ. They are both advancing. Bottom line here, sense of caution ahead of earnings out of Amazon after the close of trading today. Amazon up by 0.5%. And of course, the all-important jobs report, 8:30 a.m. Wall Street time when that drops tomorrow morning. Yes, complete coverage and analysis, as you have come to expect over the years from Bloomberg Radio. S&P right now up 6,070, a gain there of 0.1%. The Dow down 128, down 0.3%. The NASDAQ Composite Index up by 0.1%. Little changed, up by 21 points on NASDAQ. The NASDAQ 100 Index up just under 0.1%, while the Russell 2000 Index of small cap shares also little change, down less than 0.1%. The 10-year 4.45%, but the 2-year 4.20%. Gold down $15 the ounce, 28.52 down 0.5%, and West Texas Intermediate crude 71.19 a barrel, up 0.2%. American labor productivity is up, and with that story, here's Bloomberg's Vinny Del Giudice.
Employee output per hour advanced at a firm pace of 1.2% in the closing months of 2024. The fourth quarter capped another year of efficiency gains, propelling U.S. economic growth. For many businesses, labor costs are their largest expense, and they seek out new technologies. For all of last year, labor productivity rose 2.3%, the fastest in 14 years, excluding the pandemic era. Vinny Del Giudice, Bloomberg Radio.
Lots of earnings reports to digest. Ford, after earnings, down 5.8%. Qualcomm also reported after the bell last night. Qualcomm down by 4.7%. Peloton up 14.9%. Hilton up by 5.4%. Philip Morris up 9.5%. And Roblox, after earnings, down now by 12.2%. Again, recapping, S&P 500 Index up 9, up 0.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. John Tucker sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio, streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Podcast Live, and that's where you will find us. As Charlie was just reporting, Peloton up about 14.5% to $8.67. That's the good news. The bad news is this thing peaked at year-end 2020 during the pandemic craziness at $160. So a big come down there. But the stock has actually doubled in the past 12 months, so maybe it's found a little bit of a floor here as the company tries to reposition itself. Let's get the breakdown. They reported some numbers that beat estimates. Geetha Ranganathan joins us. She covers all the media stuff for Bloomberg Intelligence. So, Geetha, what did you hear from the folks at Peloton in terms of kind of right-sizing their business, maybe trying to position itself for some type of growth going forward?
Yeah, absolutely, Paul. Thanks so much for having me. So the right sizing is the right word. That has been their focus now for so many quarters. And this was actually their first quarter with a new CEO who just took over in January, Peter Stern. He's come in with this new focus. And again, he's looking very much at right sizing costs and at improving unit economics. So that seems to be the new mantra. And it's really kind of paying off so far for Peloton because we've seen this intense focus on profitability. That has led them to raise their. It obviously helped them beat estimates pretty handily for the quarter that they just reported, but they've also taken up their adjusted EBITDA estimates by over 20% for the full year. And then the big number that had always kind of been this huge pain point for Peloton was their cash burn. They burned about $3.5 billion of cash from 2021 through 2024, but finally we're kind of seeing some green shoots there. So they actually raised their free cash flow guidance by almost 60% to $200 million this year. So it's really all now about cost cuts, about efficiency, and really, as you pointed out, right-sizing the cost structure.
Well, is cost cutting any way to get to profitability? I mean, it doesn't send a great message, does it?
It doesn't, but remember, this was a company that had a really, really bloated cost structure, John. So, you mentioned the pandemic, you mentioned the $160 peak price. Of course, they were a huge pandemic darling, but what happened was that just caused costs to go completely out of whack. So if you just look at that period, 2021, 2022, the operating expense as a percentage of revenue for Peloton was about 96%. That is completely, crazy, which is why we had, them going into operating losses, the free cash flow burn. Now, fast forward to 2024, they actually did manage to bring down those operating expenses quite dramatically. So it was about 65%. And then this year, it's going to be 50% of revenue, but they're still looking to kind of cut it down. Of course, I do understand your point, John. You can't cut too much. You also need to invest for growth. But I think these were a lot of extraneous costs that needed to be, the fat needed to be kind of trimmed, which is exactly what they're doing.
Geetha, is there any strategy here to grow the top line? It seems like you grow the top line by just adding subscribers and or getting more revenue per subscriber. Is there any strategy to actually grow the top line?
Yeah, that is where we are really struggling, and that's where the company has been struggling. So they've had about 3 million, subscribers. That needle hasn't moved, Paul, now for many, many quarters. In fact, on the other hand, they've actually been losing subscribers. So right now, the CEO was obviously asked this question. What he said is, my strategy for the moment is, yes, we do need to reinvigorate growth at some point of time. But at this point of time, we want to kind of walk before we run. And so we're more focusing on stemming churn and stemming those cancellations, which is exactly what they actually did for, the quarter that they just reported, fiscal 2Q, where cancellations came in much lower than what they had originally projected. And so that kind of caused them to revise their expectations for the full year as well. So it's more, at this point, it's really more just about stemming churn and focusing more on keeping it's more customer retention rather than customer acquisition. But I think, soon as they kind of get their bearings back, they probably will, go into new modalities and get into newer products.
I asked Paul jokingly before how many suit jackets he can hang from his Peloton. But I mean, my point is, it's not just you don't just go out and buy the bike. That's not what they're really relying on. It's the subscription services, right?
Absolutely. So 70% of Peloton's revenue comes from subscription. Hardware, yes, is important, but the high margin portion of the business is as you pointed out, John, is subscription.
Do they move beyond the stuff that's in your house? Can I, subscribe to a Peloton app and pay them a monthly fee to have somebody yell at me while I go jogging down the street?
That's exactly what they've been trying. So they've been trying all kinds of different things. You don't necessarily need to be tied to the hardware, or you don't need to own it. They've had different programs, rental programs, all kinds of things. Not all of them have necessarily worked, but that's why they're kind of now trying to focus on different things, including partner programs. So one of the things that they kind of mentioned for this quarter was they had this program with Costco, and that actually helped them sell more, bikes for the holiday quarter. So they're trying new things. Again, not sure whether it's going to be a game changer at this point. So it's a little bit of a wait and watch.
Keith, every once in a while we'll see a story go by about how Peloton may be an acquisition candidate, that it's got a brand, it's got, these 2 million pretty committed subscribers. Where are we on that part of the story?
Yeah, those have always kind of been on again, off again. So for the longest time, we had potential interest from, maybe a Nike, maybe an Amazon, maybe an Apple. This year, there was some talk, or actually it was in 2024 that there was some talk about private equity kind of getting interested, just as they were kind of repositioning their whole focus into cost cutting and reducing their leverage. Again, all of that seems to have died down at the moment. But I think eventually once the company gets a little bit better in terms of visibility for profit as well as free cash flow, I think we'll have some, M&A suitors kind of circling again.
I had to Google this. Who's the highest paid Peloton instructor?
Who is it?
Cody Rigsby?
Yeah.
Really?
Sure.
The dude makes over $500,000.
Well, he's a big
yelling at people. Run! I could do that.
Exactly. All right, Geetha. Hey, before we let you go, Geetha, what's kind of the most intriguing story in your media entertainment coverage these days for you?
Well, lots of things, Paul. Everything, really. We just had Disney kind of report yesterday. It's all kind of coming down to those streaming numbers. Yep. We're seeing good progress on streaming profitability, and we're going to wait and see what happens when the other companies report with Warner Brothers and Paramount. But right now, what we're kind of focused on is really kind of seeing whether the Skydance Paramount deal actually goes through. There's been a lot of regulatory kind of rumblings, so that's a little bit of a wait and watch.
I thought we were heading into regulatory light environment with a new administration, so maybe that'll make a difference.
Yeah, we'll see. All right, Geetha, thank you so much for joining us. Geetha Ranganathan, she covers all the media, stocks, and the industry for Bloomberg Intelligence. A lot going on there in the world of global media and entertainment here. Looking at the markets here, kind of mixed. Got 10-point move higher in the S&P 500. The Dow's off about 145 points. That's 0.3%. And the Nasdaq's up 22 points. That's 0.1%. So not a lot of direction.
Maybe
there.
On hold because we have data tomorrow in the form of the jobs report.
Yeah, we have a jobs report and then change in non-farm payrolls. I guess the consensus is about 170,000. And the whisper number, WHIS, is the function on the Bloomberg terminal. You get the whisper number from a lot of Bloomberg users. That's higher. It's about 197,000. That's been drifting up over the past couple of days. So that's what's going to be the data point for tomorrow. We'll have full coverage of that coming out at 8:30 a.m. Wall Street time. And presumably that will be a data point for this Federal Reserve as it thinks about where to go next with rates. Coming up later on today, Bloomberg Television's Saleha Mohsin speaks with U.S. Treasury Secretary Scott Bessent at 1 p.m. Wall Street time on Bloomberg TV and radio, and we will bring that to you as well. Looking at the commodity space, pretty quiet there in WTI crude oil, right around $71 per barrel. Gold takes a little bit of a break from its big rise. It's now $2,850 per ounce. Bitcoin, it's off a little bit here today, just below $97,000 per total. This is Bloomberg.
listening to Bloomberg Intelligence with Paul Sweeney and Alex Steele on Bloomberg Radio.
All right, John Tucker in for Alex Steele today. Alex will be back tomorrow. I'm Paul Sweeney, live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Podcast Live, and that's where you'll find us. The next big earnings print is going to be today after the close. Amazon reports, and as it has been for some time now, the focus is more on the cloud business versus the retail business. But let's break down a little bit of the retail side of the world here. Poonam Goyal, she joins us, senior U.S. e-commerce and retail analyst for Bloomberg Intelligence. Poonam, before we get to Amazon, I know Under Armour had some results today. What did you hear from the good folks at Under Armour?
Yeah, it looks like it was a great holiday season. They're tracking to their turnaround, and in fact, even ahead of it. They had a nice beat, and it came from the wholesale side of the business, so that was nice to see that things are actually getting back on track for them. Make no mistake, they're not driving positive sales yet, but we did see better than expected consensus sales. They raised their guidance for the fiscal year. It's going to take time, but they're doing the right things to move forward, focusing on the customer connection versus just putting product out there and then having to promote it to get the sale.
I feel like this is sort of like a Peloton story as well. They're really hoping to get back to the environment of the sales environment that we saw during the pandemic.
Yeah, the environment during the pandemic was definitely an anomaly. So there was heightened demand on athleisure during that time. While we all aspire to get there, I think as long as they continue to make progress from here and reclaim the lost market share, they will continue to tread forward. Getting back to pandemic environments will take some time, if not more time than they expect.
Well, I don't want to get back to the pandemic,
who does?
to be clear.
Poonam, how's the brand positioned vis-a-vis its competitors, the Nikes, the Adidas of the world?
So it's much, much smaller than the Nike or the Adidas, right? So they can't make big bets on athletes that are already established to win mindshare. They have to bet on the rookies. They have to get the talent early on. And if it strikes in their favor, then they do well.
All right, let's switch gears to the big name after the close today, Amazon. What are you expecting from Amazon?
Good results. I think Amazon's going to have a great fourth quarter, especially on the retail side. We had very strong holiday online sales, and we think Amazon will be a direct beneficiary of that. As we move forward, though, on the guidance, and that's really what we're focused on the retail side, there's a lot of talks, as you probably know, on the tariff situation. And there are both positives and negatives when it comes to Amazon and how they will go up against these new tariffs.
Hey, I just want to back up just for a second before we go into more specifics about Amazon. What's the state of the American consumer right now?
They're doing just fine, surprisingly. The consumer is spending. We talk about this a lot. They're just choosing where they want to spend. They're choosing what they want to buy, but they are clearly spending.
I mean, is it on who's doing better, the higher end stuff or the lower end stuff?
I think I would say the lower end is probably struggling more than the higher end. And I think that the retailers that are benefiting are the ones that can offer speed and convenience and product that is truly differentiated. So if you have something where you can connect with the consumer, you will see results.
So, Poonam, what are the retailers saying about this tariff situation, given that so much stuff comes from China?
Yeah, so it depends on the retailer and their exposure. There are some retailers that have zero exposure, like a Lululemon, for example, to China. So you have that on one spectrum. And then you have a Nike, which is the largest, which does have exposure to China in the mid-teens is how much they source from China alone. So there is exposure, and it will be a net negative. That said, Paul, we were talking 6 months ago, potentially 60% tariffs, right? And now we're talking 10%. So it's definitely come down a lot. And that 10%, the additional 10%, we think can be partly absorbed by the consumer and partly passed on to the consumer and absorbed by the retailer. So there'll be a sharing going on in effect, and we do think retailers will have minimal margin impact from it.
That's interesting. Back to Amazon real quick.
Sure.
What are the other metrics that you're looking at, Poonam?
Yeah, outside of the retail side, ad revenue we think should be also strong given the strength in the retail business. And on the AWS side, the focus really is not on the results, but it's more on the guidance, especially on the CapEx side, given what we heard from rivals earlier last week and this week.
And Poonam, this is Amazon's really morphed into truly a tech stock right now. Is that the shareholder base?
Well, it depends on what you're looking at. If you're looking at it on a revenue standpoint, it's still a retail company. But when you look at it from a profitability standpoint, absolutely, AWS is driving the momentum there. So I'd say it's still a hybrid.
Still hybrid. All right, Poonam, thanks so much for joining us. Poonam Goyal, Senior U.S. E-commerce and Retail Analyst for Bloomberg Intelligence, joining us via Zoom from Princeton, New Jersey. Amazon reporting results after the close. Carol Master, Tim Stenovic, they'll be breaking that down for you as part of the Bloomberg Business Week program. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Looking at this market here, S&P 500 up 10 points, the Dow minus 140 points, the NASDAQ up 20 points. So no real direction here trading today. Again, a big data point tomorrow, as John Tucker was mentioning, we're going to get the change in non-farm payrolls. Again, the consensus is a pretty decent month, 170,000 jobs forecasted to be added. The whisper numbers higher, about 197,000. Unemployment rate forecasted to be 4.1%. Still looking for pretty solid wage gain as well. So that'll be the data point tomorrow for the markets for the Federal Reserve. Tom Keene and I will break it down at 8:30 a.m. Wall Street Times, part of our Bloomberg surveillance program. Stay tuned for the latest market news and industry research. Balance of Power with Katie Lines is next after this global update. Again, S&P 500 up 10 points. That does it for John Tucker and me. This is Bloomberg.
This is CBS News on the Hour, sponsored by Progressive Insurance.
I'm Steve Kathan. A deadline approaches in the Trump administration's bid to change the U.S. government. CBS's Weijia Jiang has more on the payout offer that's on the table.
The deadline is midnight tonight, and already more than 40,000 federal workers have taken this offer. The administration thinks that number could be as high as 200,000 by the end of today.
Congressional Democrats say they'll take legislative and judicial steps and use public pressure in an effort to, as Texas Congressman Greg Casar puts it, fire Elon Musk.
An unelected, unaccountable billionaire now has seemingly unlimited powers over Americans' private data and over Americans' taxpayer dollars.
Musk has been given wide latitude to make government changes by President Trump. Democrats today did force a delay on a Senate committee vote for FBI nominee Kash Patel over a new controversy about what have been labeled enemies lists. This morning in Washington, a Trump vow to stop the targeting of Christians in the federal government.
It's a tradition in Washington that brings lawmakers together on both sides of the aisle. This year, it was two events, starting with the prayer breakfast at the U.S. Capitol.
We have to bring religion back. We have to bring it back much stronger.
Then, across town, the president announced a task force.
The mission of this task force will be to immediately halt all forms of anti-Christian targeting and discrimination within the federal government.
Trump said the task force will be run by Attorney General Pam Bondi and will eradicate anti-Christian bias. Linda Kenyon, CBS News, the White House.
President Trump today blamed last week's deadly collision of a passenger jet and Army helicopter on what he called an obsolete computer system used by air traffic controllers. In many parts of the East, an ice scraper is essential equipment today. From Harrisburg to Hartford, ice and snow making travel rough. CBS's Rob Marciano is in Hillsdale, New Jersey.
The roads now are getting a little bit better. They weren't so good an hour or two ago. It was really dicey in the secondary roadways here. There are a lot of school districts that are not going to school today.
CBS's Cammie McCormick has new climate information from European scientists.
The month of January set the latest heat record, warmer than January of last year, which set the previous record for the month. It comes as a new study claims global warming is accelerating. Still, there are hopes this will not be another record-setting year with La Nina, which could dampen the effects of global warming.
Wall Street, right now the Dow is down 135 points. This is CBS News.
state-funded programs.
There's a key question ahead of the Super Bowl halftime show.
Fans are wondering how the NFL will handle some lyrics during halftime at the big game. Reports say neither the league nor Fox has decided on whether to censor Kendrick Lamar's off-color words in his massively popular diss track, Not Like Us. The song's the subject of a defamation lawsuit over a line that labels the rapper's nemesis Drake a certified pedophile. Drake says the claim is false and malicious. Not Like Us picked up 5 Grammys on Sunday. Deborah Rodriguez, CBS News.
With President Trump attending the game and last month's terror attack in New Orleans still fresh, Super Bowl security will be tighter than ever. Many streets will be blocked, and some 2,000 law enforcement officers will be deployed in New Orleans. I'm Steve Kathan, CBS News.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
Donald Trump and congressional Republicans try to find a way forward on the budget. Welcome to Balance of Power. I'm Kaylee Lyons. The president convening House lawmakers at the White House today as they tried to work on the reconciliation agenda, with the Senate losing patience with the lower chamber and trying to move first. We'll get into the details shortly with Bloomberg's Mike Dorning. Plus, today is deadline day for any federal government workers who are hoping to take the administration up on its offer for a buyout if they leave the government by the end of February. We'll get into that with our political panel, Rick Davis and Caitlin Legacki today. Plus, Cliff Young of Ipsos Polling will be here as we take a look at how Americans are really feeling about the first couple weeks of this new administration. All of that is ahead this hour, but we begin, as always, with a check on the markets, and Charlie Pellet has a look from New York. Hey, Charlie.
Hi, thank you very much, Kaylee Lyons. Happy Thursday. First-time jobless claims Thursday, ahead of the jobs report tomorrow morning, and indeed a sense of caution. We've got Amazon coming up after the close of trading today. Lots going on. Right to the numbers with the S&P just about flat on the day. Little changed, up 8 points, up by about 0.1%. We've got the Dow Jones Industrial Average moving lower. The Dow is slumping 0.3%. Certainly Honeywell shares weighing on the Dow. NASDAQ up 20 for the NASDAQ Composite Index. That is a gain now of just about 0.1%. The 10-year at 4.45%, with the 2-year currently yielding 4.20%. Spot gold down $15 the ounce, 28.51 right now on the precious metal, down 0.5%, while West Texas Intermediate crude down 0.2%, 70.81 for a barrel of WTI. Bitcoin right now down 0.2%, 96,757 on Bitcoin. New numbers out of Washington show jobless claims picking up, with initial applications for U.S. unemployment benefits increasing by 11,000, remaining relatively subdued. Reaction to the numbers from Jack Caffrey, portfolio manager at J.P. Morgan Chase Bank.
The U.S. economy is 60% consumption, 65% consumption. That's a flywheel. Once it starts turning, it continues to turn. And I would say, as much as we live for Employment Friday, Jobs Friday, realistically, it's Unemployment Thursday that probably is the more telling issue with respect to, is that flywheel continuing to turn?
Jack Caffrey of J.P. Morgan Chase, and you can hear more of that conversation on the Surveillance podcast, and you can download it wherever you get your podcasts. Honeywell International will split into 3 separate publicly traded companies following pressure from an activist investor. Honeywell shares down now by 5.5%. After earnings, Qualcomm today down by 5%. After earnings, Ford down 6.4%. Recapping, S&P right now up 8, up by 0.1%. For on-demand news, 24 hours a day, subscribe to Bloomberg News now, wherever you get your podcasts. Balance of Power continues. Once again, here she is, your host, Kaylee Lyons.
All right, Charlie Pellet with a look at the Thursday trade. Thank you so much. Yes, the end of the work week is almost upon us, and the congressional work week certainly is about to be over. And it looks like we'll finish up this week without achieving what the objective was of House leadership to do this week, which was mark up a budget resolution. This is a key first step forward in the wider budget reconciliation process that they're hoping to use to get through Donald Trump's legislative priorities: the border, energy, tax policy, importantly. Of course, House lawmakers have been advocating for all of this to happen in one big package, and Donald Trump has suggested one big beautiful bill as his preference as well. The problem is there's a massive dispute between hardline conservatives in the House who want pledges on steep spending cuts and the rest of Republican leadership, and that seems to be holding up the timeline here to the point where members are getting a little frustrated, including Republican Congressman Byron Donalds of Florida, who reportedly got into it with the Speaker about this in a conference meeting yesterday. We got to ask him about it on Balance of Power last night, and this is what he said about what the way forward should look like.
When it comes to tax policy, most of the Tax Cut and Jobs Act is not new policy that we got to work our way through. We are extending most of that policy and having new conversations on no tax on tips, no tax on overtime, no tax on Social Security, the ECCA, and some other new tax pieces that we're going to have to figure out. But the political lift is not in explaining the policies, it's moving it through the two chambers. In my view, two bills is the way to go at this point.
The question is whether the president is going to be on board with two bills, because, again, his preference was for one big one, though he has also suggested he doesn't really care as long as all of this gets done. And the president is convening key House Republicans at the White House today. That meeting, as far as we know, ongoing as we speak, to try to find a way forward. So for more on this, we turn to Mike Dorning, who helps lead our congressional coverage as the deputy leader of our Capitol Influence team here in Washington. He's with me in the D.C. studio. So, Mike, I do wonder if this is a question really of who might be able to sway President Trump, if anyone, or who's doing the swaying here. Is it about President Trump needing to sway hardline conservatives into agreeing to one big package, just falling in line with the rest of the conference, or is it hardline conservatives and leaders in the Senate who might be able to convince Donald Trump that actually two bills is a better strategy?
So the only reason why they're talking about doing one bill is because they think it's going to be hard to sway the hardliners in the end, and by making it one big bill, it'll be harder for the hardliners to desert them, or if the hardliners win, for the moderates to desert them. The general way, like any normal administration would go and handle this, is the exact way the Senate's doing it, which is, hey, you're new in town, you want to deliver a win early, both for the president and for the Congress of the Republicans, and show you're helping with the border enforcement, the immigration crackdown, and that's something that, you could get all the Republicans behind. And then you come back with the more complicated tax bill. Speaker Johnson's just afraid that if you do it in two pieces, he's never going to be able to get the hardliners to agree to the tax bill without big spending cuts, and the more moderate members of the Republicans to agree to the big spending cuts. And they don't want to have any Democrats that they have to make a deal with. So that's the tension. And for a while, the Senate was waiting and saying, hey, okay, yeah, go to it, Mr. Speaker. And then, a month later, there's no plan. So the Senate's like, okay, train's leaving the station. We're going next week. You had your chance. So it's all in that morass at the moment. And of course, President Trump has huge clout with his party. You've just seen that in these confirmations, where all the senators who had problems with nominees just changed their minds once President Trump put pressure on them. And that's what they're hoping for now, is Trump can just crank up the pressure and get everyone into line.
Well, so, and if it is the Senate that looks like it could go first, as Senator Lindsey Graham, who chairs the Budget Committee, has suggested, I'm moving next week. It's going to be a two-part deal. The first part dealing with border and defense, some energy measures, as well as saving tax for later. What does that actually do to the timeline on a tax package? How long would it take for part one to work its way through both chambers before they can get to part two?
So what it would do is it would get the border stuff sooner than if you had one big bill, and the tax stuff later than if you had one big bill. If you had one big bill, it would just take longer to get everything done. But by breaking it up into two pieces, you can move the first piece on express, and then the second piece is just going to take longer because you're not even starting on it till later. My guess is the tax stuff would probably drag on into the second half of the year under this two-bill approach, although in theory they could do it sooner. But even if they did it on one bill approach, it'd probably take months to get it done.
Well, and in the interim, or perhaps while all of this is happening, you need to keep the government funded beyond mid-next month. March 14th is the deadline. You're going to have to raise the debt ceiling at some point, something that, at least if we're judging by historic precedent, Democrats need to get on board with. So how do those pieces fit into this puzzle?
So it's just another way that you're going to have the hardliners unhappy and harder to deal with, because when you do this keeping the government open in mid-March, you're probably going to have something that either appeals to the Republican moderates or the Democrats. You're never going to get something that really is just what the hardliners want, and that'll take a little time, and then you'll wind up with angrier hardliners, so it makes it harder. And then the debt limit, you're probably going to get angrier hardliners in one way or another. So it just creates more anger, more dissension, and more time burned up.
But the Democrats are
kind of... they'll get those things done.
Yeah, the Democrats are kind of angry right now also, right? Is there any indication that they're going to be as willing to provide the necessary votes to get must-pass legislation over the finish line as they were, say, last Congress?
They're probably not going to be as willing to, because in the last Congress, that was partly to serve their own president to get that through. Now, if certain, the Democrats will come in with demands and the initial demands probably won't be met, it'll be a question of whether they can meet some demands that the Democrats have enough to get them on board, or make the hardliners and the moderates come to an agreement on the Republican side. Now, you do, again, have a president on the Republican side who has shown that he can force the members to do what he wants. So if he's willing to burn up his political capital and really put the pressure on House members, he could probably get all of this done.
Well, and as you already pointed out, it has been illustrated in the Senate as well, with his nominees being able to get confirmed or making it through key votes. I did want to point out today, though, Kash Patel in the Judiciary Committee, it was supposed to be a vote held today to advance him from committee to the floor, got pushed back. Is this just delay tactics on the part of Democrats again, or does this change the calculus as to whether or not he will ultimately be able to be confirmed?
I haven't seen anything that makes me think that it will change the calculus as to whether he will ultimately be confirmed, but we'll see.
Well, and in the meantime, the Democratic senators are trying to run out the clock here on Russ Vought for OMB director. They've been keeping the Senate floor occupied for the entirety of the hours allotted for debate here. It's still the expectation he gets final confirmation this evening, right after 7 p.m.?
Yes, absolutely. But there's a purpose to this. In some ways, it's just like, in terms of stopping it, it's pointless. It's not, they're not going to stop it. It's just going to delay it for 30 hours. 30 hours does not make any difference whatsoever at when Russ Vought starts his new job. But the purpose is to put a lot of attention on him and create this definition of him. And this conflict is probably the only way Americans have ever heard of Russ Vought in most cases, or at least the portion of Americans that are even hearing of him now. Yeah. So by having this giant conflict, both for the general public and for their own base supporters, they are sending a message.
All right, Mike Dorning, always covering Capitol Hill for us. Thank you so much indeed. And as we consider this second administration as it is taking shape, we're going to get into what public opinion is actually suggesting about how Americans feel about these first few weeks. Cliff Young of Ipsos Polling will be with me next, right here on Balance of Power on Bloomberg.
6:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow lower, the S&P, NASDAQ, both advancing. Relative sense of caution prevailing on Wall Street as traders and investors await the jobs report tomorrow morning, 8:30 a.m. Wall Street time, and then Amazon earnings after the close of trading today. Here's where we stand with the S&P right now up 13, up by 0.2%. Dow Industrials being weighed down by Honeywell. Right now, the Dow is down 131, lower by 0.3%. NASDAQ is up 42 now, higher by 0.2%. The 10-year 4.45% with a 2-year that's currently yielding 4.20%. Spot gold at $28.50 the ounce. Gold down $16 the ounce, down by about 0.5%. And West Texas Intermediate crude 70.81 a barrel. WTI down by 0.3%. Bitcoin with a $96,000 handle now, 96,520, down 0.4%. Yum Brands after earnings now surging by 8%, having their biggest gain in almost 5 years after sales surpassed expectations, boosted by growth at the Taco Bell fast food chain. Again, Yum Brands right now gaining by 8%. After the close of trading today, we will be hearing from Amazon. Ahead of earnings, Amazon up by 0.5%. Balance of power continues. Back we go to Washington. Once again, your host, and here she is, Kaylee Lyons.
All right, Charlie Pellet in New York, thank you so much. I'm Kaylee Lyons in Washington, where we're marking today, for those of you counting, day 17 of the second Trump administration. And I know to some it might feel like it's been more like 17 weeks, perhaps even 17 months, considering just how much has happened in the 2 weeks and change since Donald Trump took the oath of office once again, with executive order after executive order after executive order. It's been basically a daily thing. In fact, he has another executive order signing scheduled for this afternoon, 2 p.m. Eastern time, roughly. We'll see if that turns into another de facto press conference with reporters where we could get some more news, because there's been a lot of it. It's turning into a bit of a pattern. But of course, it is still early days in this administration. Again, just 17 of them have passed, or we're in the 17th now. And the president says he's been spending these early days delivering on the mandate that the American electorate gave him. And that's why he's moving so quickly. But we wanted to take stock of how people are actually feeling about what the president has done so far. And for that, we turn to Ipsos, which has new polling out on a lot of this. And Cliff Young, Ipsos's head of polling, or president of polling and public affairs, is here with me in our Washington, D.C. studio. So, Cliff, you have a lot of specifics, and I do want to get into that. But if we could just talk about his approval overall, how's it looking?
He's in a really good place. And he's in a better place than he was in 2017. And so if you take the average of the polling, not just Ipsos, but all of us, it's around 48, 49% approval rating. That's really strong in a hyper-polarized world, a world like that we live in. In 2017, it was 41%. So Trump 2.0, in my evaluation, is much more robust, much more muscular, and he has a much stronger coalition than he did in 2017.
Well, so when we take a good starting position, I guess, just how difficult historically has a good start been to hold on to? I think we all remember early on in President Biden's term, approval pretty good. Post-Afghanistan withdrawal, it precipitously dropped, and it really never recovered after that. So what does history suggest about patterns here?
Yeah, time is not your friend when you're a president, and we're looking at your approval ratings. But basically, he's in his honeymoon period. This is the period when Americans writ large will give him the benefit of the doubt, give the president the benefit of the doubt. What we know is the following. Presidents typically have about 6 months before approval ratings begin to decline more precipitously. On average, a decline is between 5 and 7 points. And we will see, obviously, because, he might buck the trend. But really, he has those 6 months to get things done and get his agenda pushed through.
Well, he certainly isn't waiting 6 months to try to get things done. He didn't even wait 6 hours, arguably, after he was inaugurated. So if we could get into some of his initiatives, beginning with the one that we've paid a lot of attention to here at Bloomberg, considering the cast of characters involved, the Department of Government Efficiency and Elon Musk and these wider efforts to trim down the size of the federal government. So far, is this popular?
Yeah, it is popular. And indeed, we pulled on a whole host of executive orders. Some aren't very popular, some are. Those linked to government efficiency, saving, the public's money, are very popular. They're above 60%, which is strong. And once again, in a highly polarized America, public opinion in general is supporting at this moment those efforts.
Even the efforts being led by Elon Musk, I do wonder if there's any data on how people feel about him specifically as an unelected individual who is playing such a big role here.
People support those efforts. And Elon Musk, when you look across the board, the political figures, let's treat him as a political figure in this case, across the board, he has pretty good favorability scores. High 30s, low 40s, once again, that's a good place to be in a highly polarized America like we see today.
Okay, so if what he is doing is popular, what's on the unpopular side of what we've seen so far? What is least popular?
Well, you know, the administration has backtracked, right? And when they froze all funding to basically grants and services, they backtracked. They reversed the order. Only 20% of Americans agree with that executive order. So that's an example. Like when it really hits the pocketbook, when it affects sort of children or the family, when it is seen as unfair, those sorts of executive orders are less popular. But once again, there are some that are very popular, some that are less so.
So when we consider, for example, the effort to dismantle USAID or the pullback in foreign aid specifically, not necessarily the money that's being spent on social programs or what have you here at home, do people care about this, or is this largely something happening in you know, NGO circles, those of us here in Washington that are paying attention?
Yeah, we're worried about it in the Beltway. No one else is. The bubble, yes, exactly, the bubble. You know, basically, foreign aid has always been an easy target. Most Americans think that we're spending in the wrong place when we're spending on foreign aid. And it makes total sense from a strategic perspective that the administration is going after it, because really you don't have much public support for that. Indeed, those sorts of efforts have, you know, have support in the mid-50s to the low 60s, depending on how you ask the question specifically. So once again, public opinion is behind it.
So if we consider foreign policy issues as well, not just in terms of foreign aid, but in, say, the expansion perhaps, or manifest destiny, widening U.S. borders, looking at Canada as the 51st state, or taking over Greenland or Panama, for that matter. We've already seen the renaming of the Gulf of Mexico to the Gulf of America, and Mount Denali to Mount McKinley. Is there support for these kinds of notions? Do Americans want America to get bigger in terms of footprint?
Yeah, that's very interesting. Americans don't like the renaming of the Gulf of Mexico.
They don't.
No, it's in you know, it's
Gulf
it's
of America is unpopular.
weak. It's a weak plurality that are in support of that. No, in general, this sort of more muscular foreign policy, Americans are not in favor of. Indeed, that's one of the reasons that Trump ultimately won. Not even Republicans support those sorts of efforts. And so once again, if he pushes those efforts forwards, those initiatives forwards, it will be misaligned with public opinion.
Well, and it's not just in the case of Canada, him wanting to have Canada join the United States, become a state united with the United States. He's also trying to exercise a lot of leverage over Canada with the form of tariff threats. Obviously, that's been punted a bit, but there was a lot of warning from American industry specifically about the impact tariffs could have on American jobs, on costs for American people. Does the electorate reflect that in terms of favorability views around tariffs, or are they largely supportive of that kind of policy?
Support for tariffs has declined over the last, let's say, month and a half.
Okay.
And so if we were talking, let's say, in mid-November, I would tell you that a majority of Americans are in favor of it. Right now, we're seeing strong pluralities in favor of it. I think the reality has set in a bit. That said, when you peel away the onion and you look at Republicans, supermajority support for such efforts.
Well, especially, I guess, when those efforts are tied to, at least in the words of the president, issues of border security, stopping the flow of fentanyl and migrants over the northern and southern borders. Obviously, that's not where those efforts stop. We've seen a lot of border and immigration-oriented action from this president so far, ranging from trying to end birthright citizenship, which has run into trouble in courts, to just sending more troops to the border, ending asylum claims, that kind of thing. How do people feel about the range of those efforts? Are some things more popular than others?
Yeah, America is not a monolith.
Sure.
And Americans see the nuance. And so a supermajority percent of Americans, 87% of Americans, support the deportation of illegal immigrants who are also criminals. Indeed, that's where the administration is really focused. There's a lot of support for that. But when you start to deal with children or involve children, birthright citizenship, DACA sort of children, and adjacent sort of segments, Americans do not support it. So once again, broad-based support for deporting, all the the criminals that are here illegally, but much more nuanced, less support for other sorts of deportation.
All right, and that nuance is important. Thank you for sharing
you.
your data with us. Cliff Young joining us from Ipsos Polling. And I want to get a little reaction as well to some of this data and the figures we're seeing for the Trump administration so far from our political panel today. Rick Davis with me, Stone Court Capital partner and Republican strategist, alongside Democratic strategist Caitlin Legacki. Rick, Cliff just told me President Trump's in a pretty good place when it comes to his approval rating, at least early on. How long is he going to be able to hold on to it?
Yeah, I actually think it's kind of precarious. I was reading some of Cliff's data, and, Trump's got the weakest first 100-day numbers of any president going back to Dwight Eisenhower. I mean, by 20%. And so, yeah, it's the modern era. We're divided as a nation, but the least popular president at the time was 55%, was Bill Clinton in his first 100 days. So that's 10% higher than Trump. So, I think he is muscular. A lot of that coalition seems to be former Democrats. I think that it says as much about the Democratic Party as it does the Republican Party. But I can't imagine if he does what Cliff says, which is this might be his high point of his entire administration, then he's right back to where he basically was in 2017, which was, hovering in the low 40s, high 30s, which is right back where Biden was. So I don't know. I think it's too early to tell, but he's certainly getting a lot done in his first 100 days. And maybe part of that strategy is a recognition that this is as good as it's going to get, and why not go as quick as you can while you're still popular?
Well, and Caitlin, briefly, even if he's low for a just starting out president, he's still higher than the president's approval leaving office was in Joe Biden. How much of this is just a comparison game, the immediate comparison?
Yeah, I think that's absolutely what it is. We saw if this election was a referendum on anything, it was a referendum on the establishment and our institutions. And so what you're likely seeing is some measure of support for Donald Trump and Elon Musk coming in and promising to shake things up. I think where they have kind of blown this opportunity is that their initial opening salvo is freezing, government funding for essential programs. It is really, for lack of a better term, coming in and throat punching the opposition, which is not necessarily what the American people like to see. And so I think that I agree completely that this is probably a high point. And rather than trying to grow their coalition even further, it's clear that there's an agenda to punish opposition, and I think that's where the American people are going to really turn away.
All right, Caitlin Legacki and Rick Davis, my political panel today, I guess joined kind of by a third panelist. There's a dog in here somewhere. I think we all can hear it, and we'll have more with Rick and Caitlin still ahead as we talk about the deadline today for federal government employees and buyouts. It's all part of this slimming down DOGE effort, and we'll get into that next right here on Balance of Power on Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. We've got the Dow lower, the S&P, NASDAQ. They are both advancing. But bottom line here, we got a sense of caution hanging over this market. Amazon reports after the close of trading today, and tomorrow morning, the jobs report. Right now, the Dow is down 128, down 0.3%, being weighed down by Honeywell. Honeywell down 5.5%. S&P up 10, up by 0.2%, while NASDAQ is up 33. For the NASDAQ Composite Index, a gain right now of 0.2%. The 10-year at 4.44%, the 2-year 4.20%. Spot gold is trading lower by $17 the ounce, down 0.6%, and West Texas Intermediate crude down 0.4%, $70.75 for a barrel of WTI. Jobless claims are running near historic lows heading into tomorrow morning's employment report. With that story, here's Bloomberg's Vinny Del Giudice.
The Labor Department reports weekly jobless claims totaled 219,000, higher than the prior week, but generally in line with pre-COVID levels. The data are consistent with the labor market that Federal Reserve Chair Jerome Powell describes as pretty stable. Separate data from outplacement firm Challenger Gray and Christmas show U.S. employers plan fewer job cuts in January. Vinny Del Giudice, Bloomberg Radio.
Qualcomm, the world's biggest seller of smartphone processors, is lower on investor concern that demand for the devices will cool. Qualcomm right now down 4.8%. Ford lower after warning that profit this year may fall by $2 billion or more due to lower vehicle prices and costly new model launches. Ford shares are tumbling 6.7%. Also reporting earnings this morning, Hilton Worldwide Holdings. Hilton shares up by 5.1%. Again, recapping the Dow lower, S&P, NASDAQ both higher, S&P up by 0.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. And Balance of Power continues. Back we go to Washington. Once again, your host, here she is, Kaylee Lines.
All right, Charlie Pellet in New York, thank you so much. I'm Kaylee Lines in Washington, where those working for the federal government in this region and others are facing a deadline today. Yes, the clock is ticking toward midnight, which is the latest, apparently, that you could tell the Trump administration whether or not you're going to take them up on a buyout offer. This offer is if you leave the federal government by the end of February, you'll be paid until September. At least that's what they're saying. According to an official from the Office of Personnel Management, which is overseeing this, spoke to Bloomberg last night, more than 40,000 people as of late yesterday evening had already signed up for this. That's roughly 2% of the civilian federal workforce. And officials did suggest they expected kind of a last-minute rush in the final hours of this window of people also taking this offer. And if they don't, according to the OPM, federal agencies are likely to be downsized. So there does seem to be a kind of undercurrent here of you can either take this or you might risk losing your job anyway. It's all part of an effort to cut government spending, of course. So let's get into this now with our political panel, which is joining me once again, Caitlin Legacki, Democratic strategist, alongside Republican strategist Rick Davis, partner at Stone Court Capital. Caitlin, I guess just first to start, for those who are considering taking this, maybe getting ready to send this resign email in the next several hours, are we even sure that ultimately these payouts will really come?
No, and I think what we have seen and heard reported so far is that government HR officials have made clear that this could change at any given moment. And we've already seen these proposals change numerous times since the initial fork in the road email was sent. So, these employees are having to choose one type of uncertainty over another. It's really unfortunate because these are the people that are ultimately responsible for delivering pretty essential government services.
So, Rick, would you trust this if you were someone weighing this offer?
Look, first, government needs to slim down, right? There is a real argument for reducing the federal workforce, and it's been debated for decades. And little impact so far. And certainly other Republican administrations, when they've tried it, they do it through a normal process called reduction in force or a RIF. And RIFs are meant to be designed to preserve those individuals with the experience and the knowledge and those who are relatively new to the government workforce to leave. This kind of offer is really attractive to more of the people who've been there a while and actually can go get another job and have experience than the younger people. So I'd hate to think, and we don't have any data on this at this stage, that the vast majority of the 40,000 people leaving the workforce voluntarily are the ones who have the most experience and knowledge within the programs that they represent, and that what we're going to be left with is inexperienced younger workers who aren't going to be able to do the job as well. So I think that the quality of the workforce is as big a discussion as it is the size of the workforce.
Well, so Caitlin, does that mean if we see kind of this culling and if not enough people leave, these agencies get slimmed down anyway, that just as quickly they might need to beef them back up if the work of the federal government hasn't been able to be done as efficiently, which is supposed to be the whole point here?
Yeah, I mean, we saw yesterday that they sent this email to every employee of the CIA, which has an essential national security function. And I think what we're going to find is that the people that take these buyouts, there's not going to be any method to who takes it or when, aside from whether someone is probably closer to retirement or not. And so we are going to find ourselves in a position where either the Social Security Administration doesn't have the staff they need to process checks, or the CIA does not have enough analysts, that we're going to have to move very quickly to backfill some of those roles in a bit of a panic. This is what happened when Elon fired all of those engineers at Twitter. And so I can't imagine why this would play out any differently.
Well, so now that Elon Musk has been brought up in this conversation, Rick, he obviously is capturing a lot of the attention with his efforts at Doge more widely coming in to dismantle or at least suggest dismantling USAID. Obviously, much made over the access that has been granted by some of his workers with him at Doge to the Treasury payment system. Are we seeing any real test to the limits of his efforts other than what could potentially come from courts? Is it the judiciary that is going to have to ultimately rein things in if they choose to?
Well, I'm not even sure, I would call it reining things in, right? The judiciary will determine whether what he is doing and what the government under Donald Trump's doing is legal or not. And there's a big difference between reining in Elon Musk and his what he's doing politically, and obviously there's an active argument over that as it relates to USAID, as you've mentioned, Kaylee. But if the only question the judiciary is going to answer is, can he legally do it? I mean, that may not slow him down a bit, right? Because that is part of the goal that the Trump administration has, is to test the legal limits of presidential power. And if the tip of their spear is Elon Musk, I think they've got a good tip, because he's going to press it. He's going to do everything he can to accomplish the goals that Doge has set out, and we've been talking about ever since the first Doge comments were made. They've been consistent. And so that's the only question left, really, is I don't see any political vulnerability they have within their own party, and that's the majority in Congress. So the courts are the last resort, and their only resort for legal tests, not political tests.
Well, and I would, on the legal questions, point out that a district judge here in Washington today did at least partly limit access by Doge to the Treasury payment system, which individuals specifically would have access and what kind of information they could share outside of it. But that's just, it seems, a kind of temporary solution until the judge actually hears arguments in this case later on, Caitlin. So in the meantime, if it's going to take a judge whether to say ultimately this is legal or not, how much activity can take place in the interim? How far could Elon Musk push things?
I think that he could push it as far as he wants to. We already saw reported today that they tried to use Doge to cancel payments through the Treasury system. They are absolutely testing every single fence to see which ones they can break through. And I think Rick is exactly right. Like the courts are not going to be able to keep up with this. And it's really a question of whether or not Republicans start to feel political pressure to constrain some of this from a political perspective, because the courts are just not designed to move at this pace.
I would point out as well, when it comes to the Treasury payment system access specifically, we will just about 10 minutes from now be bringing you an interview on Bloomberg from our colleague Saleha Mosen, who's sitting down with Scott Bessent, the new Treasury Secretary, and she will be asking him about this. So that's straight ahead, and we'll look forward to his answers on this. But to what you both were alluding to about whether there's Republican appetite to counter Elon Musk at all, Rick, are we going to see congressional oversight over an individual that does seem to have so much power to influence the shape of the federal government, even though he is unconfirmed by the Senate, he's unelected? Right now, there is no real oversight or check necessarily beyond what we've already discussed.
Yeah, and they have the oversight ability, right? They can subpoena Elon Musk to come tell them what he's doing, and they can throw up legislative roadblocks to doing that. But they don't seem to have any appetite to do that. I mean, one of the ways to do it, and we saw this happen quite a bit in the Biden administration by Democrats, is just hold up your confirmations. I mean, you barely have enough votes to confirm the cabinet of President Trump. And all it would take in many cases is one individual in the Republican caucus of the United States Senate to say, whoa, wait a minute. It's not that I'm going to vote against this guy or this woman. But what I would like to do is have Elon Musk come to Capitol Hill and explain to us what he's doing at USAID. And then we can get along with confirming these people after that. And so that is an enormous power that the Senate has, and in this case, the majority Republican senators, and they don't seem at all interested in using it for this purpose. So, yes, they have the ability to get Donald Trump and Elon Musk's attention instantly. But whether or not that happens, I'd say likely not.
Well, and on confirmations, Caitlin, obviously Democrats are trying to take something of a stand to the extent that they can, knowing they don't have the votes to block a confirmation outright, by doing things like what is taking place right now on the Senate floor, continuing 30 hours of debate on Russ Vought, who is expected to ultimately be confirmed to lead the Office of Management and Budget around 7 p.m. tonight. What is the point of the exercise of delaying knowing the ultimate outcome?
There's a finite amount of time that the Senate floor has to accomplish things. And so it's really a question of, do Democrats want to play nice, or do they want to exact some sort of pain that forces Republicans to prioritize what they want to get done and allows them to achieve fewer things? And so it really is kind of throwing sand in the gears of this machinery. As you point out, Democrats don't, at the end of the day, have the ability to stop all of these, but it does give them some leverage to either exact concessions or slow down the rate of confirmations so that, in a worst case scenario, Republicans have a chance to achieve fewer things on their agenda between now and the midterm elections.
Well, and those are quickly looming, as we know. And in some of those, in 2026, senators who are looking vulnerable are the ones we've been watching around these more controversial nominees, whether it was Joni Ernst with Pete Hegseth, Rick, or ultimately Bill Cassidy in Louisiana with RFK Jr., who decided to cast a vote for him in committee earlier this week. His confirmation vote is likely to take place just a matter of days from now. Is there any indication that either RFK Jr. or Tulsi Gabbard, after clearing committee, could still go down on the full floor?
Yeah, unlikely. I mean, the biggest obstacles I think both of them had is their committees, where only one vote would have stopped the committee from approval. And in this case, full Senate, they have a majority of three that could get them through. So the odds are that they get through. And I would say, Joni Ernst, Cassidy, Collins, they're all up for re-election this cycle. Mm-hmm. And I'm sure part of the calculus is, hey, am I buying myself a primary opponent that's going to get backed by MAGA and Donald Trump, or in this case, funded by Elon Musk? So there is serious consequences to opposing this president's nominees.
Yeah, and you do wonder how that has influenced the decision-making of Tom Tillis, the senator from North Carolina, as well, who also cast a vote in support of Hegseth, despite some initial questions as to whether that would be happening or not. Rick Davis and Caitlin Legacki, my political panel today. Thank you both so much. They'll be back for more in the next hour of Balance of Power, where we have some pretty important conversations ahead. As Donald Trump met today at the White House with members of the House Republican Conference trying to find a way forward on budget reconciliation. I'll be joined by Republican Congressman Mike Flood of Nebraska, who's the vice chair of the Main Street Caucus. That is ahead. But most importantly, just minutes from now, a sit-down interview with the new Secretary of the Treasury, Scott Bessent, will be sitting down with Bloomberg's Saleha Mosin. It will be live here on Bloomberg, so don't go anywhere. It's coming up. This is Balance of Power.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
Welcome to Balance of Power. I'm Kaylee Lines, live on Bloomberg Television and radio, where we have an important conversation straight ahead. Treasury Secretary Scott Bessent sitting down for an interview with my colleague Saleha Mosin, a conversation that will cover taxes, tariffs, and the other economic policy priorities of this administration. And this hour, we'll be getting more on the role Congress plays in achieving all of those objectives. Republican Congressman Mike Flood of Nebraska will join me this hour, as will our political panel. It's Rick Davis and Caitlin Legacki today. We'll discuss the path forward on budget reconciliation. A meeting at the White House taking place about that today. So much is ahead, but we begin as always, with a check on the markets. And Charlie Pellet has a look from New York. Hey, Charlie.
Well, hello there, Kaylee Lines. Indeed, we have got the Dow lower, the S&P, NASDAQ, both advancing ahead of our interview coming up in just a moment with the U.S. Treasury Secretary. Right now, the Dow is down 104, down 0.2%. S&P 500 index moving higher by 14 points, up by about 0.2%, while NASDAQ up 54, up by 0.3%. Relative sense of caution prevailing ahead of earnings after the bell from Amazon and the jobs report tomorrow morning. The 10-year, 4.44%, with a 2-year currently yielding 4.20%. Spot gold is down $15 the ounce. The precious metal down 0.5%. 28.51 West Texas Intermediate crude 70.66 a barrel, down 0.5%. And Bitcoin right now is at 96,677 for Bitcoin. That represents a drop now of just about 0.3%. Honeywell International is going to be splitting into separate publicly traded companies following pressure from an activist investor, the latest in a line of industrial conglomerates seeking a more streamlined portfolio. Honeywell shares are lower, down 5.2%. Again, Honeywell weighing on the Dow. Philip Morris International, meanwhile, Philip Morris reporting better than expected profit. Philip Morris shares, they are surging now by just about 10.1%. Ford shares lower after warning that profit this year may fall by $2 billion or more due to lower vehicle prices and costly new model launches. So again, recapping, we do have the Dow Jones Industrial Average trading lower. We've got the Dow down 104 now, down 0.2%. To keep it all in context, we have got the S&P 500 index up by about 0.3%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. And back we go to Washington. Once again, your host, here she is, Kaylee Lines.
All right, Charlie Pellet in New York with an eye on the markets. And markets certainly are going to want to keep an eye and an ear on the next conversation here on Bloomberg TV and radio. So let's get to it without further delay. I'll turn it over to my colleague, Saleha Mohsin, who is live at the Treasury Department with the new Secretary, Scott Bessent. Saleha.
Thank you, Kaylee. I'm here with U.S. Treasury Secretary Scott Bessent in Washington. Mr. Secretary, thank you for joining me.
Saleha, good to see you.
Mr. Secretary, we are inside the cash room at the Treasury Department. It is almost impossible to overstate how important the work that is done in this building is to the U.S. financial system. Yet right now, there is widespread concern about the DOGE team's access to sensitive payment systems. Are you worried at all that that access and that tinkering of the payment systems could affect the Treasuries market or cause any disruption?
Good. Well, Saleha, thank you for asking me about that, because there's a lot of misinformation out there. First of all, when you say the DOGE team, these are Treasury employees. It is 2 Treasury employees, one of whom I personally interviewed in his final round. There is no tinkering with the system. They are on read-only. They are looking. They can make no changes. It is an operational program to suggest improvement. So we make 1.3 billion payments a year. And this is 2 employees who are working with a group of long-standing employees.
The letter that the Treasury Department sent earlier this week talked about how the team currently does not have access to change the system. Have they at any point this year had the ability to make changes?
Absolutely not. This is no different than you would have at a private company. And by the way, the ability to change the system sits over at the Federal Reserve. So it doesn't even lie in this building. So they could make suggestions on how to change the system, but we don't even run the system.
And if they ask for, if they request the ability to change the system, would you grant that?
No, again, they have no ability to change the system. I have no ability to grant that change. That they can make suggestions, then it would go to the Federal Reserve, and just like any large ERP system, there would be tests, there would be this, there would be that, and then the Fed will determine whether these changes are robust or not.
As the Secretary of Treasury, you also oversee the IRS. Do you know what kind of access the team has to IRS data or individual taxpayer data?
Well, I'm glad you asked that too, because look, the IRS, the privacy issue is one of the biggest issues. And over the past 4 years, we've seen a lot of leaks out of there. The IRS systems are quite poor. When I started in college in 1980, I learned the program in COBOL. I think there are 12 different systems at the IRS that still run on COBOL. But as of now, there is no engagement at the IRS.
And if they request that access, would you sign off on that request?
They haven't, so we'll take that when it comes to it. I think there is a lot to do there, but the president was elected with a big agenda, and to the extent that getting the IRS in better shape is part of that, sure. Because look, with the IRS, what am I concerned about? I am concerned about collections, I'm concerned about privacy, and I'm concerned that the system is robust,
but do you
and
think,
customer service.
But do you think that if they ask for access, that is something you would consider signing off on?
There are a lot of things I would consider, but look, we're in the middle of the tax filing season right now. We even, with the government buyouts that expire at midnight tonight, we have mandated that the IRS customer-facing employees, that they're not eligible for that until May 15th. So I don't imagine anything's going to go on at the IRS until then or beyond.
Elon Musk, just half an hour ago, tweeted out that Treasury needs to stop approving certain payments. Has your staff tried to block any payments here at Treasury?
We have not, and I'm glad you asked that too. And just to put in perspective, Elon and I are completely aligned in terms of cutting waste and increasing accountability and transparency for the American people. I believe that this DOGE program in my adult life is one of the most important audits of government or changes to government structure we have seen. That when I was in my 20s, we had the Grace Report, and there's some great suggestions that came out of that, never implemented. Under Clinton and Gore, I think it was to government efficiency or reduce government, nothing happened. So President Trump came in, there's a big agenda, and I think that there are gigantic cost savings for the American people here. And I think it's unfortunate the way the media wants to lampoon what is going on. These are highly trained professionals. This is not some roving band going around doing things. This is methodical, and it is going to yield big savings.
At any point, would you heed what Musk just tweeted and stop payments from coming through Treasury?
Look, most of that happens above us, that it comes from the departments and the agencies. We are doing a complete review, and I want to emphasize to you and everyone watching that it is an operational review. It is not an ideological review. We want to make sure that the American people are getting the best practices, and I don't think that's happening right now.
The systems here at Treasury, they're known to be a little antiquated, but very, very sensitive, but also they're working. I'm hearing, at Bloomberg, we hear a lot about investors being concerned that this could hit markets in some way or start to cause a loss of confidence. As a longtime hedge fund investor, do you have a response to those concerns?
People shouldn't be concerned. At Treasury, we move deliberately and we fix things. That's the way we work. So everyone should know that all the payments are going to be made, they're going to be in good order, and at the end of this review, there are going to be substantial savings for the American taxpayer.
Mr. Secretary, you have experience in currency markets, and now in your new role, you oversee U.S. currency policy. I'd like to ask you, what does a strong dollar mean to you?
Well, first of all, the strong dollar policy is completely intact with President Trump. And I was very happy at his Economic Club of New York speech in August when he reemphasized the importance of maintaining the dollar reserve currency status. But let's think about what does a strong dollar mean. It really means four things. One, that when we think about a fiat currency, a piece of paper is credibility. So a strong dollar is credibility and a rule of law that is backing it up. Two, it means a composite price on the screen, the Bloomberg Currency Index, that is the dollar moving up against that. Three, it is a bilateral price. So what's important to remember is the dollar is either weak or strong versus something else. So we want the dollar to be strong. What we don't want is other countries to weaken their currencies to manipulate their trade. And then fourth, that we want to have the best policies that create the environment for a strong dollar.
Let's talk about other nations and how they manage their currencies. The president has asked for a tariff study from several of his cabinet officers or incoming cabinet officers due April 1st. And the Treasury piece of that is to assess how to handle when foreign nations manipulate their currencies. Do you see any evidence of manipulation in foreign exchange rate markets right now?
Well, we'll wait till the study comes out, but I think just intuitively, you and I could agree that when you see the accumulation of these large surpluses, that there is not a free-form trading system that's going. It could be due to the level of the currency. It could be due to trade restrictions. It could be due to some interest rate repression policy. So it could be any of those.
Are there any countries that you're monitoring or watching specifically right now? I know the president in the past has labeled China as a currency manipulator. Do you see any other nations that need to be closely watched?
Well, I think we'll see on April 1st. And as you know, that China is the most unbalanced economy in the history of the world. And they are in a deep recession right now. They're experiencing deflation, and they're trying to export their way out of that. And we can't allow that. We want fair trade. And part of that is taking a strong position on the currency and the terms of trade.
Yesterday, the Treasury Department had its first quarterly refunding since you were confirmed. Do you have any plans of looking at how the Treasury's debt issuance strategy comes together?
Well, I think the good news is that the trajectory of the borrowing is dropping. So I was very happy to see that it's one of the few good surprises I was left by the previous administration. So the trajectory is good, and the government's well-financed into the third quarter, and I believe that as it becomes apparent that the president's agenda is working, that we'll see a great deal of non-inflationary growth. And I think that will help us calibrate what the debt policy should be. But I don't foresee any changes in the issuance for the foreseeable future.
And what about the process? Do you think that TBAC is the most effective way of getting feedback from markets?
Well, I want to thank all the members of TBAC who are here this week. They are a very elite group. I think that maybe over time, we need to think about the style of engagement. It has turned into more of a research think tank than direct market engagement, and that's going to require some changes from both sides. I believe when TBAC was originally started, it was supposed to be a market feedback mechanism, a little less of a think tank, and we've been assigning research projects, so I think there's some recalibration on both sides, but I think that whatever we do, TBAC will still exist.
Mr. Secretary, you said yesterday in an interview that the Trump administration is more focused on long-term yields than what the Federal Reserve is doing, which is a bold statement. I want to ask, how do you plan to keep a lid on yields, considering the deluge of debt issuance that is coming down the pike and also some of the inflationary risks that are ahead?
Well, one of the things I wanted to emphasize is that we are not focused on whether the Fed is going to cut, not cut. What we are focused on is lowering rates. So we are less focused on the specific of rate cuts and how do we get the whole curve down. I mentioned that the 10-year, I believe, is the important price to focus on. It's mortgages, it's long-term capital formation. So, and look, I think with the president's policies of energy dominance, deregulation, and non-inflationary growth, I think that the 10-year is going to naturally come down. And then, look, on top of it, what if we do get some big savings on the spending side from the DOGE programs? Like, let's think of a naive formula. Government equals spending minus taxes. For my entire career, and beyond, maybe even back to pre-FDR, government equals spending minus taxes. The S, the Republicans, we like spending. We just wanted to raise it less. The Democrats want to raise it more. Taxes, Democrats want tax increases. We want tax cuts. What nobody's thinking about is what if the S actually went down? What if it actually goes down because of everything we're doing right now?
But what about the inflation concerns that are stemming from the tariffs and tariff threats?
Look, I'm not sure that where this narrative that tariffs for the country putting on the tariffs is inflationary, that we could have a small one-time price adjustment, that as we saw in Trump 1.0, that the deregulation and the other policies, we stayed right around the Fed's target level. So I'm unconcerned about that. You know, I think especially that China now, given all their excess capacity, will, no matter the level of the tariffs, will end up eating quite a bit.
There's a lot of uncertainty around tariffs. We see them threatened or signaled, and then they're taken back. It appears as if this administration might be unfriendly to businesses. Is that right?
Really? I think it's just the opposite. I think this is the most pro-business administration in history. And everything we are doing is going to increase the after-tax return on capital. And as a result, working Americans will have very high real wage growth. That what we've seen over the past 4 years is the government and government-adjacent sectors providing the employment growth. And why have we experienced this affordability crisis? First, there was a massive spending met by increased regulation, which caused inflation. And then government and government-adjacent jobs do not cause real wage growth because they move up at CPI. So, I think that we are going to not only be business friendly, but very, very friendly for working Americans.
We're seeing companies already under some stress from the tariff threats. China is investigating Google. And also, as you know, are well aware that businesses like to be able to plan ahead, but with so much policy uncertainty, that predictability factor is gone. That all points to a little bit of a tougher environment.
Well, look, I think the best thing we can do for predictability is make the Tax Cuts and Jobs Act permanent. That would be the single best thing we could do for predictability. We can go back to the 100% expensing and add some new features that I think business is going to be very happy with. But again, the most important thing is that it filters down to working wages, which is what we saw in President Trump's first administration. Hourly workers did better than supervisory workers.
Well, let me ask you about the tax plan then. On the campaign trail, Trump floated no taxes on tips and cutting the corporate rate and a lot of other proposals. How are you going to juggle which campaign promises are high on that the priority list for the bill, considering how costly everything would be? Well,
we're just starting the process now, and we'll do what President Trump will give us his priorities, but I can tell you the real priority is fixing this affordability crisis for the American people. And when you think about no tax on tips, no tax on Social Security, no tax on overtime, potentially putting back in auto loan deductibility, all of those benefits accrue to the bottom 50% of income earners in America. They have really taken it between the eyes for the past 4 years, and that's unsustainable.
Before I let you go, Mr. Secretary, I want to ask you if you have had your traditional weekly meeting with Fed Chair Powell yet.
We did. I did an away game over at the Fed. We had a very nice breakfast. Chair Powell and I don't know each other well, so it was very constructive.
How do you view that relationship involving the two agencies and buildings are supposed to work very closely together, and you've had some criticism in the past of his work?
And as I said at my hearing, everything I'm going to talk about is things the Fed's done in the past. Prospectively, monetary policy, I will not comment on. And I'm sure he's going to do the right thing. So there'll be no criticism.
All right. Well, Mr. Secretary, thank you so much for joining. Kaylee, back to you.
All right, Bloomberg's Saleha Mohsen live at the Treasury Department with the newly minted Treasury Secretary Scott Bessent. A wonderful interview taking place here on Bloomberg TV and radio. Thank you so much, Saleha, for bringing that to us. And there obviously is a lot to unpack from that conversation. So we'll attempt to work through this now here on Balance of Power, live from Washington, D.C. I'm, of course, Kaylee Lyons, and I'm joined now by Anna Wong, Chief U.S. Economist over at Bloomberg Economics, as we work through some of what we just learned from Secretary Bessent. Anna, thank you so much for being here. I guess we can begin where their conversation was ending, which was on monetary policy and the relationship that Chairman Powell may have with the Treasury Department and the way in which the Trump administration is viewing rates. We heard from the Treasury Secretary there that they aren't focused on whether the Fed will cut or not. They're focused on rates and policies that they could pursue that would actually bring things like mortgage rates down. To what extent is it really possible to do that if the Fed is not cutting rates?
I think, Kaylee, that is indeed the single most important question facing the market right now, and a question whose answer the market has not really priced in yet. So over the past 3 months, we have seen the 10-year yields risen by 100 basis points, even as the Fed cut interest rate by 100 basis points. I think that 3-month period shows that 10-year yields does not necessarily move where the Fed will be moving. And I think it is extremely important that President Trump is on board with Bessent's claim that they're now focused on bringing down 10-year yields rather than pressuring the Fed. And the way that they could do it is, as Bessent just explained to us, which is, number one, potentially cutting fiscal spending, so getting fiscal in order. And that would be quite a positive, surprising development if they're able to succeed. And certainly, I think in the past 3 weeks since this administration began, everybody has been surprised by DOGE and the effort they are putting in reducing fiscal spending. And I think generally, as economists, we have been, jaded in the past, and we think that no political parties have the will to bring down the fiscal deficit, except Bob Rubin back in the 1990s. And I think Scott Bessent is trying to basically replicate what Bob Rubin has done in the 1990s. And if they succeed, it will indeed usher in a period of non-inflationary growth, as Bessent envisions.
But then there's the question of other policies they could pursue, which we did hear the Treasury talking about, like tariffs, which prevailing wisdom is could be inflationary. But to put it in the words of what the Treasury Secretary just told Saleha, he described it as a, quote, one-time price adjustment on tariffs. He also suggested that China will end up eating quite a bit, not Americans.
Right. So
check.
I think it depends on what you mean by prevailing. So if you're talking about prevailing in the Wall Street consensus, yes. But Wall Street has groupthink, and sometimes so does the Fed. However, I would say that if you consider the wholesome empirical literature from trade, particularly the tools that the Federal Reserve staff had developed in the first trade war, you actually see that the evidence on whether tariffs are inflationary is actually very nuanced. And this is why even Powell in the last 2 press conference has begun to talk about how it depends on whether the tariffs are what goods is it imposed on and also on what countries, because I think Bessent is right. The difference between the current environment and the first trade war is that China's economy is in much worse shape right now, and much of the growth is due to external sector, so they might have the incentive to take on some of the burden of the tariff in this current trade war.
Yeah, he actually described China's economy as being the most unbalanced in the history of the world. Quite a superlative there. But on the subject of this notion of a one-time price increase, isn't the issue, though, even if it is only one time that you're actually seeing the adjustment being made in costs, consumers see it, and their expectation is, especially given recent experience of the last several years, that costs will keep climbing and inflation expectations get away, including from the Federal Reserve.
Yes, so that is the most serious risk, and that risk is a legitimate concern. At the same time, Powell has been talking about how inflation expectations have been very anchored, and if that's true, that inflation expectations are anchored, the tariffs should not have caused the pass-through to be recurrent. I mean, that's just economic theory. So if indeed that the pass-through of the tariff shows up in consumer prices and that lead to unanchoring the expectations, I think the Fed will need to ask themselves, why is it that it unanchors at this point, but not 2 years ago when inflation was hitting 9%?
I want to ask you about something, and you were alluding to this earlier, this notion that the Department of Government Efficiency is trying to pull back government spending. We just had some headlines crossing the Bloomberg terminal around the deadline, which was originally today, to buy out federal government workers. It was supposed to be today, February 6th. A judge has now extended that until a hearing on February 10th, so next Monday, as he considers whether or not to block that longer term. When we suggest, as the administration has specifically, that 5 to 10% of the federal workforce suddenly will be stepping back, that you're going to have these material cuts in federal spending, what does that mean economically for the country?
Yes. So in terms of, lower jobs growth would be dampening demand. So it is a negative demand shock. But what's the size of this negative demand shock? So assuming so currently I think there's just about 2% of the federal force took the buyout. It's possible that later in a couple of days it could rise to 5%. So the maximum unemployment hit could be up to 0.1 percentage point in our assessment, but that's a maximum.
All right, Anna Wong from Bloomberg Economics, thank you so much for helping us analyze that interview with the Treasury Secretary, Scott Bessent, and what we didn't get to with Anna, but also was important in that interview, talking about the access DOGE has to Treasury payment systems. And he says there's a lot of misinformation about they have no power to change the system and that people shouldn't be concerned. All Treasury payments will be made. We'll continue to bring you important analysis on that interview throughout the day here on Bloomberg TV and radio, just like we continue to check in with Charlie Pellet on how markets are doing. So let's get a look now from New York. Hey, Charlie.
Hi, thank you very much, Kaylee Lyons. Indeed, lots to digest from that conversation. Treasury Secretary Scott Bessent saying on Bloomberg television and radio, the U.S. continues to have a strong dollar policy under President Trump. The Bloomberg Dollar Spot Index, little change. Bessent also says with President Trump's policies, the 10-year yield will naturally come down. Right now, looking at a 10-year at 4.42%, the 2-year currently yielding 4.19%. Bessent says Musk's DOGE is not altering Treasury systems. And Bessent also a headline on the Bloomberg saying he had a constructive meeting with Fed Chair Jay Powell, and, quote, he's sure that Powell will do the right thing. S&P up 13 right now. Again, little changed at 6,074, up by about 0.2%. Dow Jones Industrial Average down 160, drop there of 0.4. NASDAQ higher by 61, gain there of 0.3%. 10-year at 4.42%, the 2-year 4.19%. Spot gold down $16 the ounce, down 0.6%, 28.50, and West Texas Intermediate crude down 0.6%, 70.61 a barrel on WTI. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And Balance of Power continues. Back we go to Washington once again. Your host, here she is, Kaylee Lyons.
All right, Charlie Pellet, thank you so much. As we just heard from the Treasury Secretary Scott Bessent and his view, and presumably the administration's view overall, the best thing for economic predictability, he says, is to make the 2017 tax cuts permanent. This, of course, is one of the legislative objectives of President Trump and of this Republican-controlled Congress. The question is how exactly they do that, and when, and how big is the bill? And it's those questions they're working through today as Donald Trump convened House Republicans at the White House to talk about the way forward on the budget. It's a complicated process, a budget reconciliation package. can be a big thing, or it can be two pretty big things, as the Senate would prefer. Lindsey Graham saying he's losing patience with the House and he's going to go ahead and pursue a budget resolution on part of this, the border and defense and energy. And the Senate wants to get to taxes later. The question is whether the House can get its act together on its idea for a one big beautiful bill before that happens. So for more, let's turn to our political panel. Rick Davis is with me, Stone Court Capital partner and Republican strategist, alongside Democratic strategist Caitlin Legacki. Rick, obviously, the Speaker of the House, Mike Johnson, had laid out a pretty ambitious timeline for trying to get one big package done. The more time that passes without forward progress, is it the greater likelihood that this thing does get split into parts?
Yeah, I actually, based on where everybody is today, I think there's literally no chance that the House of Representatives on this timetable that you just described that Speaker Johnson has, which includes getting all these things done, the debt limit, the budget for this year, all the reconciliation work that he's talking about doing, including an extension or making permanent the TCJA, all that by April? I don't think so. I mean, it's Herculean task in Washington to do something like that. So I think what you see is what you get, which is the Senate's already moving their budget, their border, and their defense bill that Donald Trump clearly wants and endorses as quickly as it can, and leave time then throughout the course of the rest of the year to get done the work of making those tax cuts permanent and increasing those tax cuts by other policy measures that Donald Trump hasn't even really endorsed or outlined yet.
Well, so Caitlin, here's the thing about what's making this difficult in the House. It's that there's hardline conservatives who want to see steep spending cuts, and that's not really in line with what leadership thinks is realistic when you consider moderate members and the fact that the Senate needs to be on board with these ideas as well. If the Senate moves first and splits these things into two, giving the border win to the president and potentially a border win to those hardline conservatives, why then, if it gets to a second tax package, would those same hardline conservatives be willing, without other incentives, to do things that could add to the deficit? If one gets passed, how much harder does number two become?
It's incredibly difficult. I mean, Democrats had this problem with the infrastructure bill and then the Build Back Better Act during President Biden's term. But I think the reason that this gets much, much more difficult if you split this into two bills is then Republicans are going to be in a position where they have to trade making the tax cuts permanent in exchange for other budgetary offsets. The thing about reconciliation bills is that they have to be paid for. And so where there's risk there is that the biggest chunks of federal spending are things like veterans benefits, Social Security, Medicare, things that are incredibly popular and will be politically very toxic if Republicans dismantle those programs or slash their funding in exchange for corporate tax cuts. So that's the line they're going to have to walk.
Well, so if you're trying to walk that line, Rick, obviously you can see where the difficulties lie in there. And Saleha was just talking about this with Secretary Bessent, this notion that there are a lot of tax ideas that have been put forward when it comes to reduce or no tax on tips, on Social Security, on overtime. Is it going to be a matter of just whittling down what tax stuff can ultimately get through? Could we end up in a world where actually all that happens is an extension of the 2017 package?
Could be. And I think you got to remember, too, on the political dynamic in the House, and this includes Democrats, if they let this tax cuts expire from 2017, it'll be the greatest tax increase in the history of the United States. There are a lot of vulnerable Democrats in Trump districts who are not going to vote for the large or sit back and vote against tax cuts that would result in an increase in their constituents' taxes significantly. And so it's not just this Republican versus Democratic dynamic. And that's why I think having a standalone tax bill to vote on before the end of the year, as people ramp up for elections next year, that they're going to think twice, if you're a Democrat, about voting against this Trump tax policy. And look, you're not going to get some of these Republicans no matter what. I mean, no matter if you even find offsets for this, these are people who don't support Donald Trump's agenda, regardless of what it is, These are folks who supported opponents to him in the primary. They're not on board like the majority of the Republican caucus, and you're going to have to find Democrats to offset that. And if you pile everything into one big package, it's going to be much more complicated, because then you're pressuring also, sort of Biden district Republicans. Remember, what's looming over top of all this is the SALT tax cut.
Yes. Buzzword here on Bloomberg TV and radio. Yes, the SALT cap will feature in these conversations. Rick Davis and Caitlin Legacki, our political panel here on Balance of Power today. Thank you so much. I'll be joined straight ahead by Republican Congressman Mike Flood of Nebraska.
And
So don't go anywhere. We'll be back for more on Bloomberg.